from that same valet's experience. So Roger, he always drove a Porsche. Predictably, people made assumptions. But then one day, Roger shows up in an old Honda, and then the next week, same thing. Turns out Porsche got repossessed, defaulted on the loan. But the really wild part, the observation in the piece is Roger showed not a morsel of shame, just like mentioned it casually, like it was nothing. And the author adds, kind of dryly, Los Angeles is full of Rogers.
That story is so telling, right? It just perfectly shows how modern capitalism, well, it makes it pretty easy to fake it, to project an image. You can finance almost anything, but the core truth, the thing this piece keeps hitting on, is that real wealth is what you don't see. What you spend, that's gone, or it becomes a liability. It's what you don't spend that holds the potential.
Okay, so if what we see is deceptive, how does this piece redefine wealth? Because it's definitely not the standard definition. It gives this really thought-provoking line: wealth is the nice cars not purchased, the diamonds not bought, the watches not worn, the clothes foregone, and the first-class upgrade declined. That feels like more than just, saving a few bucks. It feels deeper.
It is deeper.
Yeah.
That's a really key point the author makes. It's not just about pinching pennies. It's about understanding wealth as financial assets that haven't been turned into stuff you can see yet. It's the money you could spend, but you choose not to. And that's just inherently hard for us to wrap our heads around because, well, if the text says you can't contextualize what you can't see, we struggle with the invisible.
Yeah, and this deep dive uncovers this kind of weird truth, doesn't it? That when most people say, I want to be a millionaire, what they might actually mean is, I want to spend $1 million, which, as the piece points out, is literally the opposite of being a millionaire. It's consumption, not accumulation. It makes me think of that story about Rihanna, the singer. Apparently, she nearly went bankrupt from overspending and ended up suing her financial advisor.
Right. And the advisor's response was pretty blunt, wasn't it? Something like, did I really need to tell her that if you spend money on things, you end up with the things and not the money? It sounds almost ridiculously obvious. But the piece argues, and I think convincingly, that with all the societal pressure and our own desires, that simple truth is actually quite hard to stick to, even for smart people.
And investor Bill Mann put it pretty well. There is no faster way to feel rich than to spend lots of money on really nice things. That part's easy. But, he says, the way to be rich is to spend money you have and to not spend money you don't have. It's really that simple.
That's good advice, solid advice. But the perspective we're exploring here pushes it, well, a step further. It argues that the actual definition of wealth isn't just about accumulating money you have. It's specifically about not spending the money you do have. It's not just the path to wealth, it is wealth. That restraint becomes the asset itself.
So this leads us to a really critical distinction the author makes, that the difference between being rich and being wealthy, it's more than semantics. It's actually a source of countless financial woes. That's a strong claim.
It is strong, and it's absolutely vital for you, the listener, to get this difference. Rich usually means a high income, yes, but often accompanied by high visible spending. Rich people, often you know they're rich. The fancy car, the big house, the designer labels, they kind of signal it. But wealth is hidden. It's income that isn't spent, it's quiet, and its value, its real value is in giving you options, flexibility, growth, the potential to maybe one day buy even more stuff than you could right now if you wanted to. It's like an uncashed check for the future.
That hidden nature, it reminds me so much of the whole diet and exercise thing. We all know losing weight is hard, right? Even if you exercise like crazy. I think it was Bill Bryson in his book, The Body, who mentioned a study. People guess how many calories they burned exercising, and they overestimate massively, like by 4 times. And then the kicker is they go and eat about twice as many calories as they actually burned, so they end up further behind.
That's a perfect analogy.
Yeah.
Exactly. Exercise is like being rich in this context. You do the work, you feel you've earned it, so you treat yourself to the big meal. You feel good, maybe you even look good temporarily, but you're not actually making net progress on the underlying goal, which is weight loss or, burning net calories. Wealth, though, is like turning down that treat meal. It's actually achieving those net burned calories that's harder. It takes self-control, absolutely. But it creates that gap, that space between what you could do, eat the meal, and what you actually choose to do. And that gap, that's what builds up over time. That's financial freedom.
Okay, but if wealth is hidden like that, it creates this problem, right? Finding role models. It's easy to find rich role models. They're usually pretty visible, showing off their success. But wealthy ones, much harder because their success is, by definition, invisible. Like that guy Ronald Reed, the janitor who left millions. He became this huge financial role model, but only after he died. The piece makes the point that he was nobody's financial role model while he was living because every penny of his wealth was hidden, even from people who knew him well.
Yeah, and think about the implications for learning. How do we learn complex skills? Often by imitation, by seeing how others do it. The author uses this great analogy. Imagine trying to learn to write if you couldn't read books by great authors. Who inspires you? Whose techniques do you study? It would make a really hard task almost impossible, right?
It's tough to learn from what you can't see, and that helps explain why building real wealth is just such a challenge for so many people. So, really, the core takeaway, the big insight here is this: the world is filled with people who look modest but are actually wealthy, and people who look rich who live at the razor's edge of insolvency. They look great, but one missed paycheck and it all falls apart.
Exactly. And the advice, really, for you listening, is just to keep that firmly in mind. Keep it in mind when you find yourself quickly judging someone else's success based on appearances.
Yeah.
And maybe even more importantly, keep it in mind when you're setting your own goals. What are you actually aiming for? Visibility or security? It might change how you approach things.
Yeah, circling back to where we started, that irony of wealth, it's just so profound. Wealth isn't the stuff you buy, it's the options, the freedom, the flexibility that comes specifically from what you don't spend. It's the power of the unspent dollar.
So the final thought to leave you with, building on all this, is a question for yourself. If wealth is truly defined by what you don't spend, how does your personal definition of financial success stack up against that? Against this idea of unseen power and future options? What choices might you think about making differently now that you understand, maybe a bit better, the hidden nature of real, lasting wealth?
Thank you for joining us on this deep dive today. We really hope these insights give you something valuable to think about as you navigate your own financial journey. Welcome to the deep dive. We dig into interesting sources, pull out the key ideas, and, well, try to make sense of some complex stuff together.
That'd be here.
So today, we're starting with a thought from Brad Pitt. He was looking back at his career, 30 years, and said, some projects work and some don't. There's no reason to belabor either one. Just get on to the next.
That's a really interesting take, especially from someone at that level. Hits and misses.
Exactly. And it makes you wonder, right? How do some people or companies get these huge, almost unbelievable successes? Especially in fields where, let's face it, failure is pretty common.
Yeah, is it just pure talent? Or luck? Or maybe something else entirely?
That's what we're diving into today, this idea of tail events. It's a bit counterintuitive, but
Yeah.
it's the concept that just a very small number of things, events, efforts, whatever, can actually be responsible for the vast majority of the results.
Like, think of a curve where most stuff is average, in the middle. The tails are way out on the ends, the really rare but really high impact stuff.
And that's our mission for this deep dive, to explore that hidden reality, especially in areas like art, movies, and definitely finance.
It really does challenge how we normally think. We tend to focus on consistency, maybe getting things right most of the time.
Uh-huh.
But the data, well, it often points to the sheer size of a few wins being way more important than avoiding lots of small losses or just average outcomes. It's less bell curve, more power law, where the extremes matter a lot.
Okay, power law. So extremes driving the results. Let's make this concrete. How about the art world? There's this amazing story about Heinz Berggruen.
Ah, yes, Berggruen, quite a character.
Yeah, he fled Nazi Germany, ended up in California, studied literature at Berkeley. Didn't seem like he was destined for, mega success early on.
Not particularly, no.
But fast forward to the 1990s, and suddenly he's known as one of the most successful art dealers of all time.
Quite the transformation.
And the scale is just mind-blowing. In 2000, he sold part of his collection, Picasso's, Klee's, Matisse's, the big names, to the German government.
For over 100 million euros, right?
Yeah, which sounds huge, but apparently the real market value is maybe over $1 billion. He basically gave them a massive discount.
$1 billion, wow.
So how does someone do that? How do you pick art that becomes that valuable? Was he just some kind of art genius?
Well, that's the fascinating part and where this tail event idea comes in. Horizon Research looked into it.
Okay.
And they basically said, look, the great collectors, they bought vast quantities of art. Berggruen wasn't necessarily picking individual winners he knew would explode.
So what was he doing?
He acted more like an index fund. He bought portfolios, lots and lots of art, maybe, 99% of it turned out to be okay or even worthless.
Right.
But that tiny 1%, the Picassos, the really big hits, that was enough. It let him be wrong most of the time, but still end up stupendously right as the research put it.
Stupendously right. I like that. So the takeaway isn't about having perfect foresight.
Not at all. It's about having a process that allows for failure, lots of it potentially, because you're set up to capture those massive outlier wins when they happen.
Yeah.
We really underestimate how normal failure is in these kinds of fields.
Okay, that makes sense. And you see this pattern elsewhere too, right? Like Disney.
Oh, absolutely. Walt Disney's story is another perfect example. His start was rough, really rough.
First studio went bankrupt.
Yep. And even later, by the mid-30s, he'd made, what, over 400 cartoons? Mostly shorts?
People loved him, though.
They did. Critically acclaimed, popular, but financially, most of them lost money. They were expensive to make. Until Snow White and the Seven Dwarfs, 1937. That was the game changer, the massive tail event.
How big was it?
Huge. It made $8 million in just its first 6 months. That was unheard of back then. That money wasn't just profit. It funded the whole Burbank studio they still use today.
Wow.
And suddenly, Walt wasn't just a cartoon guy. He was a major Hollywood player, an Oscar winner, a celebrity.
So all those hundreds of earlier cartoons, financially, they didn't matter nearly as much as that one movie.
In business terms, yeah. Those 83 minutes of Snow White basically overshadowed hundreds of hours of previous work. It was the outlier that defined everything.
It really drives home that point, doesn't it? Anything huge, influential, profitable, it often comes down to one of these tail events.
Exactly, these one-in-a-million type things. And because they're so spectacular, we notice them, right? We focus on the Snow Whites. And that makes us forget how rare they are and how much trial and error or even outright failure usually lies behind them. We get skewed perception.
Okay, so let's talk investments. Venture capital seems like the poster child for this.
Oh, completely.
Yeah.
VCs go into it knowing this dynamic. They fully expect maybe half their investments to just fail, go to zero.
Right.
Then maybe a few will do okay, return some money. But the entire fund's success, that usually hinges on one or two absolute grand slams, the bonanzas.
And there's data on this.
Loads of it. Correlation Ventures did a big study, looked at over 21,000 venture deals over 10 years.
Yeah.
Get this, 65% lost money. 65%.
Wow, that's high.
It is. Only about 2.5% gave a 10x to 20x return. Just 1% made more than 20x. And the real magic, only 0.5%, half a percent, like 100 companies out of 21,000 returned 50x or more.
0.5%.
Yeah, and that tiny group is where most of the entire industry's profits come from. It's all tails.
So if you're a VC, you absolutely have to find those few outliers.
You have to. It changes everything. It's not just about avoiding losers. It's about making sure you're invested in the potential massive winners. You need that exposure. Missing those few can sink your whole fund.
Okay, VC is risky. We get that. But you mentioned the supplies elsewhere, like the regular stock market, public companies.
Yeah, and this is where it gets really surprising for a lot of people. You think of big established companies on the stock market as safer, more predictable, right?
Generally, yeah, more stable than startups.
But the same tail dynamic is powerfully at work. JP Morgan looked at the Russell 3000 index. That's like 3,000 of the biggest U.S. stocks going all the way back to 1980.
Okay, what did they find?
40%.
Yeah.
4 out of 10 companies in that index lost at least 70% of their value and never recovered. Basically wiped out.
40%, that seems huge.
It is. And think about this. Effectively, all the gains of the entire index over those decades came from just 7% of the companies, the huge outperformers.
So most companies were either failures or just kind of meh.
Pretty much. Think about a company like Coralco. Remember them? Made Rambo, Terminator 2.
Vaguely, yeah. Big in the 80s, early 90s.
Exactly. Huge success for a while.
Yeah.
$500 million in revenue, $1.5 billion market cap. Then, poof, bankrupt by 1996. Stock went to zero.
And that kind of wipeout happened to 40% of Russell 3000 companies.
Over time, yes. That kind of catastrophic loss is baked into the market. But here's the kicker.
Go on.
Despite 40% of its components being, terrible investments, the Russell 3000 index itself went up more than 73-fold since 1980.
73 times. How?
Because the winners won so big. That top 7%, the Microsofts, the Walmarts, the Apples, their massive gains more than compensated for all those losers. It's Berggrun's art collection, but with stocks.
Wow. Okay. So even in the safer public markets, it's still driven by these outliers.
Absolutely. And it even happens within successful companies.
How so?
Take Amazon. In 2018, it drove like 6% of the entire S&P 500's return. But why? Mostly Amazon Web Services and Prime.
Right. They're two huge successes.
Exactly. Those are tail events inside Amazon, a company that's tried hundreds of things. Remember the Fire Phone? Total flop. They had travel agencies, other experiments. Lots of failures.
Okay, yeah. And Apple?
Same story. Huge driver of the S&P 500, almost 7% in 2018. Why? Overwhelmingly, the iPhone. That's the tail wagging the entire Apple dog, which wags a big part of the market dog.
Its tail's all the way down.
Pretty much.
Yeah.
It even applies to people, to talent. Think about hiring rates at top companies. Google takes like 0.2% of applicants. Facebook, 0.1%. Apple, maybe 2%.
So getting hired there is like a tail event itself.
In a way, yeah. It suggests that finding those truly impactful employees is also an outlier phenomenon. It's not just about individual brilliance, maybe, but finding the right person in the right system at the right time to have that disproportionate impact.
Okay, this is fascinating. So bringing it back to the listener, what does this mean for you? For how you should behave, say, as an investor?
Well, think about Napoleon's definition of a military genius.
Okay.
He said it's the man who can do the average thing when all those around him are going crazy.
Ha, I like that. Keep your head when others are losing theirs.
Exactly. And it's the same in investing. Most advice is about, today. What's happening right now? What stock should I buy today?
Right, the daily noise.
But over your whole investing life,
Yeah.
those daily decisions, honestly, they probably don't matter that much. What really matters is what you do on those few rare days, maybe 1% of the time, maybe less, when everyone else is panicking.
The moments of terror, as the pilot said.
Precisely. Let's imagine a little experiment based on real history. 3 people, Sue, Jim, and Tom. They each saved just $1 a month, from 1900 all the way to 2019.
Okay, $1 a month. Long time.
Sue takes her dollar and invests it in the U.S. stock market every single month. Doesn't matter if the market's crashing or soaring, rain or shine.
Okay, steady, Sue. What about Jim?
Jim tries to be clever. He invests, but when a recession hits, he sells everything, holds cash. Once the recession's officially over, he buys back in.
Market timing, Jim. And Tom.
Tom is a bit more human. He gets scared during the recession, takes a few months to sell, then even after it ends, he waits a while, needs to feel confident again before he reinvests.
Nervous Tom. Okay, so who wins?
Sue, by a landslide, she ends up with $435,551.50.
Wow, from $1 a month.
Yep.
Yeah.
Jim, he has $257,386. Tom is just behind him at $234,476.
So Sue almost doubled them up just by staying invested.
Pretty much. Recessions happen during about 22% of those months. By just sticking to her plan, keeping her cool during those relatively few crazy periods, she crushed the guys who tried to time it or got scared out.
That really illustrates the Napoleon point. Doing the average thing, just keep investing during the panic is what matters most.
Exactly. Your long-term success isn't about the years of calm cruising. It's about how you handle those brief, terrifying moments of turbulence.
So if we accept this idea that tails drive everything,
Right.
what's the big takeaway for how we view success and failure?
It means we have to accept that failure is, well, normal, expected even. Lots of things should go wrong, break, or just not work out. That's part of the process.
So being wrong half the time as a stock picker isn't terrible.
It might actually be pretty good if your winners are big enough. A business leader might see half their products fail. It's not necessarily bad leadership. It might be smart experimentation in a tail-driven world.
Jeff Bezos seems to get this. He talked about the Fire Phone failure.
Right. He basically said, you think that was big? We're working on much bigger failures right now. He wasn't kidding.
Why? Why aim for bigger failures?
Because he knows that finding the next AWS, the next massive success, requires taking big swings. And big swings sometimes mean big misses. The potential upside from the tail event justifies the risk of failure.
Reed Hastings at Netflix said something similar, didn't he? About their hit rate being too high.
Yeah. He told his team they needed to take more risks, try crazier things, because their cancellation rate should actually be higher. They weren't failing enough to find truly groundbreaking stuff.
So it's not irresponsibility, it's a strategy.
It's a calculated strategy in a world governed by tail events. You have to generate a lot of attempts, a lot of maybes, to find the few definitive yes. We just usually only see the yes at the end.
Like with Chris Rock's comedy specials.
Perfect example. The Chris Rock you see on Netflix. Polished, hilarious. That's the end result, the tail event.
What's the process behind it?
He spends months doing dozens of shows in tiny clubs, trying out jokes, looking at notes, bombing sometimes. He says he does 40 or 50 shows just to get ready.
So the jokes on the special are the survivors.
Exactly. They're the tales that worked, selected from hundreds of attempts that didn't make the cut.
And even Warren Buffett, the investing legend.
Same deal. We all know his net worth, his famous wins like Coca-Cola or Apple. But finding all his investments, including the duds, the bad businesses he bought, that's much harder.
He's had duds.
Oh, yeah. He's admitted it himself. He's owned maybe 400 or 500 different stocks over his career, and he says he made most of his money on just 10 of them.
10 out of 500. Wow.
10. That's the power of tails again.
So what's the final so what for the listener here?
It's realizing that when we only look at the successes of our role models, we miss the vast majority of their actions, the failures, the average attempts, and that makes our own failures feel abnormal, like we're doing something wrong.
But we're not necessarily.
Probably not. You might be wrong just as often as Buffett or Berggruen or Disney were in their processes. The key isn't never being wrong.
It's what George Soros said.
Exactly. It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. You could be wrong half the time and still build a fortune if your wins are big enough.
So wrapping this up, the big idea is tails drive pretty much everything important. Art, movies, investing, careers.
Right. And understanding that means accepting that failure isn't just possible, it's often a necessary part of the path to those few huge, disproportionately important successes.
It's a different way of looking at things. Less pressure to be perfect all the time, maybe?
Maybe more focus on persistence, on trying enough things, and on making sure you can survive the failures so you're still around to benefit from the eventual big win.
Okay, final thought to leave people with.
How about this? There are maybe 100 billion planets just in our galaxy. 100 billion.
Yep.
And as far as we know, only one, this one, has intelligent life capable of pondering this stuff. The fact that you exist, that you're listening to this right now, that's the result of the longest, most improbable tail event imaginable.
That is a big thought. Puts things in perspective.
Doesn't it?
Definitely something to think about. How does understanding this idea of tails change how you look at success and failure in your own life?
Okay, let's unpack this a bit. Do people really need convincing to save money?
It sounds kind of odd, doesn't it? Especially now.
Right. But looking at the material we've got for you today, it seems, well, surprisingly, yeah, a lot of people do. So this deep dive, it's really for two groups we identified from the sources. First, there are those folks who think they can't save. Like, it's just not possible for them.
And the second group?
Maybe even more surprising is the people who think they don't actually need to save.
Ah, okay. So we're challenging both assumptions today.
Exactly. That's the mission. To dig into these ideas and, uncover some deeper truths about building wealth. And here's the main argument, the thing that jumps right out.
What's that?
It's that building wealth, it really has surprisingly little to do with your income or even your investment returns, honestly.
Okay, so if not those, then what?
It's almost everything to do with your savings rate, how much you actually keep.
Right, the gap.
Yeah, exactly. And we're also going to touch on some almost profound benefits of saving that aren't just about buying more stuff, things you can't easily measure.
What's really fascinating, I think, is how the sources just immediately shift your focus, away from the usual things like markets or pay rises.
Yeah, they pivot you inwards.
Right.
Towards what you can actually control.
Exactly. It's a different perspective from the get-go.
And that shift, that's where it gets really interesting. So the first big idea that kind of popped out from the material is the power of efficiency.
Efficiency, okay.
Yes, think back to like the 1970s. There was this widespread panic, a genuine fear that we were running out of oil.
Oh, yeah, I remember reading about that. The projections looked pretty dire.
Totally. Global demand was shooting up, supply looked fixed, and everyone was bracing for like an energy apocalypse.
But, well, obviously that didn't happen. We're still here.
Thankfully, no.
Yeah.
But the research we looked at points out something interesting. It wasn't just about finding huge new oil fields or some magical extraction tech.
So what was the main driver then?
A huge part of it, maybe the biggest, was just getting way more efficient. We learned how to do more with less energy.
Right. Using less to achieve the same or even more.
Precisely. Get this.
Yeah.
The U.S. today uses something like 60% less energy for every dollar of GDP compared to 1950.
Wow, 60%. That's huge.
It is. We're producing way more economic value with much less energy. Or look at cars. Fuel efficiency. The average MPG for all cars on the road, it's basically doubled since '75.
So these aren't just small tweaks, it's a fundamental change.
Exactly. A systemic shift in how we use energy.
And that really connects to this idea of control, doesn't it?
How so?
Well, finding new oil or gas, that's largely out of our individual hands, right? It depends on geology, global politics, markets, stuff we don't directly influence.
Yeah.
But becoming more efficient with the energy we already have access to, that's almost entirely within our control. deciding to buy a more fuel-efficient car or choosing to walk or bike sometimes.
Yeah, those are personal choices.
Yeah.
They have a guaranteed impact on your personal energy efficiency.
So how does this whole efficiency principle map onto personal finance, building wealth?
Well, it's the exact same dynamic, isn't it?
Oh.
Look, investment returns, yeah, they can definitely make you rich, no doubt.
But
But the success of any strategy, how long it lasts, what the market does next year,
mm-hmm.
that's all shrouded in uncertainty. It's largely outside your direct control.
Right, you can't predict the market with certainty.
Exactly.
Yeah.
So what the material emphasizes is that personal savings and frugality, which they basically call the financial version of conservation and efficiency, those are the parts you do control, almost completely.
Okay, I see the parallel now.
Yeah, they have a 100% chance of being just as effective tomorrow as they are today. If you think building wealth needs huge investment wins or a constantly soaring income, you might feel like those energy doomers back in the 70s.
Pessimistic, like it's out of your hands.
Right. Daunting. But frame it differently. If you see wealth building as being powered by your own frugality, your own efficiency.
Then the path looks much clearer, more empowering, maybe.
Absolutely. Because wealth, at its core, it's just what's left over after you spend what you earn. It's the leftovers.
Simple when you put it like that.
And here's a key insight from the sources. You can definitely build wealth without a huge income. It's possible, but you have basically zero chance, like none, of building lasting wealth without a high savings rate.
So that really tells you which factor is more critical, doesn't it?
It really does. The lever you can actually pull.
And there's another layer here too, right? About value. The real value of wealth is always relative to what you actually need.
Explain that a bit more.
Okay, imagine two people, same net worth on paper, but one person has cultivated, let's say, a more efficient life. They need half as much money to be happy compared to the other person whose spending keeps creeping up.
Right, lifestyle inflation.
Exactly. The more efficient person, the one who needs less, they're actually better off, wouldn't you say? Even if their investment returns are lower, their money goes further because their needs are lower.
That makes sense. It applies to income too, then.
For sure. Learning to be genuinely happy with less money, that creates a gap between what you have and what you want or need.
And that gap is kind of the same engine for wealth as just earning more money.
Yeah, but it's often easier to control, easier to achieve for many people, much more in your personal control.
So a high savings rate, it's not just about piling up cash. It means you probably have lower expenses than you could have.
Which means your savings go further, they have more impact.
Think about all the effort, right?
Yeah.
Millions of hours, billions of dollars spent by finance pros trying to eke out maybe an extra fraction of a percent in annual returns.
Yeah, a huge industry focused on that.
Now compare that effort to, say, trimming maybe 2 or 3% of lifestyle bloat. Things people could cut without much real struggle.
It's a stark contrast when you put it like that.
Yeah.
Much easier for an individual to control the spending side.
It's a huge opportunity, really. Look, big returns and big paychecks are great, obviously, if you can get them.
Of course, we're not saying they don't matter.
No, but the fact that so much energy goes into that side of the equation, income and returns, and comparatively little goes into the personal efficiency side, the frugality.
That's where the accessible opportunity lies for most people.
Exactly. And this leads to something surprisingly deep, actually.
Oh.
Past a certain income level, what you need financially, it's often just what sits below your ego's demands.
Whoa. Okay. Unpack that. Ego.
Yeah, the material suggests that spending beyond a certain point, beyond basic comfort and security, a lot of it is just ego. Trying to signal wealth or keep up with the neighbors,
Checking up with the Joneses, basically.
Pretty much. So it makes this powerful point. One of the most effective ways to seriously boost your savings isn't always raising your income. It's raising your humility, learning to need less validation from possessions.
Wow. Okay, so saving isn't just financial, it's psychological. When you frame it as the gap between your ego and your income.
It suddenly makes sense why people with good incomes still struggle to save, right?
Yeah, it's like this constant internal battle, this pressure to flash your feathers, so to speak, match everyone else.
Totally. And the forces often highlight this. People who achieve lasting financial success, they aren't always the highest earners.
What do they have in common then?
They tend to have this knack for genuinely not caring what other people think about their car, their house, their spending choices.
A kind of indifference to external judgment. That's interesting.
So it becomes clear, doesn't it? Your ability to save, it's way more in your control than you might think.
Because you can spend less.
If you desire less.
And you will desire less.
If you care less about what others think. It really boils down to psychology more than spreadsheets, according to this research.
Okay, so that covers the I can't save group. Saving is possible, maybe more possible than people realize by managing desires and ego.
Right. But what about that other group? The ones who feel they don't need to save. Maybe they have a good income, feel secure.
Yeah, why save if you don't have a specific goal in mind?
Well, this is where the sources uncover this sort of incalculable value to saving, something beyond just buying things.
Okay, I'm intrigued.
Here's another powerful idea from the material. You don't actually need a specific reason to save.
Really? So not saving for a house or for retirement or for a car?
Those are fine, obviously, good goals.
Yeah.
But the emphasis here is that you can and should save just for the sake of saving.
Just building a buffer.
Exactly. And the benefits that kind of saving, the sort of goalless saving, they're profound, but often missed.
Why I missed?
Because we usually focus on the tangible things money buys, right?
Yeah.
The house, the car, the vacation.
Sure, the obvious stuff.
But the intangible returns, they're harder to see, harder to quantify, so they get overlooked.
And yet, these intangible benefits.
They can be far more valuable. They can contribute much more to your actual happiness than any specific material purchase.
So what are these intangible benefits then?
Savings without a specific goal, it just gives you options. Flexibility. The ability to wait for the right moment.
The power to say no, maybe?
Yes. And the chance to pounce when real opportunity comes along. Crucially, it buys you time. Time to think, time to change course if you want to.
Ah, changing course on your own terms. That sounds valuable.
It is.
Yeah.
As the sources put it, like really powerfully. Every dollar you save is like reclaiming a piece of your future time that someone else might have controlled. You're giving the control back to yourself.
That flexibility, that control over your own time, that's the unseen return on wealth.
Exactly. That's the core idea.
So this raises a really interesting question the material brings up. What's the actual return on just having cash in the bank? Cash that lets you maybe switch careers or retire a bit early or just sleep better at night without constant money worries.
Right. What's the ROI on peace of mind?
The sources basically say it's incalculable.
Incalculable, meaning what exactly?
Well, two things, really. One, it's so incredibly valuable, so important, we can't really put a number on it. But also, literally, you cannot calculate it like an interest rate.
Because it's not a financial percentage.
Precisely. And things we can't easily measure, we tend to overlook or undervalue.
That makes sense. And this flexibility, this control, it becomes even more valuable in today's world, doesn't it?
How so? In what way?
Well, think about how connected everything is. Hyper-competitive, globalized. If you don't have control of your time, you're often stuck taking whatever life throws at you, good or bad.
Yeah.
Bad luck, limited options.
You're reactive, essentially.
Right. But if you have flexibility, because you saved, you have this amazing luxury, the luxury of time.
Yeah.
You can wait for the really good opportunities, the no-brainers, to come to you.
Whether that's in your job or with investments.
Both. This ability just to wait for the right moment, the right fit, it's a massive hidden return on savings. You really can't overstate it.
And it's a competitive advantage, too. One that's probably getting rarer.
Definitely. Think about it. Maybe a century ago, your main competition was probably local, right? People in your town or region.
Sure, limited pool.
Today, if your job involves working with your brain, teaching, marketing, coding, analysis, whatever, your competition isn't just local.
It's global. Millions, maybe billions of people.
Exactly. So the question becomes, how do I possibly stand out in that crowd?
And just saying I'm smart isn't really enough anymore, is it?
Not even close. There are, nearly 600 people who get perfect SAT scores every single year. Thousands more who are nearly perfect. In this global, often winner-take-all environment, those smart people are competing directly with you. Intelligence alone isn't the edge it used to be.
It's becoming table stakes almost.
You've hit on something really crucial there. In a world where pure intelligence is hyper-competitive and lots of technical skills are getting automated.
The real advantages are shifting.
Yeah, they're tilting more towards those nuanced soft skills. Things like communication, empathy, and maybe, most importantly, flexibility.
Back to flexibility.
If you have that flexibility, that buffer, you have this incredible power to wait for the truly good opportunities. In your career, in your investments.
You have time to adapt.
Exactly. You've got the breathing room to learn new skills when you need to without that feeling of desperation or panic. You feel less pressure to just chase what everyone else is chasing.
You can find your own path, maybe, at your own pace.
Yes, you can find your authentic niche, discover a different routine, maybe a slower pace. You can actually think about life with a different set of possibilities. The ability to do that, when most people are just scrambling, that's a massive differentiator.
That control over your time and your options, it really is becoming one of the most valuable currencies out there. It's more than just money.
For sure. So, okay, wrapping this up, what does all this mean for you listening right now?
Well, we've seen that building wealth, it seems, is way less about chasing some crazy high income or trying to time the market perfectly.
Yeah, it's much, much more about getting a handle on what's genuinely in your power.
Which is,
Your savings rate, your level of frugality,
yeah.
and surprisingly, even your humility, controlling the ego.
And if we look at the bigger picture here, that unseen return of saving we talked about,
That control over time and options.
it's becoming incredibly valuable in this competitive world. It's a real edge, especially when just being smart isn't enough anymore.
So it seems really clear from this deep dive. More people absolutely can save money than think they can. And they really should save money.
Not just for the obvious things like a house deposit.
No, but for this incredibly powerful, often invisible benefit. Flexibility, real control over your own life.
That's the ultimate payoff, perhaps.
It really might be.
Yeah.
You know what else people should do, though, based on some other things we've been looking at?
What's that?
Stop trying to be so perfectly rational with their money all the time. Let me tell you why. Hey, curious minds, welcome back to the deep dive. Today, we're diving into a really interesting idea. It might just change how you look at decisions, especially, when money's involved. We're going to untangle the difference between being rational and being reasonable. Our sources for this deep dive include some truly thought-provoking insights, particularly from a piece that, well, it boldly states you're not a spreadsheet, but actually a screwed-up emotional person. Which is honestly a pretty refreshing take. It gets right to the heart of making choices we can actually stick with.
Yeah, and that's really our mission today. To unpack why aiming for reasonable might actually be, well, a far more effective strategy than just chasing pure cold rationality. We'll explore how this distinction plays out in some really surprising ways. Things like Nobel Prize winning medical breakthroughs, right through to the everyday details of your personal finances. What's really fascinating here is just how much common wisdom gets sort of turned on its head when we look beyond the purely logical.
Okay, let's unpack this. And to really get it, we need to start with a story. It sounds almost unbelievable, actually, a medical history lesson.
Yeah.
Let's talk about Julius Wagner Jauregg. He was a 19th century psychiatrist. Now, this guy, he had this incredible knack for seeing patterns where others just saw chaos. What seemed crazy to some, he saw as bold. His specialty was severe neurosyphilis, which back then was basically a fatal diagnosis, no known cure. But he started noticing something odd. Patients with syphilis sometimes recovered if they also got really high, prolonged fevers from something else, like an unrelated infection. He had this hunch, an idea that had been, floating around for centuries, that fevers somehow help the body fight infection.
Right. So that raised a big question for him. Could fever actually be a treatment? So
No.
in the early 1900s, he took this incredibly bold leap. I mean, really bold. He started injecting patients with low-end strains of typhoid, malaria, even smallpox.
Smallpox, wow.
To deliberately trigger strong fevers. Some of them lasted for days.
Days of intense fever. That sounds honestly terrifying. What happened? Did it work?
Well, after some truly tragic trial and error, it actually did work. Wagner Jauregg reported that 6 out of 10 syphilis patients treated with this malariotherapy, as he called it, recovered. Compare that to maybe 3 in 10 who were just left untreated.
Huge difference.
Massive. He won the Nobel Prize in Medicine in 1927 for his endeavor to cure mental disease by inducing a fever. Now, thankfully, penicillin came along and made this treatment obsolete. But he really stands out, one of the only doctors to not only see fever's role, but to actually prescribe it.
Okay, but here's the really mind-blowing part, especially when you think about how you react to fevers today. Like, grab the Tylenol immediately, right? Our sources say modern science actually backs up his seemingly crazy idea. What have we learned since then?
Yeah, it's fascinating. It turns out fevers aren't just, annoying side effects. They genuinely play a crucial role in recovery. We have solid evidence now, just a 1-degree increase in body temperature that can slow the replication rate of some viruses by a factor of 200.
200, wow.
Right. And an NIH paper notes, quote, numerous investigators have identified a better outcome among patients who displayed fever. Even places like Seattle Children's Hospital tell parents, fevers turn on the body's immune system. They help the body fight infection. Normal fevers are good for sick children.
So, okay, millions of years of evolution gave us fever as this like built-in defense. Why is it then that most people, parents, patients, even doctors, drug companies, still treat fever like the enemy, something to be stamped out immediately?
It's a great question, and it really gets to the heart of this rational versus reasonable thing. One study put it pretty bluntly. Treatment of fever is common and likely related to standard dogma rather than evidence-based practice. Howard Markle, who directs the Center for the History of Medicine, he called it fever phobia. He suggested it's more about cultural practices spreading like diseases themselves.
Huh. Culture over biology.
Essentially, yeah. Because the core reason is incredibly simple. Fevers feel awful. They hurt. And people don't want to hurt. So while it might be rational technically to want a fever if you have an infection because of the benefits, it's just not reasonable when you're shivering, miserable, and just want the pain to stop.
You just want relief.
Exactly. A doctor's goal in the real world isn't just curing the disease in a vacuum. It's curing it within what's tolerable for the actual person experiencing it. Offer someone a pill to stop the misery. That's the reasonable choice for most people.
That's such a clear example. This fever phobia really highlights that tension. It makes you wonder, where else does this conflict pop up, this rational versus reasonable? And our sources really dig into this, especially when it comes to, well, money.
Exactly. That's the big connection. This whole philosophy aiming for reasonable instead of strictly rational is something our sources argue more people should think about with their finances. You know, academic finance often gets obsessed with finding the mathematically perfect investment strategy, the optimal one on paper.
Right, the spreadsheet answer.
The spreadsheet answer, precisely. But in the real world, people don't just want optimal. They want strategies they can actually live with, stick with for the long haul. And that's where reasonable often wins out.
Okay, let's connect this to a big name in finance. Harry Markowitz, Nobel laureate, pioneered modern portfolio theory. Developed all these complex mathematical models back in the 50s. So you'd expect his own money was in some super complex optimized thing, right? What did he actually do?
You'd think so. But no, Markowitz's own portfolio allocation, it was a surprisingly simple 50-50 split, half bonds, half equities.
50-50. After developing portfolio theory. Why?
His reasoning wasn't based on some complex calculation. He actually said he visualized his grief. His grief if the stock market soared and he missed out, or if it crashed and he was all in.
Wow.
His goal, in his words, was to minimize his future regret.
Minimizing regret. That's fascinating. It's an emotion, not a number. What do our sources say about why that approach, even if it's not mathematically perfect, is so powerful for real people?
It's powerful because, well, minimizing future regret is really hard to quantify on a spreadsheet, isn't it? But it's incredibly easy to justify in your own life. A purely rational investor looks only at the numbers, the facts. But a reasonable investor, they factor in the human stuff, the social side. Making decisions in a room with colleagues you want to impress, or maybe with a spouse you don't want to disappoint, or even competing against, your brother-in-law, or just your own nagging doubts. Those things are real, even if they aren't on the spreadsheet.
Yeah, those factors matter.
Right. As Jason Zweig put it, reflecting on Markowitz, people are neither rational nor irrational. We are human. We don't like thinking harder than we have to. Our attention is pulled everywhere. Markowitz wasn't being irrational by choosing 50-50. He was just being reasonable.
Okay, here's another example that really hammers this home. In 2008, Yale researchers published this study. They suggested young savers should supercharge their retirement accounts. How? By using 2-to-1 margin. So basically, borrowing $2 for every $1 of your own money to buy stocks. Then gradually reduce that debt as you get older.
And the math on paper looked amazing. The study showed that even if you got totally wiped out, like a 50% market crash would zero you out with 2.1 leverage, you'd still be better off long term. As long as, and this is the key part, you just picked yourself up, dusted yourself off, and started saving that same leveraged account the very next day.
The next day, after losing everything.
Exactly. The expected retirement wealth was calculated to be 90% higher this way. Purely rational, mathematically sound.
Okay, but my gut is screaming, no way. Is that reasonable? Could anyone actually do that?
You nailed it. The answer is it's almost absurdly unreasonable. Think about it. Can you imagine any normal person watching their entire retirement savings evaporate overnight and then just calmly saying, okay, time to start leveraging up again tomorrow? Absolutely not. They'd quit. They'd find a different strategy. They'd probably sue whoever told them to do it.
Right.
So the strategy might promise 90% higher expected wealth on paper, but it's, maybe 100% less reasonable for an actual human being. And this highlights something really crucial. There's actually a rational reason to prefer choices that look irrational on the surface. especially when it comes to commitment. Because few things matter more in finance than just sticking with your strategy, especially when it's going through a rough patch.
That stick-to-itiveness, yeah, that endurance. Why is that commitment, especially during those lean years, so incredibly vital?
Because history shows the odds are just overwhelmingly stacked in your favor if you can stay in the game long enough. Look at the historical odds for US markets. Making money over one day, basically 50-50, a coin toss, over 1 year, it jumps to about 68% over 10 years, about 88%.
And long.
And over any 20-year period, so far at least, it's been 100%. So anything that helps you stay invested, helps you ride out those inevitable downturns, gives you a quantifiable edge.
Okay, so how does this translate for you, the listener? What does it mean for your choices? Take that common advice. Do what you love.
It sounds a bit, well, like empty fortune cookie wisdom, right? But if you reframe it, if you see it as the thing providing the endurance you need to let those long-term odds work for you, suddenly it becomes maybe the most important part of a financial strategy.
Think about it this way. Say you invest in some company. It looks promising on paper, but you don't really care about it. When things are going well, fine, no problem. But when the market turns, as it always does eventually, and you're losing money on something you have no connection to, it feels like a double burden.
Yeah, it's just pain. Exactly. And the easiest path, the path of least resistance, is just to sell it and move on, cut your losses. But if you're passionate about that company, you love the mission or the product or the team or the science behind it, then the downtimes, which are still going to happen, feel different. They're blunted because you feel like you're part of something meaningful.
It gives you a reason to hang on.
Precisely. That can be the motivation you need to not give up, to stay invested, and let time work its magic.
That human connection providing the staying power, it makes sense. Where else do we see this reasonable over rational idea play out in finance?
Oh, there are several other examples where being reasonable, maybe not strictly rational, is perfectly fine. More human, really, like home bias. People tend to invest more in companies from their own country. Rationally, from a pure diversification view, that doesn't make sense.
Right, you should spread it out globally.
You should. But it becomes reasonable when you think of investing as sort of rooting for your home team. It feels comfortable, familiar. Or look at day trading or picking individual stocks. For most people, rationally, it's a losing game. The odds are stacked against you beating the market.
Definitely.
But doing it with a small amount of money, it can be reasonable if it scratches an itch. If it satisfies that urge strongly enough that you leave the rest of your serious diversified money alone. Investor Josh Brown put it perfectly about his own stock picks. He said something like, I'm not doing this because I think I'll generate alpha, outperform the market. I just love stocks. And it's my money. I get to do whatever.
Huh. That's pretty reasonable.
Totally reasonable. Even making forecasts. Most economic and market forecasts are, frankly, terrible.
Yeah, notoriously inaccurate.
But making them is still reasonable. It's hardwired into us. It's really difficult to wake up every day and truly accept you have no clue what the future holds, even though that's basically true. Now, acting heavily on those forecasts is dangerous. But the act of forecasting itself, it's human nature.
And there's one final anecdote that just perfectly ties this all together. It's about Jack Bogle, the legendary founder of Vanguard, the guy who spent his entire career championing low-cost, passive index investing, fighting against high fees. What's fascinating, maybe even a bit shocking, is that Bogle himself, the man who said high-fee funds violate the humble rules of arithmetic, he actually invested some of his own money in his son's active high-fee hedge fund.
Yeah. And his explanation to the Wall Street Journal, it pretty much sums up this whole deep dive. He just said, we do some things for family reasons. If it's not consistent, well, life isn't always consistent.
Wow. Life isn't always consistent.
Exactly. Even the ultimate champion of rational, low-cost investing understood that sometimes being reasonable, being human, comes first.
So wrapping this up, what does this all mean for you? Our deep dive today really shows that true success, whether we're talking health or wealth, often comes not from just rigidly sticking to mathematical perfection,
Right.
but from understanding and, embracing our own human nature.
Being reasonable really means crafting strategies you can actually stick with through thick and thin, because they account for your emotions, your relationships, your tolerance for discomfort, your need for meaning. It's about designing a financial plan, maybe even a life plan that you can actually live with day in and day out.
Because you're not a spreadsheet. You're a person. A wonderfully complex, sometimes irrational, hopefully reasonable person. And acknowledging that emotional reality, that might just be the most important part of making decisions that truly serve you in the long run. So maybe next time you're facing a big decision, health, money, career, whatever, ask yourself, okay, what's the purely rational choice here? And then ask, but what's the most reasonable choice for me right now in my actual life? What's a rational choice you've maybe avoided because it just didn't feel reasonable for you? Something to think about. We hope this deep dive gave you some powerful new insights to chew on. Until next time, keep learning, keep questioning, and stay curious. Welcome to the deep dive. Today, we're really getting into something fascinating. The psychology behind, why we chase wealth, why we want those material things.
And it's based on some really thought-provoking material you shared. And right off the bat, there's this core idea that just jumps out.
The man in the car paradox. That's what they call it, right? It's such a neat way to frame it.
Exactly. And the way they explain it, well, it starts with this story about a valet, someone who spent his days parking the absolute best cars, Ferraris, Lamborghinis.
Rolls Royces, the whole lot. And his dream, like his big ambition, was to own one himself.
Right, because he thought driving a car like that sends a message.
Yeah, like I'm smart, I'm rich, look at me, I've made it, that kind of thing.
But then comes the twist, the paradox. He had this realization.
Well, what was it?
Well, he realized that when he saw someone driving one of those amazing cars, he almost never actually thought, wow, that driver is cool.
So what did he think?
His thought, almost subconsciously, was more like, wow, if I had that car, then people would think I'm cool. You see the difference.
Okay. So it's not about admiring the person who has the thing.
Not really, no. It immediately becomes a benchmark for your own desire for admiration. It reflects back onto you.
That's a really subtle, but wow, kind of a huge misdirection we fall into, isn't it?
Yeah.
We buy the thing thinking it signals our status.
But other people just see the thing and use it as fuel for their own desire to be admired. They sort of bypass admiring the owner altogether.
So the admiration we think we're buying, it just doesn't land the way we expect.
That's the core of the paradox, yeah.
Flat out.
And it's important to stress this isn't just about fancy cars.
Right. The source has made that clear. It applies to, well, big houses, expensive jewelry, designer clothes.
Any visible status symbol, really.
Yeah.
The suggestion is that these things often fail to deliver the respect and admiration we're actually seeking from others.
It might even just generate envy, which feels very different from respect.
Exactly. It's a whole different emotional response.
Okay, so if chasing these symbols for admiration is, well, kind of a flawed strategy, what's the alternative? Where does that leave us?
Well, the material you shared gets quite profound here. It talks about a letter written by the author to his son.
Oh, yeah, I remember that part. It was very direct advice, wasn't it?
Extremely. He basically said, look, you might think you want the expensive car, the fancy watch, the huge house.
But he says you don't. Not really.
What you actually want, the letter goes on, is respect and admiration from other people.
And here's the key part. And you think having expensive stuff will bring it.
It almost never does, that's the kicker. Especially, he adds, from the people you want to respect and admire you.
Wow, that hits hard. So it's not saying don't pursue wealth or don't enjoy nice things.
No, not at all. The source is clear. The author likes nice things too. It's about understanding the real goal.
The real goal being respect and admiration.
Yes. And recognizing that using money purely to buy status symbols is, well, a pretty inefficient way to get genuine respect, especially from people whose opinions truly matter.
So what does work then? What's the path the source suggests?
It shifts the focus entirely, away from possessions, towards character.
Towards how you treat people.
Precisely. The source argues, quite powerfully, I think, that things like humility, kindness, empathy, those are the things that earn you far more genuine, lasting respect.
Much more than horsepower or square footage ever could. It makes intuitive sense when you put it like that.
Doesn't it? You think about the people you truly admire. Is it usually because of what they own or because of who they are, their character, their actions?
It's almost always the latter, yeah.
Yeah.
Kindness, integrity, empathy. Those resonate much deeper.
So the real takeaway here, the thing maybe for you listening to consider is this.
What if you shifted just some of that energy away from accumulating more stuff?
And towards actively cultivating those virtues, kindness, humility, empathy. How might that change how people see you?
How might that genuinely earn you the respect and admiration you're probably seeking underneath it all? Something to think about. We often talk about chasing wealth. We picture maybe big bank balances, fancy houses. But what if? What if true wealth is something else entirely? Something you can't quite put on a balance sheet, but feels much more important.
That's exactly where we're headed today, exploring this really powerful idea that maybe the ultimate luxury money buys isn't, a thing at all.
Okay.
It's freedom, specifically having control over your own time, that incredibly precious, non-renewable asset we all have.
So today we're diving deep into the psychology connecting happiness, money, and this idea of personal autonomy. We're pulling insights from our source material, which is excerpts from Psychology, CHB7.pdf.
Yeah, and our mission here is really to boil down the most crucial takeaways from these pages for you, to help understand how money, especially when you look at it through this lens of controlling your time, can actually build towards a genuinely well-lived life. It's kind of a shortcut to being really informed on this connection.
Okay, so let's start right there then. Unpack this core idea. The source, it kicks off with a really striking definition of freedom. It says, the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today.
Hmm.
That really shifts things, doesn't it? It's not just about having cash, it's redefining wealth.
It totally does because, we usually think wealth equals possessions, right? The bigger house, the faster car, but this flips it.
Right.
It's not about what you have, but the freedom to decide how you use your time, your most valuable resource, really. And the source hammers this home. It says, the ability to do what you want, when you want, with who you want, for as long as you want is priceless.
Priceless.
Yeah, it is the highest dividend money pays.
Yeah.
That's a powerful statement.
It really is. And, for a long time, figuring out what actually made people happy was, well, a bit fuzzy for researchers.
Mm-hmm.
Until a psychologist named Angus Campbell started asking different kinds of questions back in the 80s.
Campbell, University of Michigan.
That's him. His 1981 book, The Sense of Well-Being in America, it was a real departure because back then psychology was mostly looking at, problems.
Yeah.
Depression, anxiety, that sort of thing.
Right. Disorders.
But Campbell, he wanted to understand what made people genuinely happy.
Exactly. And what he found was pretty fascinating, actually. First off, people were generally happier than a lot of folks assumed. But the kicker was he couldn't just group the happiest people by the usual things: income, where they lived, education level.
So it wasn't like, oh, rich people are happiest.
Not necessarily. I mean, sure, some were, but plenty of people with high incomes or fancy degrees were, frankly, miserable, and vice versa.
Okay.
So Campbell dug deeper. And his conclusion was really profound. He stated, and this is a quote worth remembering, having a strong sense of controlling one's life is a more dependable predictor of positive feelings of well-being than any of the objective conditions of life we have considered.
Wow. More dependable than income or education.
More dependable than any of the objective conditions. Think about that. It means it's not primarily your external situation, how much money you make, the house you live in, but your internal feeling, that sense of autonomy, of being in the driver's seat of your own life. That's what truly predicts well-being. It's a real game changer in how we think about happiness.
Okay, so if Campbell nailed it down to this sense of control being the key predictor, what does that tell us about money itself? How does money fit into getting that control?
Well, that's the crucial link, isn't it? And our source is very clear on this. Money's greatest intrinsic value, and this is really the core idea, is its power to give you control over your time.
How so?
It lets you build up, maybe slowly, bit by bit, a level of independence, autonomy. And this comes from having unspent assets, as the source calls them. Think savings, investments, just having enough buffer so you're not living paycheck to paycheck, essentially.
Right, having some breathing room.
And exactly. Breathing room gives you power. Power over what you do and when you do it. The source gives some really concrete examples that make this clear.
Okay, like what?
Well, imagine being able to take a few sick days without worrying about losing income. That's huge for some people.
Yeah, definitely.
Or, say you get laid off. Having enough saved means you can wait for a good job, the right fit, instead of just grabbing the first thing that comes along out of desperation.
That's a big one.
Or having maybe 6 months of emergency expenses tucked away. Suddenly, a bad boss isn't quite so terrifying, is it? Because you know you're not trapped, you have options.
Mm-hmm.
It's also the freedom to maybe take a job that pays less but offers more flexibility. Shorter commute, better hours, things that improve your actual daily life.
Things luxury goods can't really buy.
Precisely. Or dealing with a medical emergency without the added nightmare of financial stress compounding everything. And the ultimate example, perhaps. Retiring when you choose to, not just when you absolutely have to stop working.
That really paints a picture. It makes so much sense. Using your money to buy back your time, to create options. Yeah, that's a lifestyle benefit that, like you said, very few fancy things can actually compete with. And the source shares this really vivid personal story about the trap of time poverty. It's about someone who, all through college, was convinced investment banking was the path. Why? The money, pure and simple.
Ah, the classic lure.
Right. So they land this summer internship, first day. Reality hits hard. The job was, and I'm quoting here, intellectually stimulating, paid well, and made me feel important. Sounds good so far.
Okay, but
But every waking second of my time became a slave to my boss's demands. Every second. There was even this saying in the office, if you don't come to work on Saturday, don't bother coming back on Sunday.
wow. That's intense.
Yeah, it was supposed to be a 4-month internship. They lasted 1 month. Just walked away.
That story is such a perfect illustration of this psychological idea called reactance. Jonah Berger, he's a marketing professor, explains it really well.
Yeah, it's reactive.
Basically, people like to feel like they're in control in the driver's seat. When you try to force them to do something, even something they might have otherwise wanted to do, they feel like their power is being taken away.
So they push back.
Exactly. They feel disempowered, so they say no, or they do something else entirely just to reassert their autonomy. It's that gut reaction against feeling controlled.
That really drives home how vital that feeling of control is. Because, like the source says, doing something you love on a schedule you can't control can feel the same as doing something you hate.
That's such a crucial point.
So this whole idea of using money strategically, not just for stuff, but to buy back your time, to shape a life where you have that control,
Yeah,
it just offers this incredible return, doesn't it?
absolutely.
It reminds me of that Derek Sivers anecdote the source mentions, the entrepreneur. He told a friend he actually got rich way before he sold his company for
Oh, right, when he was young.
Yeah, at 22. He had this day job paying like $20,000 a year, but his living expenses were super low, only about $1,000 a month. He was earning $1,800 a month.
So he had a surplus.
A decent surplus, and he realized, hey, I can cover my costs easily with just a bit of freelance work. He felt totally free. Quit the day job a month later, never had a traditional job again, the big company sale later. He said that was just more money in the bank. The real feeling of freedom, of being rich, happened years earlier when he gained control over his time.
That's a fantastic example of this principle in action.
And this leads us straight into a really striking paradox that the material points out. Think about it. The United States is, by many measures, the richest nation in history. Wealth and income are much higher than, say, the 1950s, even adjusted for inflation.
Right, objectively wealthier.
Yet. There's little evidence that its citizens are, on average, happier today than they were back then. How can that be?
Yeah, the data backs that up pretty starkly. There was a big Gallup poll in 2019, 150,000 people, 140 countries. It found about 45% of Americans said they felt a lot of worry the day before, the global average. 39%.
Worry is higher. What about stress?
Stress, too. 55% of Americans felt a lot of stress. The global average was 35%. So, richer nation, but seemingly more worried and stressed.
So what's the explanation? Why aren't we happier if we're richer?
Well, the source offers a really compelling argument. It suggests that, by and large, we've used that increased wealth to buy, well, bigger and better stuff.
Material thing.
Exactly. The median American home, for instance. It went from about 983 square feet in 1950 to over 2,400 square feet by 2018.
Wow, more than doubled.
Yeah. More bathrooms than people living there, often faster cars, sharper TVs, you name it. And this is the crucial part, the source argues we've simultaneously given up more control over our time.
Ah, so the gains from stuff are canceled out by the loss of time control.
That seems to be the idea. At best, they cancel each other out. Even though median family income adjusted for inflation jumped significantly, like from roughly $29,000 in 1955 to over $62,000 in 2019, we just aren't seeing that translate into higher average happiness levels. So the trade-off hasn't paid off in terms of well-being.
And a huge factor in this loss of time control seems to be how work itself has changed. The source brings up John D. Rockefeller, interestingly.
The oil tycoon, how does he fit in?
Well, his approach to work was apparently quite unique for his time. He wasn't about busy work or physical labor. He was often quiet, observing, just thinking, making decisions. That was his real work.
Strategic thinking.
Right. He even used to recite this little poem. A wise old owl lived in an oak. The more he saw, the less he spoke. The less he spoke, the more he heard. Why aren't we all like that wise old bird? He got that his main output wasn't something he did with his hands, but what happened in his head.
That's fascinating, and definitely different from most work back then. In 1870, think about it, most jobs were manual, like 46% in agriculture, 35% in crafts or manufacturing.
Tangible work.
Very tangible. You could see the output. And crucially, when you clocked out, you clocked out. You left the work there. But today, it's completely flipped.
How so?
Well, now something like 38% of jobs are classified as managers, officials, and proprietors. These are overwhelmingly thought-based jobs. Your primary tool, as the source puts it, is your head, which never leaves you.
So the work follows you home.
Exactly. It feels like it never really ends.
Oh, I definitely feel that. I think a lot of us do. You're thinking about work stuff on your commute, right? Or while you're making dinner, putting the kids to bed. Maybe you even wake up at 3 a.m. stressing about a deadline or an email. So even if you're technically on the clock for fewer hours than someone might have been in 1950, it feels like you're working constantly because your brain is always engaged with it.
Derek Thompson from The Atlantic put it brilliantly. He said something like, if the operating equipment of the 21st century is a portable device, this means the modern factory is not a place at all. It is the day itself.
Wow. The day itself is the factory.
Think about it. Laptops, smartphones, they free our tools from the office, right? Which sounds great, but it also means we can theoretically be productive anywhere, anytime, which often translates to feeling like we should be productive anywhere, anytime.
So comparing ourselves to earlier generations, our actual control over our time, our mental space, it's arguably lessened.
It seems that way. And if Campbell was right, and that sense of control is paramount for well-being, well, it starts to make sense why we aren't necessarily happier despite being richer. We've traded some control for other things.
This leads us really nicely into some powerful wisdom that comes from looking back over a whole lifetime. The source mentions the work of Carl Pilmer, a gerontologist.
Yes. His book, 30 Lessons for Living. Fascinating stuff.
He interviewed 1,000 elderly Americans, right?
Yeah.
Asking them about the most important lessons they learned over their long lives.
That's right. 1,000 people who'd seen it all. And what's really striking is what they didn't say.
Okay, what did they say?
Well, Pilmer emphasizes this. Not one single person out of that 1,000 said that the key to happiness was working as hard as you possibly can just to make money to buy more things.
Nobody said that.
Nobody. Nor did anyone say it was important to, keep up with the Joneses, be as wealthy as your neighbors, or that having more stuff equals success.
Interesting. What else?
And critically, no one advised choosing your career based purely on how much money you might earn down the line. That wasn't the advice they gave for a fulfilling life.
So what did they value, looking back?
It was much more about human connection and time. Things like quality friendships, being part of something bigger than just themselves, like community or purpose.
Yeah.
And spending quality, unstructured time with their children.
Time with kids.
Yeah, Pilmer quotes them directly on this. They said things like, your kids don't want your money or what your money buys anywhere near as much as they want you. Specifically, they want you with them. Just your presence, your time.
Wow. That's pretty profound advice, coming from people who have lived through it all.
It really is.
So if you take it from them, from those who've seen the whole picture, controlling your time really is the highest dividend money pays. So wrapping this deep dive up, it feels like we've landed on a really clear central insight, doesn't it? Money's most valuable role might not be acquiring possessions, but actually buying freedom, buying control over your own time.
Yeah, it reframes it as the ultimate lifestyle upgrade, in a way. Not the fancy car, but the ability to choose how you spend your hours.
Which definitely encourages some reflection, I think, for you listening.
Exactly. If you connect this back to the bigger picture of your own life, how might rethinking that relationship between money and time actually change things day to day? Or even your long-term happiness? It's worth considering.
And maybe one final thought to leave you with, building on that idea of the highest dividend money pays. What about the lowest dividends? As you think about gaining control, maybe also ask yourself, what are you currently spending money on that isn't giving you back time or freedom? What might actually be costing you peace of mind rather than enhancing it? That's definitely something interesting for you to explore on your own.
Welcome to the Deep Dive. Today, we're thinking about something I reckon we all do. Setting these big goals for the future. Maybe it's a dream job or a certain lifestyle, financial security. We make these huge plans for who we think we'll be. But here's the thing I've been wondering about. How well do we actually know that future person? The one we're planning for? And what happens when, the you of tomorrow isn't really thrilled with the plans the you of today made? It's a really common challenge, and yeah, it has some pretty big implications. This deep dive is based on some fascinating stuff from our source, CHOCH.pdf. It's actually a chapter from a psychology text looking into how we change over time,
often in ways we don't expect. So our mission today is to kind of unpack why we often misjudge what we'll want later and, what that does to our big decisions, especially money decisions,
Yeah.
and maybe find some practical ways to handle this human tendency to keep evolving.
Okay, yeah, let's dive in. There's a really powerful story in the source material we should start with. It talks about a friend of the author's who decided, like as a teenager, he had to become a doctor against pretty huge odds. Apparently, he wasn't, a natural academic whiz for it, but just incredibly hardworking, probably the hardest worker the author knew. And even though everyone thought, no way, he just pushed and pushed.
And he did it, a decade older than his peers, but he became a doctor. You'd think, okay, that's the dream achieved, right? I mean, starting from basically nothing, fighting his way through med school, getting into this really noble profession, sounds like the perfect ending. But here's the kicker. A few years back, the author bumps into him, asks how he's doing, and the friend just cuts him off. Flat out says, awful career, man.
Mm.
Awful career. And apparently he went on about it for 10 minutes, said the stress, the hours, they just ground him down. He ended up feeling as disappointed, really, as he was once determined. It just shows how different imagining a goal is from actually living it, day in, day out, with all the real-life pressures.
Wow. Yeah, that really hits home. To put in all that effort and then regret it so deeply. What does that say about how we picture the future versus, the lived reality? Is it just bad imagination or is it something more fundamental about us?
That's a great question, and it connects to so many things, right? Like childhood dreams. Think about the 5-year-old wanting to drive a tractor. The source puts it perfectly. Few jobs look better to a young boy whose idea of a good job starts and ends with vroom, vroom, beep, beep, big tractor, here I come.
Hmm.
But then, obviously, they grow up.
Exactly. Driving a tractor maybe isn't the lifelong dream after all. So maybe, as a teenager, the dream becomes being a lawyer. Okay, this is it, law school, set for life. But then they get there and the hours are brutal. They barely see their family, so they pivot. Maybe a lower paying job, but more flexibility. Then they realize childcare costs eat up most of that smaller paycheck. So maybe being a stay-at-home parent is the answer. This feels right. And then suddenly they're 70, looking back, and realize staying home meant they aren't really prepared for retirement. It's this whole winding path.
It is. And so many of us are on a similar kind of path, even if the details differ. And what's really interesting is how these stories tie into a basic psychological finding. People are just not very good at forecasting who they'll be in the future. And there's a data for this. It's not just stories. The Federal Reserve, for example, found only about 27% of college grads end up in a job related to their major.
Gosh, 27%. Wow.
Yeah. And get this, 29% of stay-at-home parents actually have a college degree. It suggests, life goals change way beyond what you thought at 18. That 18-year-old picking a major just can't imagine how different their priorities might be as, say, a new parent in their 30s.
So it's more than just like tastes changing. It's a fundamental gap in understanding what that future reality will actually feel like. Is there a psychological reason for that blindness?
Yeah, there is. This brings us to Harvard psychologist Daniel Gilbert. He talks about something called the end of history illusion.
Yeah.
It's this really strong feeling we tend to have that our personal evolution is basically just finished. Like, okay, this is me now. This is the person I was always meant to be, and this is who I'll be forever. It's an illusion, but it feels very real.
Gilbert himself said it really well, didn't he? Something like, at every stage of our lives, we make decisions that will profoundly influence the lives of the people we're going to become. And then when we become those people, we're not always thrilled with the decisions we made. That's pretty direct. And you see this playing out all the time, like the source points out. Think about young people paying good money to get tattoos removed that, teenagers pay good money to get. Or middle-aged folks rushing to divorce people that young adults rush to marry. And older adults working hard to lose the weight that middle-aged adults worked hard to gain. It's this constant cycle.
It really is compelling when you lay it out like that. And Gilbert's research actually shows this quantitatively. People from 18 right up to 68 consistently underestimate how much they'll change in the next 10 years.
Yeah.
We genuinely seem to believe our personal history just wrapped up.
Huh. Okay, that's a big idea to absorb. It definitely makes you second guess those big long-term plans. So what does this mean for something really concrete, like long-term financial planning? Charlie Munger always said the first rule of compounding that magic of growth over time is you never interrupt it unnecessarily.
Right. That's the core challenge here, isn't it? How can you avoid interrupting a financial plan, which touches your career, your investments, spending, budgeting, everything, when the person you are, what you want out of life, fundamentally shifts. It's incredibly tough. It's part of why people like Ronald Reed, the janitor who died wealthy, or Warren Buffett are such outliers. They managed to essentially do the same thing, stick to the same path for decades. That let compounding go nuts. But for most of us, we change too much. We either don't want to keep doing the same thing, or maybe life just makes it impossible.
And this source mentions those two extremes in lifestyle choices too. On one hand, you have young people living super simply, maybe very low income, but they seem perfectly happy. On the other, you have people working crazy hours, aiming for luxury, and finding satisfaction in that grind. But given this end of history illusion, are there hidden dangers in locking yourself into either of those extremes?
Oh, absolutely. Look, there's no silver bullet here, no easy answer. But the source suggests two really important things to keep front of mind when you're making these big, supposedly long-term decisions. First, try really hard to avoid the extreme ends of financial life planning. So assuming you'll be happy forever living on very little, or committing to endless work for a huge income. Both paths raise the odds you'll regret it later. Why? Because we adapt. That's the thing about the end of history illusion. The initial thrill of having everything, or maybe the simple romance of having very little, it tends to fade. But the downsides, lack of security or lack of time in relationships, those can stick around as lasting regrets, especially if you then feel like you have to, sprint in the opposite direction later to compensate.
So it's kind of like building in some wiggle room, some resilience. The source really pushes moderation as the key to endurance, doesn't it? Talks about a more moderate path, like moderate savings rate, moderate free time, trying not to have more than a moderate commute, making sure you have at least moderate time with family. That kind of balance makes it much more likely you can actually stick with a plan long enough for it to work and hopefully avoid major regrets. It's about sustainability.
Exactly. Balance for the long haul. And the second big point is maybe even simpler, but harder to do.
Right.
We need to accept that changing our minds is okay. It's normal. It's human. Think about how miserable some people are staying in careers only because that's the major they picked when they were 18. I mean, seriously, what are the odds that the job you pick before you can legally drink is still going to be the perfect fit when you're thinking about Social Security? They're pretty low, right? Almost zero.
That makes total sense. It reminds me of that story about Jason Zweig, the Wall Street Journal columnist, when he was working with Daniel Kahneman on Thinking Fast and Slow. Zweig said Kahneman had this incredible knack for just detonating what they'd written. They'd slave over a chapter, get it just right, and then Kahneman would send back a version that was completely different, totally transformed, unrecognizable.
Right. And Zweig asked him basically, how can you just throw away all that work and start over?
Yeah.
And Kahneman said something Zweig never forgot. He said, essentially, sunk costs, anchoring your choices to past efforts you can't get back, are a devil in a world where people change over time.
Mm-hmm.
Holding on to past decisions just because you spent time or money on them makes it way harder to make good choices for the future you.
And that really brings it back to you, the listener. Embracing this idea that goals you made when you were literally a different person might need to be, well, abandoned without mercy. Rather than keeping them on life support and dragging them along, that could actually be a really smart way to minimize future regret. It frees you up to pivot, doesn't it? To get back to building wealth or just building a life that fits who you are now. So, if there's one core takeaway for you today, it's probably this. You're not fixed. You're not a statue. Your wants, your goals, even your personality, they're going to keep evolving all through your life. And as this deep dive shows, the you of the past is often a pretty poor guide to what the you of the future will actually need or desire.
Absolutely. Which is why those two strategies are worth remembering. First, aim for moderation in your plans. It builds endurance, helps you avoid those painful regrets from going to extreme. And second, just accept that change happens. Let go of those sunk costs. Don't let decisions made by a past version of you trap the current you.
And maybe here's a final thought to chew on. The faster you can accept that you will change and be willing to adjust course when needed, well, maybe the sooner you can get back on track building the kind of wealth and the kind of life that truly aligns with who you are right now and also who you're still becoming.
When the dot-com bubble burst back in the early 2000s, it wiped out something like $6.2 trillion in household wealth. Just vanished.
Astounding numbers.
And then, just a few years on, the housing bubble collapsing took out over $8 trillion more.
It's almost hard to comprehend the scale.
It really is.
Yeah.
And it's not just numbers on a page, is it? These aren't just market corrections. They genuinely ruin people's lives.
Absolutely devastating, socially and personally.
So it just brings up these massive questions. Why?
Yeah.
Why does this keep happening again and again? Why can't we seem to, I don't know, Learn. Why don't we learn the lesson?
Yeah, that's the $1 million question, or maybe the $1 trillion one. The easy answer people grab is just greed. Everyone's greedy.
Right, that's what you always hear.
But it's frankly too simple. We often find this, right? People make choices that, yeah, they regret later, often with bad information, or maybe logic wasn't front and center.
Mm-hmm.
But the key thing is, those choices made sense to them in that moment. So just blaming greed makes us miss the real lessons about how people rationalize things that look greedy later on. Bubbles aren't like a clear medical diagnosis.
Oh, simple test result.
Exactly. It's
Yeah.
more like the rise and fall of a political movement or something. You know the outcome, but ask 10 people why it happened and you'll get 10 different answers. The causes are never fully agreed on.
That's a really helpful way to think about it. So less of a moral failing, more about rational choices within a specific, maybe flawed context.
Precisely.
Okay, so if simple greed isn't the main culprit, what is this crucial, often overlooked reason we're diving into today? What's our mission here?
Our mission, really, is to unpack the central idea that investors, often quite innocently, take their cues from other investors who are playing a completely different game.
Different games.
Yes, there's this idea in finance, sounds perfectly reasonable on the surface, but it's caused, well, almost incalculable damage. It's the idea that any given asset, a stock, a house, has one single rational price. But that completely ignores the reality that investors have vastly different goals, different needs, and crucially, different time horizons.
That idea. One rational price. And it does sound fundamental, but when you put it like that, yeah, it seems misleading. How do we figure out a right price then? Like, take Google stock, a huge company. How much should you, the listener, pay for Google stock today? What's the right price?
Well, see, that question itself is flawed without more context. The answer totally depends on who you are.
Right.
If your time horizon is, say, 30 years, you're saving for retirement way down the line.
Okay.
Then the smart price involves, a pretty sober analysis of Google's discounted cash flows over decades, estimating future profits in today's terms.
Makes sense. Long-term view, long-term calculation.
But what if you're planning to cash out in maybe 10 years?
Shorter time frame.
Yeah. Then the price you'd pay might hinge more on your analysis of the whole tech industry's potential over that decade. Can Google's management actually execute their plans? Different calculation.
Okay, and what if it's even shorter?
Right.
Like you're looking to sell within a year.
Now you're looking at total different things. Current product sales cycles, maybe. Is a bear market coming? Things that affect the next few months.
Right. Immediate pressures.
Yeah.
And then the day trader.
The day trader. For them, the smart price is almost, well, who cares? Is maybe putting it bluntly, but
Yeah. Blunt, but probably accurate.
they're just trying to skim a profit off tiny movements between now and, lunchtime. That can happen at almost any price level as long as it moves predictably for a few hours.
So who cares about the 30-year plan?
Exactly. So a price that looks utterly ridiculous, completely insane to the 30-year investor
Mm-hmm.
can make perfect sense to the day trader because their focus, their goals, their entire game is different.
Different games, different rational prices.
Which leads us to what I think is an iron rule of finance. Money chases returns, wherever it can find them. So if an asset starts showing momentum, consistently moving up, it's actually not crazy for short-term traders to jump in, assuming it'll keep going up. Not forever, obviously, but just for the short time they need it to.
Right.
Momentum attracts short-term traders, and then, like you said, it's off to the races.
Yeah.
Bubbles really form when that momentum, those short-term returns, attract so much money that the whole makeup of the market shifts. It goes from mostly long-term holders to mostly short-term traders.
The balance tips.
Right. And it feeds on itself. More traders push up returns, which attracts even more traders. Pretty soon, the people setting the prices, the ones moving the market minute to minute, are the ones with the shortest time horizons.
Okay, I think I'm getting this. It's not that people suddenly become irrational gamblers overnight.
Not necessarily.
It's more that they've rationally shifted to a different game where the old rules like long-term valuation just don't matter for their immediate goal.
Exactly. That's a great way to put it.
So bubbles aren't really about valuations soaring sky high. That's just a symptom.
Right, the symptom.
The underlying cause is time horizon shrinking. More and more short-term players flooding the field.
Precisely.
Let's make this concrete.
Right.
The dot-com bubble in the 90s. People call it irrational optimism.
Common narrative.
But think about Yahoo. Stock in, say, 1999. Valuation looked crazy to anyone thinking long-term. Absolutely nuts.
Through the roof.
But if you were a day trader
Yeah.
playing that short game, It made perfect sense to pay a high price. You could make your money whether Yahoo was at $50 or $500. Didn't matter, as long as it moved predictably that day.
And it did move for a long time.
Yeah. And remember the headlines back then. Record trading volume. All the time.
Oh, yeah, constant churn.
That screams high-frequency buying and selling, right?
Yeah.
Short horizons. People weren't thinking 20 years ahead. The average holding period for a stock in '99 was apparently just 4 months.
4 months. That's barely long-term thinking at all.
And Maggie Mahar, in her book Bull, pointed out how the media focus shifted to quarterly reports in the mid-90s. That just fueled performance chasing. People piled into mutual funds right when they are most expensive.
Chasing last quarter's winner. Classic short-term behavior.
Exactly. It was the era of day trading, short-term options, constant market commentary. Not exactly a long-term investor's game.
And what's truly wild is how this exact same pattern, this dynamic, played out just a few years later. Different asset, same game shift.
The housing bubble.
The housing bubble. Mid-2000s. Paying $700,000 for a basic 2-bedroom house in Florida. It's really hard to justify that if you plan to live there, raise a family for 10, 20 years.
Almost impossible based on local incomes or rents.
Right. But if your plan is to flip that house in a few months, sell it to someone else for even more in a rising market.
Then it makes perfect sense.
Totally rational for that game, and loads of people are playing it. There's data from Adam, the real estate tracker.
Yeah.
It shows house flipping defined as selling more than once in 12 months went up 5 times during the bubble. 5-fold. From about 20,000 flips a quarter in 2000 to over 100,000 a quarter in early 2004.
Wow. A huge surge in short-term players.
Massive. And then, bam, it collapsed right after the bubble burst. Those flippers, they didn't care about price-to-rent ratios or long-term income growth. Completely irrelevant to their game.
Irrelevant.
The only thing that matters was, will the price be higher next month than this month? And for years, the answer was yes.
Until it wasn't.
Until it very suddenly wasn't. So putting it all together, bubble formation isn't really about rational people suddenly becoming irrational long-term investors.
Okay.
It's more about people somewhat rationally shifting their strategy towards short-term trading to capture that momentum, which has been feeding on itself.
Makes sense.
I mean, what do you expect people to do when there's clear momentum creating big, fast profit potential? Sit on their hands.
Not likely. Money chases returns, like you said.
Never. Not how humans work. Profits will be chased. And those short-term traders, they operate in a zone where the normal rules of long-term investing, especially valuation, they just get ignored.
Yeah.
Because they don't apply to the game being played by them.
Okay, so we've got the short-term game creating this momentum, fueling the bubble.
Yeah.
But now, here's where it gets really damaging, right? For everyday people,
This is the collision point.
it's when the long-term investors playing their game start taking cues from the short-term traders playing that other game.
Yes. The signals get crossed. Badly.
Think about Cisco again back in '99. Stock shoots up 300%, hits $60 a share. The company's valued at $600 billion.
Insane.
Objectively insane by any long-term metric.
Right. Few people actually thought it was worth that. The day traders were just riding the wave. Burton Malkiel, the economist, he pointed out that for Cisco to justify that price, its implied growth rate, meant it would have to become bigger than the entire U.S. economy within 20 years.
Which is just mathematically impossible.
Preposterous.
Utterly preposterous. BUT. If you were a long-term investor back then wanting to buy Cisco, $60 was the price. That was the market price.
That's the only price on the screen.
So maybe you look around, see everyone else buy it, and see the price soaring, and you think, wow, maybe they know something I don't.
The fear of missing out.
Yeah.
FOMO.
Exactly. Maybe you jump in. Maybe you even feel smart about it for a little while. And that's the terrifying part, isn't it? In the moment, it's so easy to see that rising price and think everyone else can't be wrong.
Yeah.
They must see something. How do you fight that urge, that herd instinct?
It's incredibly difficult because what you don't realize is that the traders setting that price at the margin, the ones pushing it to $60, they didn't care about 20-year growth prospects. They were planning to sell before the closing bell, hoping it would tick up to $60.50.
Just looking for pennies.
Pennies or dollars, but very short term.
Right.
But that $60 price, for you, the long-term holder, it was a ticking time bomb, a disaster waiting to happen.
And the two types of investors, they don't even know the other exists, really.
Rarely. They're just on the same field, running different plays, maybe even running right towards each other without looking.
And bam.
Yeah.
Someone gets hurt in the collision.
Someone gets hurt. And it's fascinating because so many decisions in finance and investing, They really are rooted in watching what other people do. You either copy them or you bet against them.
Hmm.
But if you don't know why someone is acting a certain way, buying that stock, flipping that house, you have no idea how long they'll keep doing it, what might make them stop, or if they'll ever learn their lesson. You're flying blind following them.
It's like when you hear a commentator on TV, on CNBC or wherever, saying you should buy this stock.
Right. Generic advice.
You have to remember, they have no idea who you are listening at home. Are you a teenager with pocket money?
Hmm.
Are you an elderly widow trying to preserve capital? Are you a hedge fund manager playing some complex strategy?
Vastly different needs and risk tolerances.
Can't we seriously think those three people should all buy the same stock at the same price? That the current market price is magically right for all of them? It's just illogical when you break it down.
It is, but psychologically, it's really hard to accept that other people who seem rational see the world through a totally different lens than you do,
Yeah.
especially rising prices. Man, rising prices are like a drug. They can seduce even the most disciplined, value-focused investor into becoming a wide-eyed optimist.
Hmm. Detached from their own strategy.
Totally detached, pulled into someone else's game simply by the allure of the rising price. And this idea, being swayed by people playing a different game, it's not just money, is it?
No, it's a great point.
It can mess up how we think about all sorts of things. Spending habits, career paths. We look at others, we admire what they have.
Sure.
We see the fancy car, the big house, the nice clothes, the great vacations. But what we don't see are their goals, their anxieties, their specific circumstances, or maybe their huge pile of debt.
Right. The hidden context.
It's a huge trap. Have you ever caught yourself doing that? Kind of unconsciously following someone else's script?
Oh, definitely. That point about not knowing why someone acts really hits home. I think about spending. You see someone with a certain lifestyle, maybe a young lawyer, like you mentioned, trying to make partner. They need the expensive suit, the fancy car, the right address, maybe. It's part of their game, their career strategy.
Right. It's an investment for them, potentially.
But then maybe working from home, see that lifestyle and think, oh, I should have that too. But I don't need it for my game.
You're just copying the spending, not the potential payoff.
Exactly. Spending the money without getting the career boost he might be getting. We might even like the same things, but we're playing totally different games. It took me years to really internalize that. It leads to disappointment if you're not careful.
It really does. Which brings us to the core takeaway, I think. Few things matter more with money than truly understanding your own time horizon.
Knowing your game.
Knowing your game, and crucially, not being persuaded by the actions and behaviors of people playing different games than you are.
So what does this mean practically for you listening? The biggest thing you can do is actually take the time to identify what game you're playing. It sounds simple, but it's amazing how few people actually sit down and define that.
It really is. There's this sort of implicit assumption that everyone labeled investor is on the same team, playing by the same rules, like they're all on a basketball court together.
Yeah, all aiming for the same hoop.
But once you realize how wrong that is, how diverse the playing fields and goals are, you see how vital it is to just define your game. What are you trying to achieve? For instance, years ago, I actually wrote down my own investing mission statement. Sounds a bit formal, maybe, but it helped.
What did it say?
Something like, I am a passive investor. I'm optimistic about the world's ability to generate real economic growth over the long run, and I'm confident that over the next 30 years, that growth will benefit my investments.
30 years. A very specific time horizon.
Exactly. And that might sound simple, almost quaint,
Powerful.
but incredibly powerful, because once you have that written down, once you know your game, everything else that doesn't align with that mission, it just becomes noise.
Yeah, like what the market did this week or this year even.
Mostly irrelevant to a 30-year plan.
That pundit yelling on CNBC.
Irrelevant. It gives you this amazing filter to cut through the chaos and stay focused on your objective.
That's a really actionable piece of advice. Define your game. Write it down. So let's wrap up this deep dive. The big insight today. These destructive financial bubbles. They're not just about greed. That's too easy.
Far too easy.
They're deeply connected to this dangerous, often invisible collision between different people playing different investment games on the very same field, driven by shrinking time horizons and people getting sucked into following cues from players whose goals are completely different from their own.
Well put. It's about that mismatch and the momentum it creates.
And understanding that gives you a powerful lens to see markets, and maybe other things, differently.
Which leads to A final thought to leave you with. If recognizing your own financial game and tuning out the noise from other players is so critical for your financial well-being,
Hmm.
what other areas of your life could be significantly improved by doing the same thing? By clearly defining your own objectives, your own game, and consciously avoiding being pulled off course by the actions and expectations of others who are fundamentally playing a different game than you are.
All right, let's start our deep dive today with a bit of a thought experiment. Picture an alien, totally logical, just observing Earth.
Okay.
Its job is to check out our economy,
Mhm.
specifically between 2007 and 2009. And it sees, the physical stuff.
Like what?
Times Square packed with people,
Yeah.
office buildings buzzing, factories running, cars on highways, universities, patents being filed.
Yeah.
Even better tech, like everyone suddenly has a smartphone.
Right. So just looking at all that, the tangible things.
Yeah.
What's the logical takeaway for this alien? Comparing 2009 to 2007, you probably think, well, things seem about the same, maybe even a little better with the new phones and all.
Exactly. That's what makes sense if you only see what's visible. But here's the twist. If this alien could suddenly see our numbers, the human data,
Mhm.
it'd be completely baffled.
Because the reality was so different.
Totally. U.S. households, $16 trillion poor, unemployment, 10 million more people out of work. The stock market, worth half what it was.
Wow.
And people's own forecasts, their sense of economic potential, just plummeted, absolutely nosedived.
You can just imagine the alien scratching its head or whatever it has saying, wait a minute. The cities look the same, factories, knowledge, tools. Nothing physical changed. Why are you poorer? Why so pessimistic all of a sudden?
And that question, that disconnect, that's exactly what we're digging into today. What caused this huge shift that our alien observer couldn't see?
Mm-hmm.
We're going to explore these unseen forces and how they mess with economies, sure, but also our own personal decisions, especially about money.
Yeah, like why we tend to believe things we want to be true.
Right, and how we build these complete stories in our heads, even when we only have like half the picture.
Huh.
So let's unpack this.
What's really wild here, maybe a bit scary, is that the only thing that really changed between 2007 and 2009 was the story.
The story we told ourselves about the economy, that's what our source highlights.
Think about 2007. The story was stability. Housing prices always go up. Bankers are smart and careful. Markets price risk perfectly. Everything's fine.
Yeah, it was a very reassuring narrative. People felt comfortable.
Absolutely. Then, boom, 2009. That story didn't just get revised, it shattered, completely broke.
And that breaking wasn't just, a change in sentiment. It set off a real-world chain reaction.
And a nasty one. Home prices fall. People can't pay mortgages. They default. Banks take huge losses.
Mm-hmm.
Banks get scared, stop lending money to businesses. Businesses can't borrow, so they lay people off.
Less jobs means less spending.
Which means businesses struggle more, leading to even more layoffs. It just feeds on itself, a vicious cycle.
This idea of narrative damage, it's incredibly powerful when you compare it to, say, physical damage.
Right. It's not like World War II destroying factories or like Japan's demographic shift with fewer workers in the 2000s. That's tangible stuff you can point to.
But in 2009, the buildings were still standing, the knowledge was still there. We kind of inflicted this damage on ourselves through the story changing, and it was devastating.
It really drives home the point. Stories are maybe the most powerful force in the economy. Seriously.
They're like the fuel or the brake.
Exactly. They can either let all that physical stuff, our capabilities, run full steam ahead, or they can slam the brakes on, no matter how much potential we actually have.
Okay.
And this brings us to a really key idea for, dealing with a world driven by these stories, especially with your money.
Which is?
It connects psychology and finance directly. The more you desperately want something to be true, the more likely you are to grab onto any story, even a flimsy one, that tells you the odds are good. It's a human thing.
That makes sense. It's not just about numbers.
No. There's this great example in a documentary, How to Live Forever. They asked a centenarian about her happiest day. She
Wow.
said Armistice Day, end of World War I. Why? Because we knew, she said, there would be no more wars ever again.
Oh, wow. That's poignant.
Yeah. And just 21 years later, World War II starts. Kills 75 million people. That desire for peace was so intense, it created a belief, a story that just wasn't reality.
You really see how desperation fuels belief there. It reminds me of that quote from Ali Hajaji in Yemen.
Yeah, the folk remedy story.
Right. His son was sick. They tried this folk cure with a burning stick. And he told the reporter, when you have no money and your son is sick, you'll believe anything.
Chilling. And it echoes through history, right? Think about medicine before science really kicked in.
Bloodletting, starvation.
Yeah, or drilling holes in people's heads. And Daniel Defoe wrote about the Great Plague in London, 1722. People were desperate. They rushed to buy infallible preventative pills and sovereign cordials, anything that promised hope.
Because a real solution wasn't available or known.
Hmm.
So you grab onto whatever story offers relief.
Exactly, and this plays out constantly in finance.
Like with, say, TV investment gurus. People watch them even if their track record is questionable. Why?
Well, think about the potential payoff. Investing feels high stakes, even if there's only like a tiny 1% chance some wild prediction could make you rich.
Listening feels almost rational, just in case.
Right. And then, once you choose a side, maybe you buy a certain stock or you're convinced inflation is about to explode, you're invested, not just financially, but mentally, emotionally.
You want your team to win.
You want your tribe, your chosen narrative to be the absolute truth, even if it's based on a long shot. We're not good at weighing those low probabilities. We often just default to believing because the possibility of that huge win exists.
It explains a lot of, let's call it financial quackery, like the mutual fund thing.
Oh yeah, the stat is stark. 85% of active funds underperformed their benchmark over 10 years and in 2018.
And that's not new. It's been like that for ages.
Yet trillions, nearly $5 trillion, are still invested in them. It defies simple logic if you only look at the numbers.
Or look at Bernie Madoff. Hindsight makes the red flag seem obvious, right?
Totally. Returns that never varied, this tiny unknown auditor, all the secrecy.
But he raised billions from smart, sophisticated people. Why?
Because, as the source says, he told a good story and people wanted to believe it. His story perfectly matched their desire for safe, high returns.
So the takeaway here seems to be skepticism.
Yeah.
And maybe planning for things to go wrong.
Yes. When a story, especially a financial one, sounds too good to be true, your best defense isn't finding more data to confirm it. It's having that healthy skepticism and, crucially, building in room for error.
A buffer.
A big buffer. It's the ultimate shield against getting sucked into appealing fictions. And this isn't just for individuals. Even the pros fall for wishful thinking.
Like the Federal Reserve in late 2007.
Exactly. Their last meeting that year, they predicted growth for 08-09 between, what was it, 1.6% and 2.8%. That was their range, their room for error.
And the reality.
The economy actually shrank by over 5%, a massive miss.
Why do they get it so wrong sometimes?
Well, think about it. Predicting a full-blown recession is awkward, makes your job harder, it spooks everyone. It's just a painful truth to face.
So the tendency is to forecast maybe slow growth, even in the worst case.
Pretty much. It's human nature to kind of shy away from staring the really ugly possibilities right in the face.
And that applies to us too, right? Not just the Fed. If I think a recession's coming and sell all my stocks.
Suddenly your whole view of the economy gets skewed. You need the recession to happen to prove you were right.
So every negative news story looks like proof.
Yeah, you start seeing confirmation everywhere, not because it's objectively there, but because you're looking for it. You want your decision to be validated.
Okay, so how do we protect ourselves from this? From falling for stories we want to believe?
It comes back to those key ideas. Room for error, flexibility, and financial independence. They sound simple, but they're vital.
They're your safety net.
Exactly. The bigger the gap between what you wish were true and what actually needs to be true for your plan to work, the safer you are. That buffer protects you.
So that's the first big theme.
Mhm.
How much our desires shape our beliefs. What's the next piece of this puzzle?
It's related. The second core idea is this. We all see the world incompletely, we just don't have all the information.
Makes sense.
And this is the key part, we still form a complete narrative in our heads to fill in those missing pieces.
Like we stitch together a full story even with gaps in the fabric.
Perfectly put. Our source uses a great analogy. Think about a 1-year-old baby.
Okay. Cute, but clueless about economics.
Exactly. She has zero concept of jobs, bills, mortgages, the Fed. Trying to explain any of it is pointless.
Right.
But is her world dark and confusing to her? No. She's built her own internal story that makes perfect sense to her.
Right. Blankets are warm, mom's cuddles are safe, food tastes good.
Precisely. It's a coherent narrative based on her limited experience, and crucially, she doesn't know what she doesn't know. The gaps don't bother her.
And you're saying we all do that, even as adults.
All of us. We navigate the world using our own mental models, our own limited experiences. We look for causes and effects that make sense within our framework.
And we're often wrong because that framework is incomplete.
Often, yes. We just know less than we think we do. This even happens in fields like history, which seems objective.
Right, you mentioned the historian B.H. Liddell Hart. What was his take?
He said something like, the sheer amount of historical evidence is overwhelming. So historians have to select. And where there's selection, there's art, there's interpretation.
So people read history not just for facts, but maybe to confirm what they already believe.
Often, yeah. We look for stories that fit our view and tend to ignore the inconvenient bits. We want to feel like we're on the right side, looking back.
Daniel Kahneman, the psychologist, had something to say about this too, about hindsight.
He did. He pointed out that hindsight, our ability to explain the past after it happened, gives us this powerful illusion that the world is more knowable than it is.
So because we can tell a story about why something happened yesterday, we feel like we understand the world better than we do.
Exactly. When faced with something complex or random, we don't usually just say, I don't understand. We quickly create an explanation that fits our limited view. We need the world to make sense.
And financially, this illusion can be dangerous.
It can be fascinating and terrifying, yeah. If we're blind to how parts of the market or economy really work, we can develop this misplaced confidence. We misunderstand what's happening, but feel sure we know what's coming next.
Which makes forecasting so tricky. Everyone's working off their own incomplete but personally complete narrative.
Precisely. You've got billions of these individual worldviews bouncing off each other. That's why blindly following someone else's investment advice can be a disaster. Their story might make sense to them, but it might be totally wrong for the reality you're facing. Think market bubbles.
Yeah, everyone's caught up in the same incomplete story. So why then is there still such huge demand for market forecasts? We kind of know they're usually wrong.
It's that need for control again. Psychologist Philip Tetlock nailed it. He said, we need to believe we live in a predictable, controllable world. So we turn to authoritative-sounding people who promise to satisfy that need. The feeling of control, even if it's an illusion, is just more comforting than admitting uncertainty.
We prefer a confident wrong forecast to an honest, I don't know.
Often, yes. We crave stories that suggest outcomes are predictable, that someone has the map.
It feels like we confuse different kinds of problems, like science versus, well, life.
That's a great way to put it. Think about NASA sending the New Horizons probe to Pluto.
An amazing feat of precision.
3 billion miles, 9.5 years, and it arrived within about a minute of prediction. That's like 99.99998% accurate. Incredible.
But that's astrophysics. Physics doesn't have feelings or get spooked by headlines.
Exactly. That's a field of precision. But business, economics, investing, these are fields of uncertainty. They're driven by human behavior, emotions, stories, incentives. Totally different game.
Kahneman talked about this bias in planning too, didn't he? How we focus inward.
Yeah, he observed that when we plan anything, a project, a business, we focus almost entirely on what we can do, our skills, our resources.
And we ignore the competition. Or just bad luck.
Largely, yes. We focus on skill over luck. And critically, we focus on what we know, our plan, our team, and we neglect the vast ocean of what we don't know.
Leading to overconfidence.
Massive overconfidence. He told a story about asking startup founders how much of their potential success depended just on what their own company did.
And they said,
Almost always 80% or more. But that can't be right. Success depends hugely on competitors, market shifts, regulations, things totally outside their control.
But they focus on their own plan, the part they know. They build a complete narrative about their future success.
Without fully realizing how much is missing from that story.
And just like that one-year-old baby, we don't walk around feeling lost or confused by what we don't know.
Not usually, no. We construct these complete narratives because, honestly, how else could we function? How could you make any decision if you were constantly paralyzed by the infinite things you don't know? We need the world to feel like it makes sense.
So let's bring it back to our alien at the start.
Okay.
He sees the tangible stuff, feels confident he understands the economy, but he's completely wrong.
Because he can't see the invisible layer. The story is inside everyone's heads.
And that alien, that's basically all of us, isn't it? Operating with our own limited view.
It really is. We're all confident in our own narratives, often without realizing how incomplete they are.
So the final thought to leave everyone with today is this. Since we all have these incomplete views and we fill the gaps with powerful stories, maybe take a moment to consider your own big decisions, especially around money.
Ask yourself, what unseen stories might be driving my choices? What narratives am I telling myself?
And maybe the path to more control isn't just about getting more data, but about questioning those stories themselves. A powerful thought to reflect on. Have you ever noticed how bad news always seems to grab our attention way more than good news, which just kind of fades away?
Yeah, it really does.
Or how predictions of doom often sound, I don't know, so much smarter, more profound maybe than forecasts of actual progress. It's something I think about quite a bit.
It's a really powerful observation, and today, that's exactly what we're going to dig into, the seduction of pessimism.
Okay.
We're going to try and unpack why, as the historian Deirdre McCloskey put it so well, why people like to hear that the world is going to hell.
Right. It's a fascinating pull.
Yeah.
So the insights for this deep dive, they all come from this really compelling source that looks at the psychology, the economics, the history behind why we're so drawn to negative outlooks. It's all kind of viewed through this single lens.
Exactly. And our mission really is to help you understand this powerful pull. We want to explore how it shapes, how you see everything from your own finances to big global trends.
And maybe figure out what it really means to be, optimistic in a reasonable way.
Precisely. How to cultivate a grounded optimism in a world that often seems, frankly, to reward the gloom. So let's get started.
Okay, so first things first. Let's go ahead and define optimism. Because I think there's a common trap here, right? People often mix it up with, what is it they confuse it with?
Yeah, they often confuse it with, complacency or just blind faith. This idea that, everything will just magically turn out great no matter what we do.
Which isn't really optimism.
No, not at all. True optimism, as our source explains it, it's more the belief that the odds of a good outcome are generally in your favor over the long haul, even when, for sure, there are going to be setbacks along the way.
Okay.
And it's built on a really simple idea, actually. Most people, most mornings, they wake up trying to make things a little bit better, a bit more productive. They're not usually trying to cause trouble.
That makes sense.
And that simple fact forms the foundation of optimism being a pretty reasonable bet on the future.
I really like that distinction. It's not saying everything will be perfect, but that betting on improvement is the most, rational stance most of the time.
Mm-hmm.
It makes me think of Hans Rosling, the statistician. He famously said, "I am not an optimist, I am a very serious possibilist."
Yes, that quote is perfect.
It sort of bridges that gap, doesn't it?
Yes.
Between maybe a naive view and something more grounded in reality.
It really does. But what's so fascinating is, even with that more nuanced definition, pessimism still seems to win the popularity contest,
Yeah, it feels that way.
It's not just that it's more common, it actually sounds smarter. It's seen as intellectually captivating, gets more attention. While optimism, even the reasonable kind, is often viewed as, being oblivious to risk.
And this isn't just some abstract idea, is it?
No.
This intellectual pull, it plays out in really dramatic ways in how we consume news and react to things. Do you have a good example from the source?
No, absolutely. A really striking one. Think back to December 2008, remember. The global economy was just in absolute freefall. Stock markets crashing.
Yeah, scary time.
And on December 29th, the Wall Street Journal, and this is the key part, the Wall Street Journal, the most prestigious financial newspaper in the world, not some backroom blog or tinfoil hat newsletter. They ran a front-page article about a Russian professor, Igor Panarin.
Oh, I think I remember this. His prediction that was pretty out there, wasn't it?
Wildly out there. Panarin claimed that around July 2010, so just a year and a half later, the U.S. would literally break apart into 6 pieces.
6 pieces. How?
Get this. Alaska would go back to Russia. California would join China, Texas would become part of Mexico, the East Coast Atlantic America would join the EU, the northern states would go to Canada, and Hawaii would end up as a protectorate of Japan or China.
Wow. That's quite a forecast.
It was pure apocalypse. And it got front page treatment in one of the world's leading financial papers.
Okay, so hold that thought. Now let's contrast it. Imagine it's 1946, just after World War II. Japan is absolutely devastated. People are facing famine, living on less than 800 calories a day.
A truly bleak picture.
Now, imagine some academic back then wrote an article predicting that in just one generation, Japan's economy would explode, become 20 times its pre-war size.
Okay.
And not just that. This same academic predicts life expectancy would almost double. Their stock market would see returns unlike almost anything in history. They'd go 40 years without unemployment ever going above 6%.
Mm-hmm.
They'd become a global leader in electronics, own prime real estate in the U.S., and become close allies with the Americans who just defeated them.
That sounds completely unbelievable in 1946.
Exactly. But here's the kicker. All of that. It actually happened in the generation after the war.
Wow.
But that prediction, back in 1946, it would have been summarily laughed out of the room, no question.
It's such a stark contrast. It perfectly shows why, as the source puts it, the mirror opposite of Panarin looks absurd in a way a forecast of doom doesn't.
So why?
Yeah.
Why this huge difference in how we react?
Well, the simple truth, the source argues, is tell someone they're in danger and you have their undivided attention instantly.
Right. Fear grabs you.
Think about it with stocks. Someone tells you a stock you own might go up tenfold. You might think, yeah, right, and dismiss it.
Probably.
But if someone warns you that same stock is about to collapse because of fraud, you'd clear your calendar and listen to their every word.
Guilty as charged. Yeah.
And it works for the media too, right? If you go out there and say, we're heading for a big recession, you'll get calls from newspapers, maybe get on TV.
Absolutely.
But predict average growth, crickets. No one cares.
It's so true. Matt Ridley talked about this in The Rational Optimist, didn't he? That constant drumbeat of pessimism.
He did. He pointed out that if you say the world has been getting better, people might call you naive or insensitive.
Oh, okay.
But if you say the world is going to keep getting better, then you're considered embarrassingly mad.
Whereas the doomsayers.
Exactly. Ridley says if you claim catastrophe is imminent, you might just get a MacArthur Genius Award or even the Nobel Peace Prize.
It's quite the incentive structure. And Hans Rosling observed something similar in Factfulness, right? About how people perceive the world.
Yeah, he said, every group of people I ask thinks the world is more frightening, more violent, and more hopeless. In short, more dramatic than it really is.
And this isn't even new. You mentioned John Stuart Mill back in the 1840s.
That's right. Even back then, Mill observed, I have observed that not the man who hopes when others despair, but the man who despairs when others hope, is admired by a large class of persons as a sage.
Wow. So this intellectual allure of pessimism, it really does have deep roots.
It certainly seems so.
Okay, so we've talked about the intellectual appeal. But when it comes to money, our finances, that pull towards pessimism feels even stronger, doesn't it? Almost visceral. What's going on there?
Yeah, it definitely feels stronger. And a big part of it, this source suggests, is just instinctual and unavoidable. It taps into something called loss aversion.
Loss aversion. Okay, break that down for us. It sounds like something really deep-seated.
It is. Think of it as an evolutionary shield. That's how Daniel Kahneman put it. Basically, the pain of losing something feels way more intense than the pleasure of gaining something equivalent.
So losing $100 hurts more than finding $100 feels good.
Pretty much, yeah. Our brains are just wired to prioritize threats. For our ancestors, missing out on an opportunity might mean going hungry for a bit, but missing a threat, that could mean being eaten. So losses loom larger than gains. It's baked in.
That makes a lot of evolutionary sense. And beyond that instinct, there's something special about money itself, right?
Absolutely. Money is just, well, it's ubiquitous. It touches everything. So when something bad happens financially, it tends to affect everyone and captures everyone's attention.
Unlike, say, a localized disaster.
Exactly. Think about a hurricane hitting Florida. Terrible for Florida, but it poses no direct risk to, 92% of Americans?
Right.
But a recession, a big economic downturn, that could impact every single person, including you, so pay attention. That gets everyone listening.
You definitely see that with the stock market news. A 1% rise gets like a brief mention, maybe.
Really?
But a 1% fall. Suddenly everyone's trying to explain why it went down. Is it worries about growth? Did the Fed do something wrong? Are politicians messing things up?
Right. Those negative narratives are just easier to grab onto, easier to talk about, easier to worry about. And they set the stage for future gloomy stories.
The Great Crash of 1929 is a huge example of this, even though not many people owned stocks back then.
It really is. Only about 2.5% of Americans owned stocks then. Yet the vast majority watched in amazement as the market collapsed, just wondering what it meant for their own future, their jobs, their lives. The historian Eric Rauchway described it perfectly. People felt that the ground under their feet was giving way.
It highlights that systemic nature you mentioned. Health problems are often individual, but money.
Exactly. Money issues are more systemic. Everything's interconnected. So those financial risks just feel much bigger and more immediate to everyone.
This connects to another really interesting point from the source. It's not just what we pay attention to, but how things actually unfold. This idea of adaptation.
Ah, yes, the iron law of adaptation.
Right. This idea that really bad situations often contain the seeds of their own solution because people and markets adapt. Necessity is the mother of invention, that sort of thing. Can you walk us through that, maybe using that oil prediction example from 2008?
Yeah, it's a perfect illustration. See, it's really easy to make a pessimistic forecast by just assuming that something ugly will stay ugly.
Right.
It's persuasive because it doesn't require imagining the world changing in any fundamental way.
Just drawing a straight line from today's problems.
Exactly. So back in 2008, the environmentalist Lester Brown looked at China's rising demand and predicted that by 2030, China would need 98 million barrels of oil a day. He then noted, the world is currently producing 85 million barrels a day and may never produce much more than that.
So a huge shortfall looming. Sounds scary.
It did.
Yeah.
And he was right about the scenario demand was set to rise, but he missed that iron law in economics. Extremely good and extremely bad circumstances rarely stay that way for long because supply and demand adapt in hard-to-predict ways.
So what happened with oil prices and production then?
Well, remember, oil prices surged massively, from around $20 a barrel in 2001 to $138 in 2008.
Yeah, huge run up.
That made drilling oil like pulling gold out of the ground. Suddenly, the incentives completely flipped. There was this massive push to find more oil and develop new ways to get it out.
Like fracking.
Exactly. Technologies like fracking and horizontal drilling, which were maybe experimental or too expensive before, suddenly became incredibly profitable. The oil historian Daniel Yergin pointed out that something like 86% of oil reserves in the United States are the result not of what is estimated at time of discovery, but of the revisions that come later because of better technology.
So we found ways to get way more oil than we thought possible.
Dramatically more. U.S. oil production went from about 5 million barrels a day in 2008 to 13 million by 2019.
Wow, more than doubled.
And world oil production, it's now over 100 million barrels a day. That's 20% above what Brown assumed was the high mark back in 2008.
So the pessimistic extrapolation missed the adaptation.
Completely. To someone just extrapolating oil trends in 2008, things looked really bleak. But to a realist who understood that necessity is the mother of all invention, the situation was far less terrifying. The core message is really powerful. Problems create incentives to solve them. People adapt. Threats often spur solutions of equal magnitude.
That really shifts the perspective, and it leads to another key point, the difference in speed. Progress seems slow, almost invisible sometimes, while setbacks feel instantaneous.
That's a crucial asymmetry. As the source says, there are lots of overnight tragedies. There are rarely overnight miracles.
The airplane example is fascinating here. The skepticism was intense for so long.
Oh, absolutely. Think about it. Late 1800s, a major newspaper, the Detroit Free Press, just flat out declares airplanes appear impossible. Their reasoning. Nature put a weight limit on flight, maybe 50 pounds, and a flying machine would need to weigh 300, 400 pounds. So, impossible. Nature has reached this limit and has failed to pass it.
And this was right before the Wright brothers.
6 months later, Orville Wright drops out of high school to start working with Wilbur on inventions.
But even after they actually flew in 1903, it took ages for people to get it right.
It's amazing. No one seemed to notice. Frederick Lewis Allen wrote about this years later, saying, several years went by before the public grasped what the Wrights were doing. People just dismissed it as some kind of trick without significance.
How long did it take for the press to really believe it?
Get this, nearly 4.5 years. Not until May 1908 did experienced reporters finally start giving full credence to the news coming out of Kitty Hawk.
4.5 years. And even then, they underestimated it.
Wildly, for years. First, it was just a military weapon. Then maybe a toy for rich people. Then, okay, maybe a few people could fly. The Washington Post, as late as 1909, wrote with confidence, there will never be such a thing as commercial aerial freighters. Freight will continue to drag its slow weight across the patient earth.
And when did the first cargo plane fly?
5 months later.
Oh, the irony. Now, contrast that incredibly slow awakening to the potential of the airplane with how quickly we react to bad news.
Exactly. Think about the drivers of pessimism, like a corporate bankruptcy or a major war. The reaction is instant, it's visceral, everyone pays attention immediately.
So why this difference in speed perception?
Well, growth is driven by compounding, which always takes time. It's like planting a seed and waiting for it to grow into a tree. It happens slowly, incrementally. You might not notice the daily change.
Right.
Destruction, however, is driven by single points of failure, which can happen in seconds, and loss of confidence, which can happen in an instant. A dam breaking, a market crashing, it's sudden.
You see this in medicine too, don't you?
Oh, definitely. Think about the progress against heart disease. It's been extraordinary. The age-adjusted death rate has fallen something like 70% since 1965.
That's huge.
It translates to saving 500,000 American lives per year. That's like saving the population of Atlanta saved every year. It's incredible progress.
But because it unfolds slowly, year after year.
It just captures less attention than quick, sudden losses like terrorism, plane crashes, or natural disasters.
Yeah.
I mean, imagine the headlines if you had a Hurricane Katrina 5 times a week, every week. The attention would be immense, right?
Unimaginable.
But even that level of tragedy would not offset the number of annual lives saved by the decline in heart disease. Yet the slow gain gets less focus than the sudden loss.
And this applies to business, markets.
Everywhere. It takes years sometimes to see how important a new company or product is, but failures, they can happen overnight. A stock market falling 40% in 6 months. That gets congressional hearings, endless news coverage.
But a huge gain over several years.
140% gain over 6 years. Might barely register. It just goes unnoticed. So the short sting of pessimism prevails, while the powerful pull of optimism goes unnoticed.
Which really highlights that if you're investing or just thinking long term, you have to understand that volatility and loss are part of the journey towards growth.
Exactly. It's the price of admission for long-term success.
So after unpacking all of this, the intellectual appeal, the financial fear, the slow progress versus fast setbacks, what's the ultimate reason pessimism is so seductive? What's the core payoff?
Well, the source suggests the ultimate psychological payoff is actually quite simple but profound. Pessimism reduces expectations.
Reduces expectations. How so?
It narrows the gap between all the possible outcomes out there and the outcomes you'd actually feel great about. If you expect things to be mediocre or bad, then anything slightly better feels like a win.
Yeah, that makes sense. It reminds me of that incredible story about Stephen Hawking.
Oh, yeah?
When someone asked him if he was always cheerful, despite everything, he said, "My expectations were reduced to 0 when I was 21. That was when he got his diagnosis.
Right. Such a devastating prognosis.
And then he added, "Everything since then has been a bonus."
Wow. That puts it perfectly.
Lowering the bar makes it easier to be pleasantly surprised.
That's the deep irony, isn't it? Expecting things to be bad is the best way to be pleasantly surprised when they're not.
Which, funnily enough...
Which, ironically, is something to be optimistic about.
Huh. Little twist at the end there.
Yeah.
So, okay, wrapping this up. We've seen how our own minds, our biases, the way news is framed, and just the fundamental way growth and setbacks happen. It all conspires to make pessimism feel really powerful, sometimes misleadingly so.
Absolutely. It's a complex mix of factors all pushing in that direction.
So for everyone listening, now that you hopefully understand this seduction of pessimism a bit better, maybe the question to ponder is this. How might knowing this change how you take in the news? How you think about risks, both personal and financial? Or even how you approach your own long-term plans and goals?
Yeah, maybe pause and consider that hidden strength of human adaptability we talked about, and that quiet, slow, compounding progress that's always happening. Even if it doesn't make the headlines, it's definitely something worth thinking about.
Welcome to the Deep Dive. We're here to cut through the noise and really get to the heart of important ideas.
That's right. And today, we're tackling something I think is, well, genuinely fascinating.
It's this paradox, isn't it, about how we use history, especially when it comes to money and markets.
Exactly. Yep. History is, fundamentally a story of surprises, things that hadn't happened before.
Right. Events that were totally unprecedented at the time.
Yet, we have this tendency, almost a reflex, to treat it like a roadmap for what's next, like an instruction manual.
It reminds me of that quote from Stanford professor Scott Sagan. He said, "Things that have never happened before happen all the time."
It's such a great quote because it captures the irony perfectly. We want predictability, naturally, especially with our finances.
We look back hoping to find certainty, some kind of guide.
But if history's main lesson is surprise, how can it be a reliable blueprint? The future's bound to have its own shocks.
So our goal in this deep dive is really to help you, the listener, calibrate your thinking on this.
Yeah, help you spot these common pitfalls of using past data and maybe gain a more nuanced view of the future of money.
Without getting totally lost in all the numbers and charts.
Precisely, because that urge for comfort in the past, that leads directly into this trap we're calling the historians as prophets fallacy.
Okay, let's unpack that. The historians as prophets fallacy. What is it really?
It's basically an over-reliance on historical data, thinking it's a clear signal for what's coming next.
Especially in investing, right, where things seem to change so fast.
Exactly. Innovation, change, they're constant, but it's tempting to view investing like, say, geology or medicine.
Ah, okay. Because in those fields, the basic principles are pretty stable over time.
Right. A geologist can study rock formations from millions of years ago and apply those principles today. Doctors know kidneys worked basically the same way 1,000 years ago as they do now.
There's that underlying consistency.
Yes. But investing,
Hmm.
it's just fundamentally different.
How so? Aren't there economic laws or something?
Well, it's driven by people. Millions of people making imperfect decisions with limited information.
And emotions get involved.
Hugely. Nerves, greed, fear, paranoia. Even the smartest people are susceptible. It brings to mind Richard Feynman's famous line.
Oh, the one about physics.
Yeah, imagine how much harder physics would be if electrons had feelings.
Uh-huh. That perfectly captures it. That's investing.
It really is. And it means the foundation of economics isn't stability, it's actually constant change.
Nothing stays great forever. Nothing stays terrible forever. Things shift.
Right. Think of Bill Bonner's analogy of Mr. Market with his capitalism at work t-shirt and a sledgehammer. He's always changing things.
Because what drives it, all the stories we tell ourselves, what we want to buy that changes with culture, with generation.
It's always evolving. It never just sits still.
And that constant motion, that unpredictability, that leads to the first big danger you mentioned.
Yes, exactly. The first major danger of leaning too hard on history is that you're very likely to miss the really big shifts, the outlier events.
The game changers, not just small market bumps.
No, we're talking about the truly record-breaking stuff, things that seemed almost impossible before they happened.
Like the Great Depression.
Definitely. Or World War II, the dot-com crash, 9/11, the 2008 housing crisis.
These weren't just blips. They reshaped everything.
They had an absolutely massive, outsized impact because they set off chain reactions, cascading consequences.
It's wild to think about individuals, too. Like, how different would the world be if just a handful of key people never existed?
It's a powerful thought experiment. Take maybe 7 figures from the last century or so. Hitler, Stalin, Mao, Gavrilo Princip.
Yeah.
But also Edison, Bill Gates, Martin Luther King.
Their absence would have created entirely different timelines.
Unquestionably. Billions lived, but the actions of a few had disproportionate global effects.
The same with events, right? Think of the 20th century without, say, World War II.
Or the Great Depression, the Manhattan Project, antibiotics, the internet's precursor, ARPANET, 9/11, the fall of the Soviet Union.
Just a handful of things out of countless events that fundamentally altered the path we're on.
Absolutely, and the compounding effect is often missed. Let's take 9/11 again.
Okay.
19 hijackers. Seems like a specific terrible event, but follow the ripples.
Right.
The Fed cuts rates drastically in response. That fuels the housing boom.
Which then leads to the bubble and the crash in '08.
Exactly. Then you get a terrible job market post-crisis. Millions decide college is the only path forward.
Leading to a huge increase in student borrowing.
And now we have $1.6 trillion in student debt with a default rate over 10%. It's not intuitive to link 19 hijackers to today's student loan crisis, but the chain reaction is there.
It's like that failure of imagination idea Nassim Taleb talks about.
Precisely, like the Egyptians only planning for the worst recorded Nile flood or Fukushima built for the worst past earthquake.
They analyzed the past, but couldn't imagine something worse happening.
Yes. The problem wasn't lack of data, it was a failure to conceive of something truly unprecedented.
So what's the real lesson from surprises then?
Daniel Kahneman put it beautifully. He said the correct lesson isn't, I'll never make that mistake again.
Okay.
It's realizing that the world is surprising. Full stop. It's admitting we really don't know what's next.
We shouldn't use past surprises to define the limits of future ones.
Exactly right. So if you want one prediction that holds up,
What's that?
it's that the next big thing, the event that truly moves the needle for the economy and markets, will likely be something history gives us very little warning about.
Something unprecedented.
Mm-hmm.
And because it's unprecedented, we won't be ready.
Which is partly why it has such a big impact. Surprise is the constant mover.
Okay, so that's the danger of missing outliers. What was the second big danger?
The second one is ignoring structural changes. History can be misleading because the underlying systems, the very way the economy and markets work, change over time.
Ah, so the context shifts.
Dramatically. Think about your own personal finances. The 401k plan, it's only about 42 years old.
And Roth IRAs came even later, in the 90s.
Right. So, how Americans save for retirement today, the advice they get, the analysis, it's not really comparable to what someone faced a generation or two ago. The tools are different.
That makes sense. What about other areas?
Venture capital is a huge one. 25, 30 years ago, it barely existed as an industry.
Really? It seems so dominant now.
It is now, but think of Phil Knight trying to fund Nike early on. He wrote there was no VC back then.
Wow.
So all our historical data on startup fund cycles, failure rates, investment patterns, it's based on a relatively short and very different period. The landscape is completely new.
And even the big public markets like the stock market have changed.
Oh, fundamentally, the S&P 500 index is a good example. Financial stocks weren't even in it until 1976.
I didn't know that.
Now they're a huge chunk. Tech stocks were tiny 50 years ago. Now they dominate.
So all the rules changed too, right? Accounting, disclosures.
Exactly. How companies report earnings, how audits work, how easily you can trade stocks market liquidity, all vastly different.
It seems even basic things like how often recessions happen have changed.
That's another great example. Back in the late 1800s, the U.S. had recessions roughly every couple of years on average.
That often.
Yeah. Early 20th century, it stretched to about 5 years. The last 50 years or so, it's been more like 8 years between them.
And we just had a really long stretch without one recently.
The longest since before the Civil War, actually. Whether it's better economic management by the Fed or the shift from manufacturing to services, the point is the underlying pattern, the structure, has changed.
This makes me think about investment gurus like Benjamin Graham. His book, The Intelligent Investor, is considered a classic.
Absolutely, a foundational text for value investing.
I remember reading it when I was younger, looking at all the historical data.
Yeah.
And his formulas seem like, a magic key, step-by-step instructions to get rich.
That's the allure, isn't it? Specific rules based on past success. But what happens when you try to apply those specific formulas today?
Well, yeah, that's the thing. A lot of them don't really work anymore, do they?
Often, no. Like his rule about buying stocks for less than their net working assets or avoiding stocks trading above 1.5 times book value.
Right.
If you strictly followed those today, you'd likely end up owning mostly very distressed companies, or maybe just specific sectors like financials, not quite the diversified path to wealth he intended.
So was Graham wrong or just misunderstood?
He wasn't wrong for his time. He was incredibly successful. But the key, as Jason Zweig pointed out when updating the book, is that Graham himself was constantly adapting.
He didn't stick to the same formulas forever.
Not at all. He was always experimenting, retesting. Zweig noted he'd discard old formulas from previous editions and replace them with new ones. He updated the book 5 times.
He practiced what he preached about analysis, even on his own methods.
Exactly. And near the end of his life, in 1976, someone asked him if his famous detailed stock analysis was still the best approach.
What did he say?
He said, in general, no. He admitted he wasn't an advocate of those elaborate techniques anymore because, and this is his quote, the situation has changed a great deal since then.
He acknowledged the world was different.
Explicitly. He mentioned more analysts, better technology, economic shifts, basically the structural changes we've been talking about. Even the prophet knew his specific prophecies had an expiration date.
It's funny how the further back you look in investing history, the more you're looking at a world that just doesn't exist anymore in the same way.
Which brings us neatly to that phrase everyone loves to mock. It's different this time.
Ah, yes. John Templeton supposedly called those the 4 most dangerous words in investing.
He did, but the irony is Templeton himself admitted that, well, maybe 20% of the time, it is different.
Huh. So even he knew things change.
Right. And those changes are often the most important things to understand. Michael Batnick had a great comeback to that.
What was it?
He said, the 12 most dangerous words in investing are, the 4 most dangerous words in investing are, it's different this time.
That's brilliant. It highlights the danger of automatically dismissing the possibility of real change.
Exactly. So the takeaway isn't ignore history. Not at all.
But use it differently.
Yes. The further back you look, the more general the lessons should be. Focus on the timeless stuff.
Like human psychology, greed, fear.
Precisely. Those don't change much. But specific trends, trades, which sectors are hot, what causes market moves, those are constantly evolving.
So recent history might actually be more relevant for specifics because the underlying structures are more similar to today.
Often, yes. It requires a nuanced approach. History provides context, not a crystal ball.
Okay, so let's pull this together. We've dived deep today and found that history, while valuable, isn't a perfect map for the future.
Right. Two main reasons. First, the world is shaped by huge, unpredictable outlier events that history can't really prepare us for.
And second, the fundamental structures of the economy and markets are constantly changing, making old data less relevant over time.
So instead of looking to history for a detailed map, maybe the better approach is cultivating imagination
Imagination for what could happen, rather than just what has happened.
and building resilience, preparing for surprises rather than trying to predict them precisely.
So the question for you, the listener, is this. Knowing that the future will bring surprises, knowing that the ground rules will shift, how do you plan for your financial future?
How do you avoid getting caught in those traps of relying too heavily on past data?
Maybe the answer lies less in forecasting and more in preparing for a world that will always surprise us. Something to think about.
Welcome to the deep dive. Today, we're taking a deep dive into some really fascinating insights about managing uncertainty, especially, when it comes to our money.
Right.
We've got a fantastic source document here that pulls together lessons from some unexpected places. Our mission today is basically to pull out the most important nuggets of knowledge from this material. Help you understand how to navigate a world that's less about certainties and much more about probabilities.
Yeah, that's the key, isn't it? Probabilities.
Exactly. And we'll explore why giving yourself room for error isn't some sign of weakness, but actually a powerful strategy for success and, frankly, peace of mind.
It really is.
Okay, let's unpack this. So here's where it gets really interesting right off the bat. Our source starts by pointing to, well, a pretty unlikely place for smart financial behavior, Las Vegas casinos.
Yeah, not exactly the first place you think of for financial wisdom.
Not the average player, mind you, but a small group of blackjack card counters.
Mm-hmm.
What on earth can a casino floor teach us about managing uncertainty with our money?
Well, what's fascinating here is how these card counters, they really understand probability deeply.
Okay.
They know, no one can predict the next card with certainty. It's impossible.
Yeah.
But by tracking the dealt cards, they calculate the odds of the remaining cards.
Right, counting the high and low cards.
Exactly. Then they bet more when the odds are, slightly in their favor and less when they're against them. It just highlights that it's a game of odds, not absolute certainties.
Yeah, so what does this all mean practically? The system works because it slightly tilts the odds from the house to the player, just slightly.
A small edge.
But the key is humility. Even with a statistical edge, like say a 2% edge over the casino still wins almost half the time. 49%, according to the source.
Yeah, that's crucial. You absolutely have to be prepared for those swings of bad luck.
So how do you prepare for that?
Well, this raises that important question. Kevin Lewis, who is a successful card counter, he emphasizes having enough money, enough capital, to withstand those bad swings.
Ah, the bankroll.
Exactly. A rule of thumb he suggests is having at least 100 basic units. So for example, if you start with $10,000, you could maybe comfortably play a $100 unit.
Okay, so you're cushioning yourself against the inevitable losses.
Precisely. It's not about avoiding loss, it's about making sure a loss doesn't wipe you out.
And this idea, this giving yourself room for error, it connects directly to Benjamin Graham's, classic concept of margin of safety.
Absolutely. It's acknowledging that uncertainty and randomness and just plain chance are, they're ever-present parts of life, always there.
It's really the only effective way to safely navigate a world governed by odds, not certainties.
And almost everything related to money exists in exactly that kind of world, almost everything.
Yeah.
And if we connect this to the bigger picture, forecasting anything with precision is just incredibly hard. It's obvious to a card counter looking at a deck, right? But it's somehow less obvious to someone asking about, say, stock market returns over the next 10 years. Or even setting a retirement date.
We want those definite answers, don't we?
We do. We tend to want black or white answers, but the smart way to proceed is really in that gray area, pursuing things where, a range of potential outcomes are acceptable.
But people underestimate this need for room for error in almost everything they do with money, it seems. Stock analysts give these precise price targets, not ranges. Economic forecasters predict exact GDP figures.
Yeah, down to the decimal point sometimes.
And let's be honest, pundits who speak with that unshakable certainty, they often get bigger followings than those who admit, look, we just can't know for sure.
There's definitely a psychological reason for this. Max Bazerman at Harvard, a psychologist, he showed that people overestimate their ability to accurately predict their own plans.
Oh, interesting. Like my own kitchen renovation?
Exactly. More than they overestimate someone else's renovation plans. It's driven by two things, really. First, that uncomfortable feeling of admitting you don't know the future.
Yeah, nobody likes that.
And second, this sort of perceived harm of not fully exploiting what looks like an accurate view of that future, even if it's probably flawed.
It's commonly seen as like a conservative hedge. Room for error is for people who don't want to take much risk. That's the perception.
Right, the cautious approach.
But our source argues it's actually, well, quite the opposite.
It is, because room for error lets you endure. It lets you withstand a range of potential outcomes. And endurance is just critical.
Why endurance specifically?
Because it lets you stick around long enough for those low probability but really big gains to eventually fall in your favor. The biggest opportunities, the biggest wins, they often happen infrequently, or they take a long time to compound.
You have to be in the game to win the game, basically.
That's it. Think about Bill Gates. He said he wanted enough cash in the bank to pay a year's worth of Microsoft's payroll, even if they got zero payments coming in.
Wow, a whole year. That's a serious buffer.
Or Warren Buffett, pledging to always run Berkshire with more than ample cash. He famously said he will not trade even a night's sleep for the chance of extra profits.
That's room for error in action right there. Big time.
Absolutely. And it's not just about the cash flow being positive. It's also about mental and emotional endurance.
Ah, okay. Tell me more about that.
Well, think about it. A 30% market decline, that can absolutely shoot your confidence. People quit investing after big losses, often not because they're technically broke,
Right.
but because they're just physically and emotionally exhausted,
Ah,
worn out by the stress and the second guessing.
that's a really powerful point. Spreadsheets, they're great with numbers, but they don't model how you'll feel at 2 a.m. wondering if you made a terrible mistake that's going to hurt your family's future.
Exactly. That gap between what you can technically endure on paper and what's emotionally possible for you, that's a huge, often overlooked version of room for error.
So how does this apply to something like, say, retirement planning?
Well, it applies directly. History shows the U.S. stock market has returned, an annual average of about 6.8% after inflation since the 1870s. That's the long-term number.
Okay, a standard benchmark.
And while that's a reasonable estimate to start with, what if future returns are lower? I mean, significantly lower.
Or what if your retirement date happens to fall right in the middle of a nasty bear market like 2009?
Exactly. Or you just get scared out near the bottom and miss the recovery of the next bull market. Happens all the time.
So this solution, according to our source, it's pretty simple.
It is elegantly simple. Just use room for error when you estimate your future returns. Build in a buffer.
How much buffer, though?
Well, the author admits it's more art than science. For their own personal investments, they assume future returns will be, get this, 1/3 lower than the historical average.
A full third lower. Wow.
Yeah. And because of that assumption, they save more. That's their margin of safety. It lets them sleep well at night.
It reminds me of that Charlie Munger quote, the best way to achieve felicity is to aim low.
That's it, precisely. It's about setting yourself up so you can still succeed even if things don't go perfectly according to plan, which they rarely do.
Now, there's a related idea here, isn't there? Something about optimism bias.
Yes, a close cousin of room for error is what the source calls optimism bias in risk-taking. Or maybe more vividly, the Russian roulette should statistically work syndrome.
Okay, that sounds bad.
It is. It's this dangerous attachment to favorable odds when the potential downside is just completely unacceptable. Ruinous.
Right.
Nassim Taleb talks about this. He says, you can be risk-loving and yet completely averse to ruin. And you should be absolutely averse to ruin.
So take risks, but not that risk.
Exactly. The idea is, sure, you have to take risks to get ahead, but no risk that can wipe you out, completely take you off the board, is ever worth taking. The odds are massively in your favor with Russian roulette, right? 5 out of 6.
Statistically, yes.
But the downside isn't just losing. It's total, irreversible ruin. The potential upside doesn't justify it. There's no margin of safety for that.
And the same applies to money. Lots of things usually work out. Real estate prices generally go up. Paychecks usually arrive.
Most of the time.
But if something has, say, a 95% chance of being right, that 5% chance of being wrong means you will experience the downside eventually if you play long enough.
Almost certainly, yeah. The improbable becomes probable over time.
And if the cost of that downside is ruin, the 95% odds just aren't good enough.
Not even close. And leverage, taking on debt to make your money go further, that's often the real devil here, as the source puts it. It pushes routine, maybe even manageable risks into something capable of producing utter ruin. Our sort of rational optimism most of the time can completely mask the odds of ruin some of the time. We
Yeah.
just systematically underestimate the real risk involved.
We saw this play out so brutally during the housing crisis, didn't we? Housing prices fell, maybe 30% nationally,
Hmm.
and those with high leverage, high mortgages relative to their home value, they faced what the source calls a double wipeout.
Explain that.
Well, not only were they broke, wiped out financially, but being wiped out meant they had absolutely no opportunity to get back in the game when things were cheap.
Ah, right. They couldn't buy low in 2009 or 2010.
Exactly. Homeowners in 2009 who lost their homes, or even huge firms like Lehman Brothers, they were just done. Game over. No chance to recover or capitalize.
So, to navigate this kind of extreme risk, the author thinks of their own money using an interesting analogy. It's barbelled?
Barbelled, like weights.
Yeah, exactly. Imagine a barbell. Heavy weights on each end and almost nothing in the middle. So they take risks with one portion of their money, maybe smaller high-growth bets,
Okay.
and are terrified, extremely conservative, with the other, much larger portion, safe assets.
So very risky and very safe, but not much in between.
Pretty much. It sounds inconsistent, maybe, but it's really about ensuring you can remain standing long enough for your risks, the ones you do take, to potentially pay off. You have to survive to succeed.
That ability to do what you want when you want for as long as you want,
Right.
the source says that has an infinite ROI.
It really does. It's the ultimate goal, isn't it? Freedom and control.
Now, room for error. It does more than just widen the target around what you think might happen. It also helps protect you from things you'd literally never imagine.
Yes, the
Yeah.
unknown unknowns. And these can be the most troublesome events we face precisely because we don't see them coming.
Okay, give me an example.
Well, consider the Battle of Stalingrad. There's this story, maybe apocryphal, maybe not, about a German tank unit being effectively defeated not by enemy fire, but by field mice.
Field mice? Seriously?
Yeah, the story goes they nested in the parked vehicles during winter and ate through the electrical insulation in the wiring harnesses.
No way.
Yeah, that was almost certainly unimaginable to the tank designers back in Germany. You can plan for anti-tank guns, you can plan for mud, but mice eating your wires.
That's wild. You plan for every risk except the things that are too crazy to even cross your mind.
And those crazy things can do the most harm because you have zero preparation for them.
Warren Buffett seemed to get this. In 2006, when looking for his replacement at Berkshire, he said he wanted someone, quote, genetically programmed to recognize and avoid serious risks, including those never before encountered.
Exactly. Not just the known risks, but the ones nobody's seen yet.
The source gives some almost comical modern examples, too, from startups its venture capital firm backed.
Oh, yeah. Like what?
Things like water pipes breaking and flooding entire offices, multiple break-ins, getting kicked out of manufacturing plants unexpectedly, a store being shut down by the health department because of a customer's dog.
A dog.
Yeah. Even a CEO's email being spoofed during a really critical fundraising round.
Huh.
Several of these were like existential threats to the companies.
Wow. And none of them were foreseeable.
Right.
Not in any business plan.
Exactly. You just can't predict that level of weirdness. Avoiding these kinds of unknown risks is almost impossible. You can't prepare for what you literally can't envision.
So the key way to guard against their damage, because you can't prevent the event itself, is to avoid single points of failure.
Okay, that makes sense. Don't put all your eggs in one basket.
It's a really good rule of thumb for life, actually. Everything that can break will eventually break. So if many important things rely on one specific thing working perfectly, and that one thing breaks, catastrophe is probably waiting.
Right. Like airplanes having redundant electrical systems, backup hydraulics.
Or suspension bridges being designed so they can lose quite a few cables and still not collapse. It's engineered resilience.
So bringing it back to money, what's the biggest single point of failure there?
For many people, it's probably a sole reliance on their paycheck to cover all their short-term spending needs, with absolutely no savings buffer.
So no gap between income and expenses, living paycheck to paycheck.
Exactly. No gap between what you think your expenses are and what they might suddenly become due to some unforeseen event.
And the trick here, which is often overlooked even by people who are quite wealthy,
Yeah.
is realizing you don't actually need a specific reason to save money.
Go on.
Like saving for a car or a house down payment, that's fine, obvious goals. But it's just as important, maybe more important, to save for the things you can't predict or name yet.
Saving for the unknown.
Exactly. Few financial plans that only prepare for the known risks have enough margin of safety built in to actually survive the chaos of the real world.
You know, in fact, I'd argue the most important part of every plan is planning on your plan not going according to plan.
That's a great way to put it. So, wrapping this up, whether you're a card counter trying to figure out the odds or just, a regular person planning for retirement decades down the line, the lesson seems pretty clear. Humility, acknowledging uncertainty, and deliberately building in that room for error. That can be your greatest asset. It's about constructing a robust foundation for yourself.
It really is. It's about building resilience,
No.
not just financially, but as we discussed, emotionally too.
Yeah.
So you can endure the inevitable bumps and swings of life.
Right.
And just stay in the game long enough for the odds eventually to fall in your favor. It's the ultimate long game strategy, really.
So what really stands out to you from this deep dive, maybe think about this. How might planning for your plan not going according to plan, how might that change your approach to the future? Definitely something to consider as you go forward. $1 million from their units to cover any potential earnings gap.
So effectively borrowing from the future to make the present look better.
It was a very clever way to create this powerful illusion of consistent, predictable growth. No surprises.
So under Welch's leadership, stockholders got exactly what many investors crave: consistency and predictability. A stock that just seemed to surge year after year without the messy surprises of uncertainty.
Right. They didn't feel like they were paying the price in real-time volatility. It felt smooth, easy almost.
But, as we've established, the bill always comes due, eventually.
And boy, did it ever for GE. In the years following Welch, GE shareholders suffered through roughly a decade of mammoth losses. Losses that were, in many ways, previously shielded or deferred by those accounting maneuvers.
So the penny gains of Welch's era
Became dime losses later on because the underlying issues, the real volatility and challenges in the businesses were never truly addressed in real time. They were simply papered over, hidden from view.
And it wasn't just GE playing this game, right?
Oh no, not at all. Think about the big mortgage giants, Freddie Mac and Fannie Mae, back in the early 2000s.
Right, before the financial crisis.
They were caught underreporting their current earnings by billions of dollars. And why? Precisely to spread those gains out over future periods.
To create that same illusion of smoothness and predictability.
Exactly. The illusion of getting the rewards without having to pay the price of normal business fluctuations. It never works in the long run.
Okay, so considering everything we've discussed, these hidden costs, GE saga, the investment volatility, the futility of trying to avoid it, it really begs the question, why? Why is it that so many of us who readily pay for everything from cars and houses to food and vacations seem to resist so strongly paying the seemingly invisible price for good investment returns?
It's a great question, and I think the answer is actually quite simple, maybe even psychologically obvious when you break it down.
Okay.
The price of investing success isn't immediately obvious. It's not like a physical price tag you see on a product in a store. There's no sticker on your portfolio saying volatility fee, 10% drop possible this year.
Right. It's hidden, implicit.
So when the bill does come due, when your portfolio value drops significantly, it doesn't feel like a known cost you agreed to pay. It feels like a fine, like a punishment.
Okay. Like a fine for doing something wrong.
Exactly. Think about a traffic fine, or worse, an IRS fine. What does that imply? It implies you messed up, you did something wrong, and now you're being penalized for it.
So the natural reaction is to avoid future fines.
Of course. If you view that market drop as a fine, your instinct is, how do I make sure this never happens again? Which leads to trying to time the market, or selling low, or avoiding stocks altogether, all the things that tend to hurt long-term returns. It's a fundamental psychological reaction.
That distinction is actually crucial, isn't it? It might sound like just semantics, changing a word, but thinking of market volatility as a fee rather than a fine. That seems like a really important part of developing the kind of mindset that lets you stick around long enough for investment gains to actually work in your favor.
It completely changes your perception. It's vital.
Yeah.
I mean, let's be honest, few investors can genuinely say, oh yeah, I'm actually totally fine if I lose 20% of my money. Especially newer investors who haven't lived through a major downturn, it sounds abstract until it happens.
For sure.
But if you can start to view that volatility not as a penalty for bad luck or bad timing, but as a fee you pay for the potential of higher long-term returns, things look completely different.
You used the Disneyland analogy earlier, which I thought was great. Can you walk through that again?
Sure. Think about Disneyland tickets. They cost, what, maybe $100, $150 these days? I don't even know, but it's a lot.
Yeah, definitely not cheap.
Right. But millions of people willingly pay that fee every year. Why? because they anticipate getting something incredibly valuable in return, an awesome day with their kids, memories they'll cherish forever.
They see it as a worthwhile trade-off.
Exactly. No one walks out of Disneyland feeling like that $100 ticket price was a punishment or a fine. They see it as the cost of admission for a great experience. The worthwhile nature of the fee is obvious when it's clear you're paying a fee for something desirable.
And you're saying it's the same logic with investing, just harder to see sometimes.
Precisely. Volatility, the ups and downs, the scary headlines, that is almost always a fee, not a fine. Market returns are never free, and they never will be. They demand you pay a price, just like any other valuable product or service.
And you have a choice.
You do. You're not forced to pay this fee, just like you're not forced to go to Disneyland. You can opt for the local county fair. Maybe the tickets are only $10 cheaper, maybe still fun.
Or stay home for free.
Or stay home for free, right? Keep your money in cash, perhaps. You might still have a perfectly fine time financially. Maybe you preserve capital, but you'll usually get what you pay for in terms of long-term growth potential.
So the volatility and uncertainty, that's the cost of admission.
That's the cost of admission if you want to access returns potentially greater than those you'd get from lower fee, lower risk options like cash or maybe some bonds. It's the price for playing in the higher return arena.
Okay.
The real trick, the ultimate challenge, is truly convincing yourself deep down that the market's fee is worth it.
Not just tolerating it, but accepting it.
More than accepting it, actively realizing that it's an admission fee worth paying for the potential long-term rewards. It's the only way to properly deal with the inevitable volatility and uncertainty without letting it derail your plans.
That's a really powerful way to frame it. So what this whole deep dive really boils down to, it seems, is that the most valuable things in life, whether it's leadership success, investment returns, maybe even relationships or skills, they often come with a hidden price. And it's not always monetary. It can involve discomfort, uncertainty, fear, regret, or simply the passage of time enduring difficulty.
Absolutely. And if you truly understand that, if you accept that the greatest rewards often demand a non-obvious fee, well, it raises an important question for you, our listener, to maybe mull over.
Okay, leave us with that final thought.
What areas of your own life thinking beyond just your finances now might be transformed if you could identify and then willingly choose to pay the often hidden costs of what you truly desire?
Welcome to the deep dive. Ever wonder why the experts, the people who seem to have all the answers, sometimes suggest one thing but then do something totally different themselves?
Oh, absolutely.
Well, today we're digging into exactly that. And it kind of starts with this really simple question from billionaire investor Sandy Gottesman. He asks, what do you own and why?
Just that. Sounds basic.
It does, right.
Yeah.
But it actually uncovers this huge, mile-wide gap sometimes between what logic says you should do and what people actually do in their own lives.
Yeah, and that's what we're exploring. This isn't just about financial spreadsheets or anything. It's really about how your own personal values, your unique situation, how that molds your decisions.
Often pushing aside the conventional wisdom.
Exactly. And we'll see why maybe following that personal gut feeling, that unspoken sense of what's right for you, might actually be the smartest way forward.
Okay, so let's pull back the curtain on this disconnect, because it shows up in some really interesting places, like with Sandy Gottesman. When he interviews people for his investment team, he doesn't ask for, market predictions or hot stock tips.
No complex models.
Nope. Just, what do you own and why? He's not after what you think is cheap, based on some analysis. He wants to know what you personally believe in enough to put your own money into. Your actual skin in the game.
Right. Your real commitment. And it's pretty wild how often that commitment seems to be, missing, even where you'd least expect it.
Like where?
Well, there was this Morningstar study. It found that half of all U.S. mutual fund managers don't invest a single penny of their own cash in the funds they actually manage for other people.
Wait, half? That seems, I don't know, counterintuitive, almost hypocritical.
It feels that way, doesn't it? But the source suggests maybe it's less about hypocrisy and more just common. This gap between professional advice and personal practice, it happens more than you'd think.
And it's not just finance, right? You see it in other fields, too.
Definitely. Think about doctors. There was this really powerful essay back in 2011 by Dr. Ken Murray, How Doctors Die.
Oh, I think I remember hearing about that.
Yeah, he's a professor at USC. And he found that when doctors themselves are facing, the end of life, a terminal illness, they often choose very little medical treatment.
Really? Less than they might recommend?
Often, yeah. They tend to opt for palliative care, comfort, managing symptoms, focusing on, as he put it, going gently, often at home with family. It's quite a contrast to the sometimes very aggressive, do everything approach they might offer patients.
Wow. So why the difference? Why do they choose one path for themselves and maybe suggest another for others?
Well, that really gets to the core of it. For these incredibly complex, deeply emotional issues, end of life care, big financial choices, the source argues pretty convincingly that there just isn't one universal truth. There's no single right answer that fits everyone.
Okay, so it's more personal.
It's entirely personal. It's about what works for you, for your family, what lets you feel okay, what helps you sleep at night. These big decisions, they're not just numbers on a page.
They're made around the dinner table, you mean?
Exactly. Often driven by wanting to avoid regret later or protect your family, not just chasing the absolute highest return possible on paper.
So, okay, if that's the case,
Right.
what does financial success really even look like then? Because it sounds like it's not just about piling up the most money.
Precisely. The philosophy we're really digging into today isn't just about getting rich or beating the market. It's something more fundamental. It's the pursuit of independence.
Independence, okay.
Yeah, the legendary investor Charlie Munger, he
Hmm.
put it so well. He said, "I did not intend to get rich. I just wanted to get independent."
That's a really interesting shift. It's not about the dollar amount, but the freedom it buys you.
Exactly. The freedom to choose, to control your own life, your own time. That's the real prize.
So independence means what? Like being able to walk away from a job you don't like?
That's a huge part of it. The source defines it as doing only the work you like with people you like at the times you want for as long as you want. And they share this really powerful story about the author's dad. He was an ER doctor, high stress, obviously, worked in it for 2 decades, and then one day, at age 40, he just quit.
Just like that.
Just like that. Because he could. And that ability, that power to just wake up and decide, okay, I'm changing things starting today, completely on your own terms whenever you feel ready. I mean, that feels like the ultimate financial goal, right?
Yeah, the source called it the grandmother of all financial goals. I like that.
Me too. And here's the kicker.
What's that?
Achieving that kind of freedom, that independence, it doesn't necessarily require a huge income like an ER doctor's.
Really? So how does it work then?
The real driver, the engine behind independence, isn't so much your income level, but your savings rate, how much you're putting away.
Okay, savings rate. Makes sense.
And once you're earning, a decent living, what mostly controls your savings rate isn't getting a raise, it's your ability to keep your lifestyle expectations from constantly inflating, keeping things in check.
Avoiding lifestyle creep.
Exactly. Which leads to this idea they call stopping the goalposts.
Upping the goalposts.
Yeah. The author and their spouse, they had rising incomes for over 10 years, one in finance, one in healthcare, but they consciously decided to pretty much stick with the same moderate lifestyle they had when they were just starting out.
So, decent apartment, decent car, decent food. Nothing too fancy.
Right. They found it comfortable. They just didn't feel the need to constantly upgrade everything as their paychecks got bigger. They essentially said, okay, this is good enough. Let's stop moving the goalposts for what enough means.
And because they did that.
Because they did that, almost every extra dollar they earned from raises didn't just get absorbed into spending more. It went straight into savings, into their independence fund, as they call it.
So their savings rate just kept going up and up.
Continuously. It wasn't about being stingy. They just weren't particularly motivated by more stuff. Their aspirations kind of plateaued in that area, so they just let the goalposts sit there.
That takes discipline, though.
It does, but think about the psychological benefit. By choosing not to constantly upgrade, you sidestep that whole exhausting game of keeping up with the Joneses.
Yeah, that relentless comparison trap.
Exactly. Nassim Taleb, the author, has this brilliant line. True success is exiting some rat race to modulate one's activities for peace of mind.
Peace of mind. That's a huge win, often totally overlooked.
Enormous. And it frees you up to make decisions that might look, let's say, irrational if you're only looking at spreadsheets.
Okay, like what kind of decisions?
Well, take their choice to own their house outright. No mortgage.
No mortgage. But interest rates have been so low for ages. Financially, that seems questionable.
Oh, they totally admit it. The source says flat out, on paper, it was probably the worst financial decision they made. Any advisor would say, leverage that cheap debt. Invest the difference in stocks for higher returns.
Right. Standard advice.
But for them, it wasn't about the math. It was about feeling secure.
Yeah.
Independent. Getting rid of that monthly mortgage payment gave them this incredible sense of freedom that they valued way more than potentially higher, but also less certain, investment gains.
So it comes back to that choice. Do you want to be happy or do you want to be technically right, according to the spreadsheet?
Exactly. And they chose happy or maybe secure. Another example. They keep a really high percentage of their assets in cash.
Cash, like just sitting there.
Yeah, something like 20% of their investable assets outside of their house value, just cash. Which, again, from a pure investment return
It's
perspective,
hard to defend. You're losing out on potential growth.
totally indefensible on paper, but they don't see it as idle cash losing to inflation. They call it the oxygen of independence.
Oxygen of independence. How so?
Because having that buffer means they are never, ever forced to sell their growth investments, their stocks at a bad time just because some unexpected large expense pops up.
So it protects the long-term investment.
Precisely. It lets the compounding keep working. Remember Charlie Munger again. The first rule of compounding is to never interrupt it unnecessarily. Their bedrock belief is that everyone eventually faces some huge expense they didn't see coming.
A medical bill, job loss, roof caves in.
Something. And that cash reserve makes it much, much more likely they can ride out that storm without having to wreck their long-term investment plan. It lets compounding do its magic over decades.
Okay, so this focus on independence, on sleeping well, on avoiding forced selling. How does that shape their actual investment portfolio? What do they own?
It's led to, well, simplification. The author mentions that back in their 20s, they used to be an active stock picker, holding maybe 25 different individual stocks.
Trying to beat the market.
Yeah, the usual goal. But now they own only low-cost index funds.
It's just index funds,
Yeah.
like S&P 500 trackers.
Pretty much broad U.S. and international index funds. The shift happened because they came to believe that for most people, trying to pick winning stocks or time, the market is just low odds.
The odds aren't in your favor.
Right. They figure just consistently investing, dollar cost averaging, into a simple, low-cost index fund gives you the highest probability of long-term success.
And the data kind of backs that up, doesn't it?
Yeah, it really does. That stat they mentioned, 85% of large-cap active fund managers failed to beat their benchmark, the S&P 500, over the decade ending in 2019. That's pretty telling.
So it's like trying to become a pro athlete. Some people can do it, but...
But the odds are stacked against most of us. So why take on the extra risk and effort if a simpler approach works well?
So their current strategy is just straightforward.
Remarkably so. Invest regularly from each paycheck into those broad index funds. Max out retirement accounts like 401ks or IRAs. Contribute to 529 plans for the kids' college savings.
Yeah, that's it. No complex trades, no chasing trends.
That's pretty much the extent of the effort. It comes from this belief that there's actually very little connection between how much effort you put into investing and the results you get.
Really? Less effort can be okay.
They argue yes, because market returns are often driven by tails, meaning a few really big winners or a few major events account for the vast majority of the overall long-term gains. Trying to micromanage constantly doesn't necessarily help you capture those.
So keep it simple, stay consistent, let compounding work, and have that cash buffer for emergencies.
That seems to be the core strategy, because if you can reach all your financial goals, achieve that independence, without the stress and risk of trying to outperform everyone else, why wouldn't you?
Makes sense. The ultimate goal isn't beating the market.
Nope. The ultimate goal is independence. It's maximizing your ability to sleep well at night. And that, they argue, is the real mastery of the psychology of money.
Wow. So this whole deep dive really drives home that there isn't just one right way to handle your money or your life, really.
Absolutely not. We saw it with Gottsman's question, with the doctor's personal choices, with this family focusing squarely on independence. It's all about how deeply personal values and priorities shape everything.
Yeah, the path to feeling financially secure, it isn't always about chasing every last dollar or maximizing returns on paper.
Often, maybe more often, it's about finding what genuinely gives you peace of mind, what allows you to live life on your own terms.
It comes back to that quote from the source. No one is crazy. People do things that make sense to them, given their own experiences and goals.
Exactly. So, as we wrap up, maybe the question for you listening is, what really stood out to you from this look at the psychology of money? And how might your own definition of financial success, your own path, look different from what the traditional advice might say? Welcome to another deep dive. Today, we're plunging into a topic that really touches everyone, how we navigate financial decisions. We often look for the right answers, don't we? But what if, maybe, the best approach comes from somewhere totally unexpected, like, say, medicine, Yeah, we've got some really fascinating material here for this deep dive. Excerpts from a text that, well, it promises to tie together key lessons for making better financial choices. So, our mission today is to unpack these insights for you. And we're going to focus particularly on this surprising historical story that really illustrates the dangers of just being told what to do, especially with your personal journey.
It's really compelling, actually, how this source kicks off with something that seems totally unrelated, an old anecdote, but it just perfectly sets the stage for this critical discussion about autonomy, about decision making, and what it actually means to be well informed, whether that's health or finance.
Okay, let's get into it then, because to really get the author's point, we need to go back, way back, to 1931, and specifically to a dentist appointment that just went horribly tragically wrong. So, picture this. 1931, a man, Clarence Hughes, he's in agony, terrible toothache. He goes to the dentist. The dentist uses what they called back then crude anesthesia. So Clarence wakes up hours later. The toothache is gone, sure, but he finds out he's also missing 16 teeth. And kind of randomly, his tonsils are gone too.
Wow.
Yeah. And then the real tragedy hits. A week later, Clarence dies from complications. From that, extensive surgery he never actually asked for.
And you'd think, okay, medical malpractice lawsuit, right? But his wife's lawsuit wasn't really about that. It was about something, well, more fundamental, lack of consent. Her point wasn't that the surgery itself failed. I mean, that was a risk back then, a known risk. It was that Clarence never agreed to have 16 teeth pulled or his tonsils out, and probably wouldn't have if he'd been conscious and asked.
And the legal side of things in 1931, well, it was pretty murky on this. Consent wasn't exactly clear-cut. The case didn't really go anywhere. And one court ruling sort of summed up the thinking at the time. It said doctors needed, quote, freedom to make the best medical decisions.
Right.
And get this, it added, without such, we could not enjoy the advancement of science.
That ruling,
Yeah.
it really shows you the mindset, doesn't it? The historical medical thinking. For like most of history, the doctor's job was just seen as fix the patient. Simple as that. What the patient actually thought about the treatment. Often totally irrelevant. And, it wasn't necessarily doctors being arrogant or malicious. It came from this really deep belief in two things. First, every patient wants to be cured. Okay, seems reasonable. And second, there is a universal and right way to cure them. Now, if you truly believe both those things, then minimizing patient consent, well, it actually follows a certain, albeit strange logic. Sounds jarring now, but back then.
But that's obviously not how medicine works today, thankfully. And the source material we're looking at uses this shift beautifully. There's been this maybe subtle but really profound change in medical schools over the last, say, 50 years. They've moved from just treating the disease toward treating the patient. And that means something fundamental changed. Doctors started laying out the options, explaining the choices. And then, this is the key part, letting the patient decide which way to go.
Yeah, and that massive shift. It was driven by a few things. New patient protection laws played a part for sure, but also the really influential work of a Dr. J. Katz. Katz argued very powerfully that patients, well, they have wildly different views about what's worth it in medicine. What's an acceptable risk for you might be totally unacceptable for someone else, right? Different values, different life situations. So their beliefs, their personal context, it has to be part of the decision.
Yeah, Katz had this quote. It's really powerful, gets right to the core of it. He said, "It is dangerous nonsense to assert that physicians can rely on their benevolent intentions, their abilities to judge what is the right thing to do. It is not that easy. Medicine is a complex profession, and the interactions between physicians and patients are also complex." That last bit. Interactions between physicians and patients are also complex. That feels incredibly important, don't you think?
Absolutely. It's not just the science.
Right. It's the human element.
Exactly. It means even if a doctor means well, their judgment can't just override the patient's autonomy, because only the patient really knows what's worth it for them. And this wisdom from medicine, this focus on the individual, it maps so perfectly onto financial advice. Just like a good modern doctor doesn't just dictate treatment, the author of our source material says, look, I'm not going to tell you exactly what to do with your money. They explicitly avoid treating you like that dentist treated Clarence Hughes.
And that distinction is just crucial. It's not saying doctors or financial advisors are useless now. Not at all.
Yeah.
They have huge amounts of knowledge. They know the odds. They know what generally works for most people, most of the time. But at the end of the day, you, the individual, you have to decide what's right for your specific, unique situation. Like our source says, there are universal truths in money, sure, but people will apply them differently. And they should apply them differently, based on their own goals, their values, their circumstances.
Okay, so with that kind of groundwork laid, this idea of autonomy and context, our source then gives us a series of short recommendations,
Mm-hmm.
but they're not rules, not prescriptions. Think of them more like guideposts,
No.
really helpful ones. They're designed to help you navigate your financial life, respecting all that complexity we just talked about. Just like a good doctor helps you choose your treatment.
Right. So let's dive into these guideposts. The first one that really jumped out at me, and maybe it sounds a bit, I don't know, counterintuitive, it's humility and forgiveness. The author says you need to really make an effort to find humility when things go right and offer forgiveness or compassion when they go wrong because they say it's never as good or as bad as it looks.
Absolutely. And it's not just about, being nice to yourself, although that's part of it. It's about really understanding that outcomes, well, they're a mix, aren't they? Your effort, your skill, sure, but also just chance, randomness,
Yeah.
luck, and risk. So things go well. Okay, maybe it wasn't all you. Things go badly. Probably not entirely your fault either. Understanding that helps you avoid getting overconfident when you win and beating yourself up too much when you lose, which is, essential for staying sane long term.
That's such a critical point. It changes how you judge yourself, sure, but also how you judge others and who you pick as role models.
Yeah.
Which kind of leads into another big one, less ego, more wealth. The author puts it bluntly, saving money is the gap between your ego and your income. What do you make of that?
Oh, it's spot on. Because wealth itself, often it's the money you don't spend. It's built by resisting the urge to buy something today so you have more options or more security later on. We tend to think wealth is the fancy car, the big house, the stuff we see.
Yeah, the visible stuff.
Exactly. But true wealth is often quiet,
Yeah.
invisible. It's accumulated savings, investments. It's about delaying gratification, prioritizing the future over showing off now. It doesn't matter how much you earn, really. If you can't manage that gap between your income and your ego, you won't build lasting wealth.
That really drives it home. Wealth isn't just a number, it's a behavior, a mindset. And speaking of mindset, here's a great guidepost. Manage your money in a way that helps you sleep at night, which is very different from just saying get the absolute highest returns possible, isn't it?
Totally different, yeah. A lot of finance advice focuses purely on maximizing returns.
Yeah.
But this source suggests that prioritizing your peace of mind,
Right.
that might actually be the best universal guidepost for everyone. It just acknowledges that we're all different. Different risk tolerance, different life stages, different emotional reactions to money swings. If your financial plan keeps you up at night, worrying constantly, even if it looks great on paper, it's probably not the right plan for you.
Mm-hmm.
It goes back to treating the patient, not just the numbers.
Makes perfect sense. Your finances should support your life, not cause constant stress. Okay, and for investors specifically, the author highlights the single most powerful tool they have, increase your time horizon.
Time. It really is the magic ingredient in investing, isn't it? It lets compounding work its wonders, turning small amounts into bigger ones. And just as importantly, it smooths out the bumps. Big mistakes. They tend to fade in importance over decades. Market crashes. You have time to recover. The longer you stay invested, the more your results tend to move closer towards what people deserve, meaning closer to the market's long-term average growth. It irons out the volatility.
Gives good decisions time to pay off, and bad ones less impact.
Exactly.
Which is a nice segue to another key piece of advice. Be okay with a lot of things going wrong. The source says you can actually be wrong half the time and still make a fortune. How does that work?
Well, it's because in finance, especially in investing, outcomes aren't evenly distributed.
Mhm.
It's often what they call a power law or Pareto principle. A small number of things drive the majority of the results. Think about venture capital.
Right, they expect most investments to fail.
Yeah, they might have tons of investments that go nowhere or even lose money,
Mm-hmm.
but one or two huge winners, Google and Amazon, can make the entire portfolio incredibly successful. So, the lesson is, judge your overall performance, your full portfolio, not individual bets. Fixating on single stocks or single decisions can lead you astray. You might ditch a strategy too soon or think one lucky pick makes you a genius.
It's about the overall average and surviving the inevitable losers to benefit from the big winners.
Precisely. You have to endure the bad to capture the good.
Enduring. That connects perfectly to the next idea. Worship room for error. This gap between what could happen
Yeah.
and what you need to happen. That's how you endure, right?
It's such a crucial concept, and maybe a bit counterintuitive again. Our instinct is often to push things to the limit, optimize everything for maximum gain.
Yeah, squeeze out every last drop.
This guy post says, no, hold back a bit. Build in a buffer, room for error, having savings beyond your immediate needs, not being fully leveraged. Having flexibility might look like you're being too conservative, like a hedge that costs you potential gains. But it's what keeps you in the game when the unexpected happens. A job loss, a market crash, a global pandemic, whatever life throws at you. And staying in the game is how you let that compounding magic happen over the long run.
Yeah.
So that buffer pays for itself many, many times over. It's not just caution, it's strategic endurance.
I love that framing. Endurance, not just caution. It changes how you think about it. Okay, and then the author wraps up with a couple of ideas that bring it right back to that personal context we started with. Define your game and respect the mess.
Yeah, these are so important for navigating the real world of money. Define your game means understanding your goals, your time horizon, your risk tolerance, and crucially, making sure your actions are not being influenced by people playing a different game.
Oh, that's huge today with social media and everything, seeing people flashing cash or hyping stocks.
Exactly. It's so easy to get caught up in what others are doing. FOMO, right?
Yeah.
Fear of missing out. But if that person is, say, a day trader playing with money they can afford to lose, you're saving for retirement in 20 years. You're playing totally different games. Following their moves could be disastrous for you.
Right. You need blinders, almost. Focus on your own path.
And then respect the mess. This acknowledges that even smart, well-informed, reasonable people can look at the same financial situation and come to completely different conclusions.
Why?
Because, as the source says, people have vastly different goals and desires. What's right for one person is wrong for another. So, there often isn't one single right answer in finance. Accepting that messiness leads to less judgment, both of others and yourself, and probably more effective playing for your own situation.
Wow. Okay, this has been a really, really illuminating deep dive. It shows the financial wisdom. It's not just about the numbers, is it? It's so deeply tied into understanding ourselves, human behavior, our values, even these big historical shifts in how experts think.
Absolutely. And if you connect it all back, that journey in medicine, from a doctor just telling a passive patient what to do to a doctor collaborating with an informed patient, that journey really mirrors the path we should be taking in finance. It's about knowing the general principles, the universal truths, sure, but always, always applying them with a deep respect for your own individual context, your own specific goals.
Which brings us nicely to our final thought for you, the listener, to maybe chew on. In this world that's just overflowing with financial advice, how do you actively, consciously define the game you're playing? And how do you make sure your decisions truly line up with your goals, your desires as they are now and as they might change, rather than just following someone else's playbook?
And building on that, maybe ask yourself this: how can you intentionally cultivate that room for error in your own financial life? Not seeing it as, just being overly cautious or missing out, but embracing it as the actual foundation. The thing that gives you endurance, the thing that lets that long-term compounding magic truly work for you.
Lots to think about there. Thank you for joining us on this deep dive. Until next time, keep digging for those insights. Okay, imagine this for a second. You fall asleep in, say, 1945. Then you wake up in 2020.
Whoa.
Right. I mean, the shock would be incredible. You'd see this staggering wealth in places like New York, San Francisco, but then, devastating poverty in Detroit, and the prices, homes, college, healthcare. It would make absolutely no sense.
Yeah.
And maybe the biggest thing, how average folks think about money, saving, spending. Totally different from back then.
Yeah.
And I bet any story you try to tell yourself about how we got from A to B, it'd probably be wrong. You just couldn't have predicted it. So, yeah, how did we get here?
That really is the essential question, isn't it? If you want to understand the modern consumer's mindset, even get a handle on where the economy might go next, you really have to trace that journey back.
Okay.
So that's what this deep dive is about. We're going to explore the story, the narrative of the American consumer, really starting right after World War II. We'll link the big events, try to show why we think about money the way we do today.
And why those ideas are so sticky, maybe.
Exactly. Why they're so hard to shake off, even when things change.
All right, let's do it. So we start August 1945. Japan surrenders. New York Times calls it the happiest day in American history. Just pure joy everywhere.
Absolutely. Parades, celebrations.
But then, once the cheering stops, this big question mark starts hanging in the air. What happens now?
And that wasn't just a casual question. It was loaded with anxiety. For policymakers, for regular Americans, everyone.
Because the scale was just enormous.
Think about it. 16 million Americans served.
Yeah.
That's like 11% of the whole population then.
Wow.
8 million were still overseas when the war ended. And almost all of them, barring maybe 1.5 million, were going to be home at a uniform within 18 months.
So the immediate fear was...
Three huge things. Where are they going to live?
Right.
And what jobs they're going to do.
Right.
A lot of people, smart people, economists, genuinely thought, here we go again, back to the Great Depression, which, remember, had only really ended 5 years before. That fear was palpable.
And you can imagine, with that depression shadow looming, policymakers must have felt immense pressure. What were the specific things staring them in the face, like the concrete problems?
Well, for starters, housing. Construction basically stopped during the war. Everything went to the military effort.
Sure.
In 1943, they were building fewer than 12,000 homes a month. That's nothing. So GI's coming home. Massive housing shortage.
Okay, so that's shelter. What about work?
Millions of jobs have been created just for the war. Building ships, tanks, planes, highly specialized stuff.
Right.
And those industries, they shut down almost overnight. Boom. Gone. Not like a normal business cycle downturn.
So policymakers were genuinely worried.
Deeply. The Council of Economic Advisors wrote a report for President Truman in '46 warning of, quote, a full-scale depression.
Wow.
There's another memo from '47 summarizing a meeting with Truman talking about the danger of a downward spiral.
And they couldn't just, like, export their way out of it?
Not easily. Europe's economy was wrecked. Japan's too. So export markets weren't there. And America itself. Record levels of debt from the war. So massive government stimulus wasn't really an option either.
Okay, so faced with this, this potentially catastrophic situation, what did they do? What levers did they pull?
This is where it gets really interesting. You see this very deliberate policy choice emerge. Keep interest rates incredibly low.
How low?
Well, the Fed had announced back in '42 during the war that they'd keep short-term rates pegged at 0.38% to help finance the war, right?
0.38. That's
Correct.
basically zero.
Pretty much. And here's the kicker.
Yeah.
Those rates didn't move for 7 years.
7 years.
Yep. 3-month Treasury yield stayed under 2% all the way until the mid-1950s.
So was that just inertia from the war financing, or did they realize, hey, this cheap money could be useful?
That's the key point.
Yeah.
It started as war finance, but it quickly became clear that these rock-bottom rates made borrowing super cheap for houses, for cars, for all the new gadgets people wanted.
So it became a strategy.
An explicit economic strategy, yeah. The historian Sheldon Garin talks about this shift. We went from this wartime culture of save, 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 buy war bonds to actively encouraging people to spend. Cheap borrowing was the engine.
And there were two huge things that really poured fuel on that fire, right?
Absolutely. First, the GI Bill. Just transformative.
How so?
It gave those 16 million veterans access to mortgages like never before. Often zero money down, no interest for the first year, fixed rates so low your mortgage payment could actually be less than rent.
Unbelievable. And the second thing?
An explosion in consumer credit. They started loosening the regulations that had been put in place during the Depression.
Okay.
You get the first real credit card, Diners Club in 1950. Then store credit, installment plans, personal loans, payday loans. It all just took off.
And you mentioned a crucial detail before about taxes.
Right. Until 1986, the interest on all debt, including your credit card debt, was tax deductible.
Out. Seriously.
Seriously. Think about the incentive that creates to borrow and spend. It's baked right into the tax code for decades.
Okay, so that really sets the stage. You've got cheap money, easy credit, and after the war, all this pent-up demand. People hadn't been able to buy stuff for years.
Exactly. Factories were making tanks, not toasters.
Yeah.
So households were starved for goods.
Were there other factors boosting this spending wave?
Yeah, there was this sort of hidden productivity gain that came out of the Depression.
How does that work? Hard times make you more productive.
In a way, yeah. The 1930s, tough as they were, forced incredible resourcefulness, efficiency, innovation, just to survive.
I see.
So you had all these advancements bubbling under the surface, better appliances, cars, phones, air conditioning, wider electricity access. It wasn't obvious during the Depression or the war, but by the 50s, America realized, hey, we're actually really good at making stuff now. We've got all these cool new things to make.
And people just went on a massive shopping spree.
Colossal. Give you some numbers. Commercial car and truck production. Basically zero from 42 to 45.
Right?
Then, between 45 and 49, 21 million sold. Another 37 million by 1955.
Whoa! And houses.
Same story. Fewer than 2 million built between 40 and 45. Then, 7 million from 45 to 50, another 8 million by 1955.
It's hard to even picture that scale of building and buying. It's not just economics, it's like the physical landscape of the country changing.
Completely. And think about the jobs. All those returning GIs needed work. What did they do? They got jobs making all this new stuff.
Right.
And they earned good money doing it.
Oh.
The Fed told Truman in 51 that by 1950, consumer spending in home building hit $203 billion. That's about 40% higher than the peak of the war effort in 44.
So the answer to what will the GIs do was basically they'll build the suburbs, fill them with stuff, and buy cars to drive between them.
Pretty much. They were buying stuff with money earned, making new stuff, often helped by cheap loans to buy even more stuff. It was a powerful cycle.
So this post-war boom takes off. What was the kind of social vibe? Was everyone getting rich or was it uneven?
You know, what's really remarkable about that period, roughly 1950 to 1980, is how much the country got richer together.
Shared prosperity. You hear that term a lot.
And it was real then. The gap between the rich and the poor actually narrowed significantly.
How so?
Well, look at the top 1% share of national income. After taxes, it fell from about 13% down to 7% by 1945. And get this, from 1950 to 1980, the real income growth for the bottom 20% of earners was almost identical to the growth for the top 5%.
That's incredible. So people really felt like they were moving up together.
Exactly. And it wasn't just income. It was social leveling, too. Women entered the workforce in much greater numbers. Participation went from 31% after the war to 40% by 1965.
Ever.
Minorities saw gains, too. Eleanor Roosevelt wrote about seeing an African-American reporter at a White House reception in 1945, mixing easily, something she said would have been unthinkable just 12 years earlier.
And lifestyles became more similar.
Yeah, Harper's Magazine wrote in 57 something like, "The rich man smokes the same cigarettes as the poor man, uses the same razor." There was this sense of shared experience. But Paul Graham made a great point years later about TV. Back then, there were basically 3 networks. So every night, tens of millions of families, neighbors, were watching the same shows, laughing at the same jokes. What we see now only with the Super Bowl. That used to happen every night. We were literally, as he put it, in sync.
That's a powerful image. And it matters, right? Because we judge our own well-being by looking at the people around us.
Absolutely crucial. For most of that 45 to 80 period, most people saw their neighbors, their co-workers, living lives that felt, similar, or at least understandable, relatable, not wildly different.
So with all this shared growth, how did debt fit in? Were people still scared of it after the Depression?
You'd think so, but no. Household debt actually surged. It increased 5-fold between 1947 and 1957.
Wow. Why?
Well, that new consumer culture we talked about.
Yeah.
All the new things to buy. Plus, all those new ways to borrow money, credit cards, installment plans, and crucially, those super low interest rates, often subsidized.
But didn't cause problems.
Largely, no. Not then. Because incomes were rising so strongly across the board, people could handle the payments. And remember, people started from a very low base of debt. The Depression wiped a lot out, and wartime rationing and saving had kept borrowing down.
So debt was rising, but income was rising too.
Exactly. Even with that 5-fold increase, the overall household debt-to-income ratio stayed below 60% right up until the late 1970s.
Which is way lower than today.
Oh, much lower. Today it's over 100%, and a lot of that debt was going into homes. The homeownership rate just took off. It was 53% by 45, hit 62% by 1970. Millions became homeowners who couldn't have before.
So this generation just had a different attitude towards debt.
Completely different from their parents.
Yeah.
David Halberstam wrote about this in his book, The 50s. He said they were confident, optimistic. They didn't fear debt like the generation that lived through the Depression. They felt like, the good times were here to stay. The future had already arrived, as he put it.
It sounds like a golden age in a way. America booming, doing it together, debt manageable, but obviously it didn't last forever.
No. The story definitely takes a turn. Around 1973, you start seeing the cracks appear.
What happened in 73?
Well, a recession hit, and it was nasty. Unemployment shot up to levels not seen since the Depression. Inflation, which had been around, suddenly surged and just stuck around. It became persistent.
Stagflation.
Exactly. And interest rates started climbing too. Short-term rates hit 8% in 73. Remember, they were down around 2.5% just 10 years earlier.
And this wasn't happening in a vacuum, right? There was other stuff going on.
A lot of other stuff. The hangover from Vietnam.
Right.
Riots in cities.
Mm-hmm.
The assassinations of the king, the Kennedys. There was a sense of unease, instability.
Plus, America wasn't the only economic game in town anymore.
Right. Japan's economy was booming, becoming a real competitor. China was starting to open up. The Middle East realized the power it had with oil. The oil embargo hit in 73 too. America's unquestioned economic dominance started to fade.
So those post-war tailwinds were dying down. The economic ride got bumpier.
It got uneven. That's the key word.
But, and this seems crucial, people's expectations didn't change overnight, did they? That idea of shared prosperity, of living like your neighbors.
That's the critical disconnect. The economic reality started to shift, become less equal, less certain. But the cultural expectation, forged in those post-war decades, the expectation that your life shouldn't be dramatically different from the people up the income ladder that persisted.
That idea that, the 50th percentile and the 90th percentile shouldn't live in totally different worlds.
Precisely. That expectation lingered, even as the economic foundations for it were starting to erode.
And this is where that lag you mentioned comes in, expectations moving slower than reality. Because the economy did bounce back in the 80s, right? Morning in America.
Oh yeah, the 80s saw strong growth. Reagan's 84 ad wasn't just spin, GDP growth was high. And the 90s too. Bill Clinton, in his 2000 State of the Union, bragged about 20 million new jobs, fastest growth in 30 years.
And the overall growth numbers were actually pretty similar to the 50s.
Roughly, yeah. Total real GDP growth in the 90s was about 40% compared to 42% in the 50s. Pretty close.
So if the amount of growth was similar, what was the big difference?
The big difference was who got that growth. It flowed into, as one writer put it, totally different pockets.
Yeah, inequality.
The Atlantic had a piece showing that between 93 and 2012, the top 1%'s incomes grew over 86%, the bottom 99%. Just 6.6% growth.
Wow, that's a huge divergence.
Huge. Joseph Stiglitz pointed out in 2011 the top 1% saw incomes rise 18% in the prior decade. Meanwhile, middle-income folks actually saw their incomes fall, especially men with just a high school degree down 12%.
Okay, so you've got this sharp rise in inequality happening right when people still hold on to those two big post-war ideas. One, you should live kind of like everyone else. And two, it's okay to use debt to get there. That sounds like a recipe for trouble.
It's the recipe for what some people call the big stretch.
The big stretch.
Yeah. As the incomes of that top group soared, their lifestyles pulled away. Bigger houses, fancier cars, private schools, elaborate vacations.
And everyone else is watching this.
Everyone else is watching. First through glossy magazines and TV ads in the 80s and 90s, later amplified massively by the internet and social media. That old keeping up with the Joneses impulse, which only kind of innocent when everyone's income was rising together.
It becomes something much more stressful when the gap widens.
Exactly. It becomes almost impossible to keep up without stretching financially, usually with debt.
Can you give us an example? Make it concrete.
Sure. Think of, like, Joe. He's an investment banker, making, say, $900,000 a year. He buys a 4,000 square foot house, leases 2 new Mercedes, sends his kids to Pepperdine. He can afford it.
Okay.
Then there's Peter. He's a bank branch manager, makes $80,000. Decent income, but nowhere near Joe's. But Peter sees Joe, sees that lifestyle, feels that pressure.
The pressure to keep up appearances.
Right. So what does Peter do? He takes out the biggest mortgage the bank will give him for a house that's maybe too big. He racks up $45,000 on credit cards. Leases 2 cars he can't really afford. His kids end up graduating with a mountain of student loan debt. He's stretching.
Yeah.
Trying to maintain a semblance of that upper middle class lifestyle that's drifting further away from his income level.
And the data shows this wasn't just anecdotal.
Oh, the numbers are clear.
Yeah.
The median size of a new American home grew by 50% between the early 80s and the 2000s, even while median wages were basically flat.
50% bigger.
Yeah. And nearly half of new homes had 4 or more bedrooms by the 2000s, up from just 18% in 1983.
People were buying way more house than they used to.
Way more house. And cars, too. The average inflation-adjusted car loan, it more than doubled between 1975 and 2003, went from about $12,300 to nearly $28,000.
Wow.
Plus, the explosion in college costs and student debt we all know about.
So all this stretching meant more debt.
A lot more debt. That household debt-to-income ratio, it climbed from that sub-60% level in the 70s past 100%, hitting over 130% by 2007.
Even while interest rates were coming down in the 90s and 2000s?
Even then, because people were borrowing so much more. And critically, the burden wasn't shared equally. Lower-income households ended up spending a much larger chunk of their income servicing debt, like 14% for the lowest income groups versus 8% for the highest.
That just feels unsustainable.
It was. It brings to mind the economist Hyman Minsky. He talked about how debt crises start. It's that moment when people or systems have taken on more debt than they can actually handle.
The Wile E. Coyote moment.
Exactly. You're running along, everything seems fine, then you look down, realize there's nothing under you, and gravity takes over.
Which is pretty much what happened in 2008.
Precisely. The great financial crisis.
Okay, so 2008 happens, huge crash. Afterwards, people did pay down some debt, deleveraged a bit, and interest rates went to near zero again. Household debt payments are actually lower now relative to income than they've been in decades.
That's true, on average.
But did the policies put in place after the crash fix the underlying problem? Or did they maybe even reinforce some of those inequality trends?
That's a really important and kind of controversial point.
Yeah.
The policies were arguably necessary to stop a complete meltdown, a second Great Depression.
Right. Things like quantitative easing, bailouts.
Exactly. But those policies, while maybe necessary, did tend to benefit asset owners more than wage earners. QE boosted stock prices and real estate helps people who own those things.
Which tend to be wealthier people.
Generally, yes. The Fed stepping in to backstop corporate debt, again, helps bondholders, corporations. Tax cuts over the last couple of decades have also tended to favor higher earners.
So it's not that the policies were necessarily wrong, but they maybe didn't address or even worsen that underlying divergence.
You could argue that. There are symptoms of a system where maybe the economy just works better for some people than others, where success isn't as broadly distributed as it felt like it was in that post-war era.
And why do those old expectations persist? Why do people still cling to that idea of a broad middle class where everyone lives similar lives?
Because it felt good. I mean,
Yeah.
really good. For a lot of people, for a long time when it was largely true. That sense of shared prosperity, of common experience. It's a powerful, attractive ideal. It's really hard to let go of something that felt that good, even when the facts on the ground have changed.
And that gap, that disconnect between the expectation and the reality,
Yeah,
that fuels a lot of the frustration we see, doesn't it?
absolutely. Think about the political movements we've seen bubble up. The Tea Party on the right, Occupy Wall Street on the left, Brexit, Donald Trump's election.
Different groups, different proposed solutions.
Totally different groups, often with opposing views, but you could argue they're all shouting in their own way because they feel like stuff isn't working for them.
Within that old framework.
Within the context of that post-war expectation that stuff should work out roughly the same for roughly everyone. When it doesn't, the feeling becomes, this is broken. This isn't the world I was promised or the one I expect.
And that leads to
That feeling of, I don't live in the world I expected, it makes people angry. It makes them think, okay, screw this. Screw the status quo. I'm going to support something totally different, maybe something radical, because this isn't working.
And technology pours gasoline on that fire.
Oh, massively. Social media, Facebook, Instagram constantly shows you curated versions of how other people live, often making the gap seem even larger. Cable news can create echo chambers that reinforce grievances. Benedict Evans made the point that economic outcomes used to be more localized, less visible now. Everything's global, instant, and right in your face. It just intensifies the comparisons and the discontent.
So, looking forward, are we just stuck in this loop? Expectations from the past clashing with the reality of today? Is there a way out?
Well, I try not to be too pessimistic. Economics runs in cycles. Things change.
And there are some positive signs now?
There are. Unemployment is low. We've seen periods recently where wages for lower-income workers have actually grown faster than for high-income workers, which is a reversal of a long-term trend. College costs, once you factor in grants and aid, seem to be stabilizing somewhat.
Yeah, maybe we forget the progress in other areas.
I think so. If you really step back and think about the massive improvements since the 1950s in healthcare, technology, communication, travel, civil rights, opportunities for women and minorities, most people wouldn't actually want to trade today for the 1950s, even with the shared prosperity aspect.
But that core problem remains. Expectations change slowly.
Much slower than reality. That's the central theme, really. Even if we started a new boom tomorrow, a new era of broadly shared growth, that feeling, that deeply ingrained belief that the odds are stacked against everyone but those at the top, that could linger for a generation or more.
So that feeling of this isn't working, the demand for something radically new right now that might be with us for a while?
It very well could be. It
Mhm.
just shows how the decisions made, the culture created way back after World War II, are still echoing today. History isn't just dusty dates. It's, as the saying goes, just one damn thing after another, all connected. So pulling it all together, this whole journey from that post-war moment of fear and uncertainty to deliberately building a consumer society on cheap credit, finding that amazing shared prosperity, and then watching that fray into inequality and unsustainable debt. It's really baked into how Americans think and feel about money today. Those expectations set back then, they're powerful. They shape our reactions to the economy now, even when the underlying reality is very different.
It leaves you wondering then, what does it really mean when our collective hopes or expectations are out of sync with the economic facts on the ground? How do you, listening right now, navigate that gap yourself? The gap between the life you aspire to, maybe based on those older ideals, and the actual economic situation today. What could help align those things better? And maybe more importantly, what happens personally and for society if they don't align? Something to think about.
Have you ever looked at someone else's financial decisions and just thought, are they crazy? What were they thinking?
Oh, all the time.
Maybe it's a friend who, I don't know, bought a designer dog kennel that cost more than your first car. Or maybe a relative who swore by a stock tip they got from their psychic.
Yeah.
We all do it, right? We see these choices and they just don't compute. They seem illogical.
Completely.
Well, today in this deep dive, we're going to explore why people make the financial decisions they do, even the ones that seem completely baffling to outsiders.
Right.
We've pulled together some really fascinating sources that unpack the surprising truths about our money mindsets. Our mission really is to get to the bottom of why what seems crazy to you makes perfect sense to someone else.
And the core premise here, it's simple, but it's pretty powerful. No one's crazy.
Right.
Our goal today is really to understand, not to judge. Because while it's crucial to realize our unique experiences shape our views about money far more profoundly than we often acknowledge.
So that core idea, no one's crazy. It sounds simple,
Yeah.
but it really does make you rethink things. How do we start to, unravel why it holds true?
Well, it really comes down to this. Everyone's financial lessons are just wildly different because their experiences are unique. And what you've personally experienced is frankly far more compelling than anything you just learned secondhand.
Yeah, that makes sense.
Think about it. We all kind of go through life anchored to a set of views about how money works. And these views, they vary dramatically from person to person.
So like different starting points.
Exactly. For anyone up in severe poverty, they perceive risk and reward as a child of wealthy bankers cannot fathom. It's a different world.
Right.
Or, consider someone who grew up during a period of really high inflation. They've experienced something tangible that someone who only knows stable prices just hasn't. And the stockbroker who lost everything in the Great Depression, their understanding is, well, it's incomparable to a tech worker who maybe flourished in the booming late 1990s. This goes on and on. These unique experiences are truly endless.
So when we see people, say, on opposite sides of a major financial debate, like about recessions or strategies, it's not necessarily a battle of intellect. It's more like a clash of life stories.
Exactly. It's generally not about raw intelligence. What's truly striking and a bit mind-blowing is that our personal experiences with money might make up this tiny, tiny fraction, like 0.0000001% of what's happened in the world.
Wow, that's small.
Yeah, minuscule. But they account for something like 80% of how we think the world works.
90%, that's huge.
It is, and this raises a really important point about what you might call the unrecreatable power of fear and uncertainty.
The unrecreatable power of fear and uncertainty. That's a strong phrase. Can you give us an example?
Sure. Take John F. Kennedy. When he was running for president, a reporter asked him what he remembered about the Great Depression. And Kennedy basically said he had no firsthand knowledge. This was incredibly wealthy. They actually had bigger houses, more servants, traveled more during that time.
So he didn't experience the hardship?
Not at all. He only learned about the Depression by, reading about it at Harvard. And this was actually a major point in the 1960 election against Hubert Humphrey, who had lived through it.
Right. Humphrey had that direct experience.
Exactly. And the challenge for all of us is that no amount of studying or open-mindedness can truly recreate the emotional weight of living through that kind of economic fear and uncertainty. You can read all about what it was like to lose everything, but you don't have the emotional scars, right? Spreadsheets model how often stock markets decline historically.
Sure, you can see the numbers.
But they can't model that feeling of looking at your kids and wondering if you've made a mistake that's going to impact their lives.
Yeah, entirely.
It is. As the investor Michael Batnick puts it, some lessons have to be experienced before they can be understood. And we are all, in different ways, kind of victims of that truth.
Makes so much sense when you put it like that. We've talked a lot about the anecdotal evidence and the logic behind it, but is there actual data? Has anyone formally studied how our personal histories impact our financial decisions?
Oh, absolutely. Back in 2006, two economists, Ulrich Mulmendier and Stefan Nagel, from the National Bureau of Economic Research, which is, a major nonprofit research institution, they dug through 50 years of the survey of consumer finances.
50 years. Wow. That's a lot of data. And what did they find? Was it as compelling as the stories?
I'd say so. Their findings were pretty profound. They discovered that people's investment decisions were strongly anchored to the experiences those investors had in their own generation, especially experiences early in their adult life.
Okay, so those early years really stick.
They really do. For example, if you grew up when inflation was high, you tended to invest less in bonds later in life compared to people who experienced low inflation.
Right, because bonds got hammered.
Exactly. Conversely, if you grew up during a strong stock market, you tended to invest more in stocks later in life.
Makes intuitive sense.
They concluded that individual investors limit their risk depends on personal history, not necessarily on intelligence or education or even financial sophistication.
So it really boils down to luck of the draw sometimes. When and where you were born.
That seems to be a huge factor, often just the dumb luck of when and where you were born.
So does it mean someone who lived through, say, 2008 or the dot-com bust might just inherently react differently to market downturns today, even if they're a super sophisticated investor now?
Well, that's what the research implies. It's like those early experiences get deeply ingrained.
But what about, education, financial literacy? Sure, with enough knowledge, someone overcomes early biases, right? Can you learn your way out of it?
You'd certainly hope so, and education helps, no doubt. But the research suggests these early experiences are incredibly persistent, maybe more than you think. And you see this play out in the real world. Like the Financial Times interviewed the famous bond manager Bill Gross back in 2019.
Oh, yeah, Bond King.
Right? And he openly admitted he probably wouldn't be where he is today and would be a decade earlier or later. His career just happened to coincide almost perfectly with this generational collapse in interest rates.
Ah, so falling rates made bonds amazing.
It made bonds seem like wealth-generating machines to him. But, to his father's generation, who'd lived through higher inflation, those same bonds might have seemed like wealth incinerators.
Wow. Same asset, totally different perception based purely on timing.
It's all about perspective, shaped by experience, even for the most brilliant financial minds.
The dumb luck of birth years is powerful. Can you give us some more concrete examples of how different birth years radically shift someone's financial view?
Yeah, absolutely. So say you were born in 1970.
Okay.
During your teens and 20s, those really formative years, the S&P 500 increased almost tenfold, even after adjusting for inflation.
Tenfold. That's incredible.
Right. That's an amazing foundational experience with stocks seeming like a sure thing. But if you were born, say, in 1990, the market was very different during your formative years. You saw the dot-com bust, then 2008. It leads to a completely different view on how the stock market works.
Totally different lesson learned.
Or think about inflation. If you were born in 1960s America, price more than tripled during your teens and 20s. You might remember gas lines, stagflation.
And so as my parents told me.
Exactly. But if you were born in 1990, inflation has been consistently low your entire life. Yeah. It's probably never really crossed your mind as major economic threats. It's just background noise.
And this goes beyond just birth year. You mentioned socioeconomic factors too.
Oh, absolutely. The scope broadens dramatically there. Take November 2009, deep in the Great Recession. America's nationwide unemployment was around 10%.
Which was high.
Very high. But it wasn't 10% for everyone. For African American males aged 16 to 19 without a high school diploma, that rate was nearly 49%.
49%? That's staggering.
It's almost unbelievable. Now, contrast that with, say, Caucasian females over 45 with a college degree. Their unemployment rate was just 4%.
Wow. Same country, same time, vastly different economic realities.
Precisely. And these differences extend globally, too. Think about World War II.
Okay.
Think about the impact on German and Japanese stock markets, economies. Entire regions bombed out. German farms, post-war, could only produce enough food for maybe 1,000 calories a day per person for a while.
Devastation.
Total devastation. Now, compare that to the U.S. economy during that same period. It was booming. The stock market more than doubled from 41 through 45.
Right. The war effort boosted the U.S. economy.
Exactly. So what this all tells us is, well, you shouldn't expect members of vastly different groups to think the same way about money, or respond to financial information identically, or even trust the same sources of advice.
Because their fundamental view of money was formed in completely different worlds.
That's it. And when that's the case, a view that one group finds outrageous or crazy can make big sense to another.
Some of the numbers and theories, they only tell part of the story. You get profound differences in perspective. You almost look at individual experiences, right?
You do.
That Foxconn sweatshop story you mentioned earlier, this seems like a perfect example of this. Tell us about that again.
Yeah, it really is. So, New York Times ran a piece, detailing the working conditions at Foxconn, the huge Taiwanese electronics manufacturer.
Right, making iPhones and other things.
Exactly. And American readers were, quite rightly, upset at the often atrocious conditions described. Long hours, low pay, tough environment.
Yeah, I remember the reaction.
But what's truly fascinating, was a response in the comment section from the nephew of a Chinese worker there. He wrote in, and he explained that his aunt had worked at Americans call sweatshops. He acknowledged it all hard work, long hours, small wages, poor conditions. No argument there. But then he revealed something just eye-opening. Before working at Foxconn, his aunt had been a prostitute.
Oh, wow.
And so, from her perspective, the factory, despite all challenges that seem horrific to us, was a profound improvement.
An improvement
because it meant her body wasn't being exploited anymore in the same way. It gave her a different kind of maybe dignity or control, even within those harsh factory conditions.
It completely reframes it, doesn't it? It really challenges our immediate sort of black and white thinking.
It absolutely does. It shows how relative poor conditions or improvement can be depending on your start and your alternatives.
That anecdote is incredibly powerful. It really hurts on the point that every financial decision person makes is logical to it, actually makes sense to them in that moment.
Exactly. It checks the boxes they need to check based on their reality.
They tell themselves a story about what they're doing and why. And that story is shaped by their own unique experience. They might be misinformed, sure, or have incomplete information, maybe be bad at math or misjudge the consequences.
All possible.
But in their mind, in the moment, it works. It makes sense.
Which brings up an important question. If this is true, How do we explain something that seems so clear crazy to any of us, like buying lottery tickets?
Ah, yeah, the lottery. Good example.
Americans spend more on lottery tickets than on movies, video games, music, sport events, and books combined.
Combined. That's unbelievable.
And who buys them? It's primarily low-income households. They spend on average about $412 a year. That's 4 times the amount spent as income groups.
$400.
Yeah.
And wasn't there a stat about emergency funds?
Yes. Shockingly, 40% of Americans can't come up with $400 in an emergency.
So people buying $400 in lottery tickets are often the people who don't have that tiny safety net. That does seem crazy on the surface.
It really does.
When I first did those lottery stats, I admit, I had nothing. It just didn't compute with conventional financial wisdom,
Of course.
But then, if you really try, if you strain a little to step into that mindset, why starts to maybe emerge, doesn't it?
How so?
You can almost imagine their reasoning. It might go something like this. Live paycheck. That seems completely out of reach. Our prospects for getting ahead or even putting our kids through college without just crippling debt, they feel slim.
A feeling of being stuck.
Yeah. And much of the good stuff you people, people who read finance books, you have now or have your chance at. Well, we don't. We just don't see a path. Buying a lottery ticket, it's the only time in our lives we can hold a tangible dream of getting the good stuff that you already have. And we take for granted. We are paying for a dream.
Paying for a dream.
And you may not understand that because you already living a dream, or at least have a realistic shot. That's why we buy more kids than you do.
Now look, you don't have to agree with that reasoning. Right? Buying lottery tickets when you're broke is still, generally speaking, a bad financial move.
Objectively, yes.
But understanding the why, understanding that narrative they're telling themselves, it bridges the gap. It makes the behavior comprehensible, even if not advisable.
Right. It shifts from crazy to understandable, given their perspective.
Exactly. And the truth is, very few people make major financial decisions purely with a spreadsheet. They make them at the dinner table, or maybe in a company meeting, where personal history, their unique view of the world, ego, pride, marketing, odd incentive, it's all scrambled together.
Scrambled together into work for them.
Precisely.
This leads us to a really crucial point, doesn't it? Something else that helps explain why money decisions are so difficult, and there's so much perceived misbehavior out there.
Yes, it's about how new all this is.
New. But money's ancient. Right? King Eliadus lived 600 BC.
Money itself, yes, ancient. Coins, currency, that's been around for millennia. But the personal responsibility for managing it, for saving and ensuring ownership, that's actually a very, very recent development in human history.
Okay, tell me more about that. How new are we talking?
Well, what's fascinating here is just how new some of these core concepts really are. Take retirement, for example.
Yeah, retirement.
Yeah.
Seems pretty standard now.
Yes, but before World War II, most Americans simply worked until they died. That was the expectation, and it was a reality.
No golden years relaxing.
Not for most. Security was established, sure, but its initial benefits back in 1940 were tiny. Ida Fuller's first check, $22.54.
$22.
Yeah. And it wasn't until the 1980s that the average Social Security check, even adjusted for inflation, consistently exceeded $1,000 a month. So the idea that everyone should save and invest money to ensure a dignified retirement, that only really took hold in the 1980s.
80s. That's surprisingly recent.
It really is. And to reiterate how new this is, the 401k, right?
Yeah.
The backbone of American retirement savings now. It didn't even exist until 1978.
Wow.
And Roth IRA, born in 1990. If for a person, it would barely be old enough to drink legally in the U.S.
That's incredible. So these cornerstones of modern personal finance are younger than many of the people using.
Absolutely. And the same pattern holds for college education.
How so?
Well, the share of Americans over 25 with a bachelor's degree went from less than 1 in 20 back in 1940
Tiny percent.
to 1 in 4 by 2015. And during that same time, average tuition rose more than fourfold adjusted for inflation.
So more people going, way more, very quickly.
Exactly. Something that big and important hit us like that fast. It helps explain why some people have made maybe poor decisions with student loans over the last 20 years. There just aren't decades and decades of accumulated experience for society to learn from.
We're essentially winging it.
We're winging it. And modern investment vehicles, also very new. Broad market index funds, the easy way to invest across tons of companies. They're less than 50 years old.
Less than 50.
Hedge funds only took off in the last 25 years or so. Even widespread consumer debt, mortgages, credit cards, car loans, didn't truly explode until after World War II, partly spurred by things like the GI Bill.
Kind of like analogy. Dogs were domesticated about 10,000 years ago, and they still retain some behaviors from their wild ancestors.
Right.
Here we are, with maybe only 20, 50 years of real, widespread experience in this modern financial system.
Yeah, 50 years is generous for some of the stuff.
And we expect ourselves and each other to be perfectly acclimated, to make all the right decisions all the time. It's almost comical when you frame it that way.
It really is. And for a topic like money, which is so heavily influenced by emotion versus fact, this newness, it's a major problem and helps explain why we don't always do what we're quote-unquote supposed to with money.
Okay, so let's try and wrap this up. To summarize our deep dive today, we all do things with money that might seem crazy to others. It's often because we're all relatively this complex game. We're operating from our own unique set of experiences that fundamentally shapes our perspective.
That's the core of it.
So no one is truly crazy. We're all just making decisions that make sense to us in that specific moment, given the story built from our lives.
Right. And maybe a final thought for you to consider as you go about your week. Think about someone whose financial decisions judge, maybe someone you see as irrational.
Okay.
Instead of just deciding that, right, take a moment, ask yourself, what experiences might have shaped their unique story? What could make those seem perfectly logical to them?
Flipping the perspective.
Exactly. And then maybe ask, what does that contemplation tell you about the assumptions you might be making about money and about how the world works?
Okay, so there's this great story. Kurt Vonnegut, the writer, he's at a Berkshire Island with his friend Joseph Heller, Catch 22 Heller.
Legendary.
And Vonnegut points out their host, some hedge fund guy, made more money in one day than Heller got from Catch 22 over his entire history.
Wow. Yeah.
And Heller says, yes, but I have something he will never have. Pauses. Enough.
Enough. Such a powerful word. Really gets to the core of it, doesn't it?
It really does. And so that's what we're doing to today, this whole idea of enough, how crucial it is, how often we miss it, especially with money and success.
And the dangers. Right. Surprising dangers when you don't know when enough is enough.
Yeah.
Even for people who, seem to have absolutely everything.
Exactly. Why do incredibly rich people sometimes risk all chasing just more? That's the big question we're telling.
Yeah, and we've pulled together some really compelling real-world stories, examples, and observations that shed light on, well, nature, ambition, our whole relationship with wealth.
The goal is to unpack why this happens, not just what happened. Look at the psychology, the financial thinking, and what lessons you can take.
Makes sense.
So let's dig in. First, Red Gupta. Now, here's someone whose story is just remarkable. He started in Kolkata, really tough background, orphaned as a teenager.
A genuine humble beginning. Not exactly blunt.
Not even close. Couldn't see the stadium, but his rise, absolutely phenomenal. I mean, mid-40s, CEO of McKinsey.
He most consulting for the world, arguably.
And he doesn't just retire quietly. He gets involved with the UN, the World Economic Forum, philanthropy. Bill Gates sits on boards for 5 huge companies.
So incredible success, and obviously with that comes serious wealth. By 2008, reportedly worth $100 million.
I know.
Just pause on that. Even a pretty conservative 5% return on it. That's nearly $600 an hour.
Wow.
24 hours a day, whether he's working or sleeping.
Right. So he has the success, the money, the produce, the power, freedom. You have to ask, what more could he possibly need or want? What was driving him?
$1 million question, or a $100 million question.
Right. It seems almost irrational. But apparently what he wanted wasn't just to be a centimillionaire. Rajat Gupta aimed higher. He wanted to be a billionaire.
He's on the Goldman Sachs board, surrounded by titans of finance.
And he felt like that circle, the Goldman circle, was just the hundreds of millions, not the real elite, the billionaire circle. That's how he got.
Which is an incredible perspective to have when you're already worth $100 million.
It really is. So fast forward to 2008. The financial crisis is hitting. Warren Buffett steps in, plans to invest $5 billion into Goldman Sachs to stabilize things.
Huge deal. Massive news.
And Gupta, as a board member, finds out before anyone else. And then, it's critical, 16 seconds after hearing about the deal in a board call, he hangs up and calls Rajaratnam, a hedge fund manager.
16 seconds. Wow.
Rajaratnam immediately buys 175,000 shares of Goldman Sachs.
Just before the news breaks.
Exactly. Hours later, the deal's announced. Goldman purchases, and Rajaratnam makes $1 million. Just like that.
Instant profit based on inside information.
Result, utterly tragic. Both Gupta and Rajaratnam end up in prison for insider trading. Careers gone, reputation destroyed.
Just throw away. All for felt like more.
The star example, reaching for more when you already have so much. But then there's Madoff. You never know his name, the Ponzi scheme guy.
Synonymous financial fraud, yeah.
What often gets lost, I think, is that Madoff, kind of like Gupta in a way, was actually a madly successful, legitimate businessman before it all went wrong.
That's a really good point. People forget that his market-making firm, Bernard L. Madoff's Securities, it was huge. Very profitable.
How profitable are we talking?
Well, he was a pioneer in electronic trading, basically volume away from the New York Stock Exchange floor. His firm handled something like 9% of the NYSE's average daily volume off exchange.
Wow, 9%.
Yeah. And legitimate business, it was making him between $25 million to $50 million a year. Every year, legally.
25 to 50 million a year. And still, he builds this massive Ponzi scheme on the side.
Exactly. Which brings us back to that core question for both Gupta and Madoff, right?
Yeah. Why? Why people with hundreds of millions, with all the prestige, power, freedom you can imagine, why risk everything for money?
It's not like stealing bread because you're starving. This is something else entirely.
It feels fundamentally different. What does it tell us about, I don't know, the psychology of wealth or maybe just humor?
Well, it's fascinating because you see versions of the same thinking even when it's criminal. Long-term capital management, LTCM, the hedge fund that blew up spectacularly.
Yeah, I remember that. Nobel laureates on their board, super geniuses.
Exactly. And traders themselves, they were personally loaded. Tens, hundreds of millions each. Most of their money was tied up in the fund.
Okay.
But they chased more. They leveraged themselves to the absolute hilt, taking on enormous risk. And then they lost it all. Wiped out.
And this was in 1998. Not exactly a bull market then.
No. It was in the middle of a huge bull market, a strong economy. It wasn't market conditions ruined them. It was own insatiable desire for more, leading to unbearable risk.
Warren Buffett had something to say about LTCM, didn't he? He always has the perfect line.
He really does.
Right.
He said, to make money they didn't have and need, they risked what they did need. And that's foolish. It's plain foolish. If you risk something that's important for something that is unimportant to you, it just does not make sense.
Plain foolish. Yeah. That's through it. So these stories, Gupta, Madoff, LTCM, They all seem to point towards this dangerous pursuit of more.
Mm-hmm.
So what's the takeaway? Maybe first big insight here is that the hardest financial skill isn't making money, it's getting the goal of something.
That's a great way to put it. Because your results go up, but your expectations often go up as fast or even faster.
So you actually feel like you're getting ahead.
Exactly. You put in extra effort, get more money, more power, whatever, but you just want more. Ambition outpaces that.
And the goalpost just keeps shifting further away.
Right. And then you feel like you're behind, even though you're objectively right. And that feeling, that's what can push you to take bigger and bigger risks to try and catch up.
It's like modern capitalism is brilliant at creating wealth. Envy.
Really feed each other, wanting to keep up, wanting to surpass others. That can drive hard work. Life's no fun if you never feel like you have enough happiness. It really is just results minus expectations.
And a huge driver of those rising expectations seems to be, well, look around at what other people have.
Yeah.
Social comparison.
Oh, absolutely. That's the engine right there. Think about that key baseball player you mentioned. Make $500,000 a year, objectively rich.
Totally. Life-changing money for most people.
But maybe he's on the same like Trout, who signed that $400 million contract.
Suddenly, $500,000 feels not so rich.
He feels broke by comparison. It's all relative.
It does stop there, does it?
Not at all. Making $36 million a year. Maybe he compares himself to the top fund managers. Back to the top 10 guys each made at least $340 million.
$340 million in 1 year.
Right. Those guys. Maybe look at the top 5 who made over $700 million each.
Okay, this is getting started.
And even then look up at someone Warren Buffett. His personal wealth went up by $3.5 billion in 2018.
$3.5 billion.
That's an amount that would take a rich baseball player making $500,000 a year, 7,000 years to earn.
7,000 years. Okay, so the point is, the ceiling keeps going up and up.
It's effectively infinite. You can always find someone with more, which means trying to win at social comparison is unwinnable.
So the only way to win is not to play.
Pretty much. You have to just opt out. Except enough might be less than what the person next door has, and it's okay.
It reminds me of that Las Vegas casino dealer story.
Oh, yeah.
A friend of mine goes every year, asks the dealer, what games do you play? And the dealer is dead serious. The only way to win in the Las Vegas casino is to exit as soon as you enter.
Ah, that's perfect.
And it's exactly the same with trying to keep up with other people's money, right? You got to know when to walk away. Enough.
Precisely. Which leads nicely into, I think, the third key insight here.
Okay, what's that?
That enough is not too little. It doesn't mean being unambitious or, leaving perfectly good opportunity untouched.
It's about settling for mediocrity or playing it super safe all the time.
No, it's more fundamental. It's about realizing that the opposite of enough, that insatiable appetite for more, will actually push you too far. It leads to regret. Well, think about eating. How do you know you're absolutely have to eat until you literally get sick?
Yeah, not pleasant.
Exactly. Nobody does that because vomiting feels way worse than any extra bite of food tastes good. The downside outweighs the upside.
Makes sense.
But for some reason, that logic doesn't always stick when it comes to business or investing. People keep pushing, keep reaching for more until they break.
Until they burn out or make terrible investment decisions.
Or like Gupta and Madoff end up doing something because in the end, every dollar is worth no matter the cost.
That ability to say no to one more potential dollar, it catches up to you. Turns potential gain into definite, often catastrophic loss.
After Gupta got out of prison, he told the New York Times something interesting. He said the lesson was, don't get too attached to anything, your reputation, your accomplishments, or any of it.
He said, I think about it now, what does it matter? Okay, this thing unjustly destroyed my reputation. That's only troubling if I'm so attached to my reputation.
Wow. That sounds like a code, like trying to rationalize away the loss.
It's easy to see it that way. Maybe the worst will take away, right?
Yeah.
You feel okay about something that really isn't okay. Suggesting reputation doesn't matter after yours is, frankly, ruin your own actions.
Yeah, because let's be real, reputation is valuable. Massively valuable. And so is freedom, independence, your family, your friends. Being loved, the people you want to love you, happiness itself. These things are priceless.
Exactly. They are the things that really matter. And your best shot, your only shot, at keeping those invaluable things safe
is knowing when taking risks that could destroy them.
Knowing when you have enough. It's the yield for what's truly important.
So understanding enough isn't just about money on a spreadsheet. It's about protecting your whole life, really. The things that actually make it worth living. It guards your freedom, your relationships, your peace of mind.
Good news. The best tool for building that sense of enough. It doesn't require some complicated financial strategy or taking risks.
Not at all. It's simpler. It's more about perspective, about recognizing what you value. Realizing that true wealth isn't just accumulation. It's also about knowing what you have and choosing not to risk it for something you don't really need.
So maybe the final thought for everyone is, what does enough actually look like for you? What are those invaluable things you aren't willing to put at risk? Today, we're going to look at the stack of sources you sent over. Articles, papers, even some personal notes. And they're all grappling with the question, we all think about. What really drives success and failure?
Yeah.
in our finances, in our lives.
Yeah, and we love those simple stories.
Absolutely. The lone genius, the innovator who has worked tirelessly,
Yeah.
the bootstrap story.
Right, and then failure's just, oh, they made bad choices, or they were lazy.
Exactly. But our mission today really is to unpack the incredible complexity behind all that.
We really love those clear cause and effect lines, those tight narratives. Yet, as these sources really show, every outcome in life is guided by forces other than individual effort. So this deep dive about those kind of hidden roles, luck and risk, they're so
intertwined. And actually, to kick us off, it's a great idea, NYU professor Jack Away, perfect for this. He says, nothing is as good or as bad as it seems. And think of luck and risk as like siblings.
Siblings, I like that.
Two sides of the same coin, really, can't actually separate them.
It's a powerful way to put it. These siblings, risk, they're forces mostly outside our control, aren't they? But they just heavily influence where we end up. The world, as these sources suggest, it's just way too complex to think 100% of what we do dictates 100% what happens. Right. Sometimes those outside factors, the things we don't choose or even see coming, they can matter way more than we do.
So if they're that powerful, why are we, as humans, so resistant to seeing it? Is it just needing control?
I think it's a mix, and partly control. But also these forces, randomness, pure chance, they're just so hard to measure.
Yeah.
So hard to really accept. It's easier to just gloss over them. We prefer to think we're fully in the driver's seat, that our actions alone shape our destiny. It just feels better, more empowering, even if it's not a whole story.
Okay. Let's dig into this with a case study then. It really brings this stuff to life. It's about one of the most successful people ever, Bill Gates. Obviously, brilliant guy, driven visionary, all that.
Sure, no doubt.
But let's look at this 1 in a million head start he had.
Okay. This starts back in 1968. Gates is 13, attending Lakeside School in Seattle.
Right.
The really extraordinary thing is that Lakeside was one of the only high schoolers in the entire world that had a computer back then. Almost sounds made up today.
It really does.
Yeah.
How did he get it? It wasn't like a big corporation or something.
No, not at all. That's the amazing part. It was a math and science teacher, Dougal. He'd been a WII Navy pilot, and he just had this foresight. He believed kids needed real-world experience, especially with computers. So in 1968, he goes to the Lakeside School Mothers Club.
The Mothers Club. Bagels and stuff.
Exactly. The ones who raised money from rummage sales. He asks them for just $3,000.
$3,000
to lease a Teletype Model 30 computer.
It's incredible.
It was just any old machine. It was hooked up to a General Electric mainframe for time sharing.
Which was brand new tech, right?
Super new. Yeah. Gates himself said time sharing was only invented in 1960. So Dougal was incredibly forward-looking.
So forward-looking.
Most university grad schools back then didn't have access to a computer as advanced as what Bill Gates had in 8th grade.
That's just staggering. So what did he do with it? Just mess around?
Oh, no, he devoured it. He had Paul out there, and they basically lived in a computer room. Night weekends, learning everything. Al even remember Gates showing him a Fortune magazine, asking, "Do you think it's like to run a Fortune fund company?"
Already thinking big.
That ambition, starting a unique environment that led to now worth over $1 trillion.
Incredible. So let's try and quantify that luck. Let's add 1968. How many there?
Okay, globally, roughly 303 million.
300 million.
In the U.S., about 18 million. Washington State, maybe 207,000. Seattle area, over 100,000.
And Lakeside.
Just 300 students.
303 million down to 300.
Yep. That puts Gates at roughly 1 in a million high schoolers worldwide who went to a school that had both the money and to that computer.
1 in a million.
And Gates knows it. He told Lakeside's graduating class in 2005 straight up, if there were no Lakeside, there would have been no Microsoft. So yes, staggering intelligence, hard vision, absolutely. But he also acknowledged he had that 1 in a million head start.
It really makes you wonder, does Gates admits huge slice of luck?
Right.
What about the flips? What happens when those same random forces work against someone just as talented? And that brings us to Kent Evans.
Kent Evans, Bill Gates' best friend back in 8th grade.
Yeah.
And according to Gates himself, Kent was the best student in the class.
Wow.
Just as good with computers as Gates and Paul Allen. They actually built a program to get out the school's really complex class scheduling, and apparently it worked perfect.
Kind of striking hearing Gates talk about it, even his phone number after all those years.
At 557-851, he had them countless times.
And apparently, unlike Allen, maybe, Kent had that same business drive as Gates, that endless mission.
Totally. Gates remember Kent carrying the big case like a lawyer.
In 8th grade.
Yeah, and always scheming, as Gates put it, about the future. Should be CEO, could we have general ambassador? Was they do it together?
They didn't.
No. Tragically, Kent Evans died. A mountaineering accident before he graduated high school.
Oh, man.
Based on everything said, he could easily have found a partner of Microsoft right alongside Gates Allen. Same drive.
And the odds there, just as aren't they? Mountaineering deaths.
Yeah, incredibly rare, especially for high schooler. Only about 3 dozen total deaths in the U.S. each year.
So the odds of that happening to him specifically?
Roughly 1 in a million. Same odds, direction.
What? 1 in a million luck for Gates, 1 in a million for Evans.
Exactly. That's a core lesson here, I think, from these sources. Gates gets the lucky break, Evans gets the lucky one.
Right.
Their paths were so aligned and just divergently. It perfectly shows how outcomes can be guided by forces totally outside our effort.
So similar, those odds. You really can't believe in Gates' luck without also respecting Evans' risk.
You absolutely have to. They're two sides of that same coin, like you said earlier.
Which brings us back to how we process all this. We do prefer to think this is all skill and work.
Definitely.
And failure, just bad decisions or laziness. It's cleaner, simpler, but dangerously incomplete.
It really is. You know, the Nobel Prize-winning economist Robert Shiller, he once said the thing he most wanted about investing but couldn't was the exact role of luck in successful outcomes.
You couldn't figure it out.
Right. It said it's not hard to quantify, almost as impolite to suggest someone's success involved luck. It kind of diminishes their effort in our eyes.
That makes total sense.
Yeah.
If I told you, particularly, maybe 10 billion out there, mostly through pure chance.
Probably not make sense statistically.
Right, but then name which 10.
Suddenly feels, I was wrong, demoralizing, as one put it. We don't want to point fingers and say, you were lucky.
Yeah, and this is into our economic lives too, right? There's that research by Boschkar, wasn't there?
Oh, the study on brothers' incomes. Yeah, fascinating stuff.
Their incomes are more correlated in their height or weight.
Which points strongly towards shared upbringing, opportunities, the environment they grew up in. Others learn outside their individual control later on.
But people who benefit most from that art, they often deny it applies to them personally.
It's that bias again.
We do it to ourselves too. The double, someone else fails, bad decisions, we fail. Oh, that was such bad luck circumstances.
Absolutely. We create these well-aired ones to justify choices once go, rather than just admitting, hey, that was random.
And Forbes magazine isn't running covers, celebrate investors who made calls, got unlucky.
Oh, no, definitely not. Celebrate the ones who made maybe got lucky. The outcome is the storytelling.
Which is so dangerous when you're trying to learn. See success, see failure. You think, okay, do what she did, avoid what he did.
But what if what he did was pure luck? And what he did was a perfectly sensible decision, just ran into bad risk. How do you tell?
You often can't, especially not at a time. That line between inspiring bold and foolishly reckless, sometimes it's paper in.
Millimeter. Yeah. And only insight. Luck are total doppelgangers.
Look at examples of this thin from this.
Okay.
Like Cornelius Vanderbilt, building his railroad empire, apparently just ignored laws left and right.
Yeah, so he goes, the advisor warned him, this law, and then supposedly shot back. What do I care about the law? And I got power.
Right. And because he succeeded, we look back and may call it sage wisdom or, or strategy.
But this asks a good question. How does society end up normalizing rule breaking after success validates it? That really good luck.
Probably not. And John Ockler, similar story, right? His tactics, a judge called a calm.
But historians frame it as cunning business smarts. Again, the outcome colors the perception of the action.
It really does. It should have completely.
And there's Benjamin Graham, the father of value investing, Warren Buffett's mentor.
Guru.
Right. But the sources revealed most of his actual investments came from owning a huge chunk of Echo's stock, which by his own rules violated basically everything he taught about diversification.
Oh,
massively. And even he asked, was that one lucky break or one supremely shrewd decision? And the killer question, can we tell them apart?
That highlights it, doesn't it? The theory is the messy reality, maybe involving one giant lucky break.
Exactly. Mark Zuckerberg.
Turning down a $1 billion offer for Facebook back in 2006.
Praised the genius, he saw the future, then they'll get some later turn down Microsoft's buyout offer. They should have out.
So the exact same type of decision, turning down the offer.
It's brilliant for one, terribly other based purely on what happened next. It's just how hard it is to judge all without hindsight.
Market time, valuation. It's just so unpredictable.
It really restores that doppelganger effect. Inspiringly bold, foolishly reckless.
Yeah.
Just can't which and much later.
Okay, so what does this all mean for you listening right now? Trying to navigate your own life, your finances. How do we find something useful in all this comes?
Yeah, that's the key question, because the core problem, as sources keep saying, is just how hard it is to unlock luck, skill, and risk.
It's a huge challenge if you're trying to learn how to make good life decisions.
Definitely. But there are a couple of recommendations or shifts in perspective come through sources.
Okay, like what?
First, maybe more humility about outcomes.
Humility about
Yeah, recognizing that even your biggest wins probably had some good fortune baked in, and your worst losses might not have been entirely, maybe just bad luck.
The parents' letter to their son.
Oh yeah, that was powerful. Not all success is due to hard work, and not all poverty is due to laziness. Keep this in mind when judging people, including yourself.
Wow, there really hits home.
It's crucial that kind of thing. Maybe you shift how you judge yourself too, not just by the result, but by the...
I make the best call I could with what I knew then, even if it went the wrong way.
Exactly. Did you have a sound process? That'd be more important than when you got lucky or unlucky in any single outcome.
Okay, that makes sense. And it's a recommendation.
Focus less on specific individuals, especially the extreme goals.
Like the billionaires that you were just about, or the massive failures.
Yeah. It's tempting to study them, but their experiences are the least likable in most people's lives. They're outliers, by definition. Level luck or risk is off charts.
So where should you look and say?
Look for broader patterns, general principles of success and failure that apply more commonly.
More actual lessons.
Kind of, yeah. Think about historian Frederick Lewis Allen. He focused on the average median American, how they lived, what worked didn't over time.
Right.
There are probably more relevant, actionable takeaways in the broad observation than studying the extreme outliers who have headlines. They might be these wild waves of luck or risk that you'll never experience.
Those focus on the extreme story more on common patterns.
Got it. Yeah.
So as we wrap up, let's go back to that Alloway I started with.
Nothing is as good or bad as it seems.
Exactly. Bill Gates had that quote, right? Success is a lousy teacher.
It seduces people into thinking they can't lose.
Things are going incredibly well for you. Maybe pause and realize, okay, this is as amazing as it feels.
Right. You're not invincible. And if you admit luck to part in getting there, then you absolutely have to respect luck's sibling risk, because it can turn things around just as fast.
The flip side true too. Failure can also be a lousy teacher.
Definitely. It tricks people into thinking their decisions were awful, when maybe it was just the unforgiving realities of risk, as one source.
The practical advice when you're dealing with failure or risk.
Arrange things, finances, maybe other parts of your life so that one bad investment or one missed goal doesn't completely wipe you out.
Right. So you can stay in the game, keep playing.
Exactly. Have enough room for error, enough of a safety net so that risk doesn't take you out permanently.
So really, understanding this interplay of luck and risk, it fundamentally changes how you see everything. Your own wins and losses.
And other people too.
And maybe foster something we get more of.
Yeah.
Humility when we win, and when we feel that.
Definitely. Think about how that shift in perspective could actually reshape choices you make, your empathy, even your whole journey forward. Anything you finance, always about wealth.
Right, the strategy, the
Exactly. How, if the real skill, the one we don't talk enough, actually staying wealthy.
it's a stand. That's really what we're diving into today. Our source, it argues strongly that both there's ways,
And then with, yeah.
but we only know what keep. And that's this kind of frugality and
Frugality and parent. That phrase really jumps out. Because, we're often told, gold, chase growth. Why the combo? Frugality and paranoia. Seem almost expensive.
Well, it is, in a way, but it's a long-term. It's about managing not just pay, but ahead over decades. It is just pinching pennies.
Okay.
It's about building first, giving yourself space so you're never back to a corner, forced to make bad decisions when things get off.
And the parent part, like hiding under the bed.
No, not quite. It's like active vigilance. Really understand all the ways things can go wrong and building into your thinking. Being prepared for surprises, not just hoping they happen, but resilience, really.
So our mission today is to dig into that. What does financial longevity actually look like? Not just a flash of the pan.
Exactly. Survival isn't just one skill, but maybe ultimate financial skill.
And we're drawing on some really interesting insights, financial psychology perspective. Lots of history, some counterintuitive stuff too.
Yeah, should be good. And to really get this idea, the difference between getting and keeping wealth, our source kicks off this amazing historical story.
Jesse Livermore and Abraham Jinsky.
That's of their time on the 1929 crash. They didn't know each other, but their stories, wow, Ireland just crashed literally around that event.
Okay, let's start with Livermore. Born in 1877, pro stock trader. By his 30s, worth like $100 million today.
Yeah, huge deal on Wall Street by 1929. Then boom, October 29. Black Monday, Tuesday, Thursday.
It just tanks. Loses a third of in a week.
Total chaos. His wife, Dorothy, she was terrified when people were jumping windows, the story.
She probably thought they were ruined.
But Jesse, he'd done the opposite of everyone else. Genius, luck, whatever you call it. He bends the mark, shorted.
So when it crashed,
he made a fortune. Comes home, Dorothy's distraught, and he said something like, "Nope, darling, just had my best day ever. We're fabulously rich."
Wow.
Made the equivalent of over $3 billion in one day. Became one of the richest men on earth.
Incredible, just staggering. But at the same time, while Livermore was writing, Abraham Jermansky.
Yeah, the other side of the multi-millionaire real estate made his money in the roaring 20s.
Like a lot of people, that big stock market continuing to go up.
And it October 26, 1929. New York Times, he's just disappeared. Vanished. His lawyer, he invested heavily in stocks. Yeah. And that's kind of where his story ends. Ruined.
So right there, the crash made Livermore and Jermansky. Stark contrast.
Absolutely. He's the part that really drives the point home. Fast forward 4 years.
Okay.
Livermore. He's riding high from that 1929 feeling insolent. Starts getting bigger and bigger bits. Gets massively into debt.
Oh no.
And loses all, everything. And tragically,
wow, so they both end up
in ruin. Different paths, different timing, but same outcome. Our specific. Both were very getting wealthy and equally staying wealthy.
That hits hard. And it's not about business, is it? This applies to, well, anyone trying to build any family.
Exactly. Money is one skill set. Keeping it, that's a whole different ballgame. Survival, our source keeps active. Survival is the key.
Survival. It sounds so basic. When you look at the stats.
This is tough. Think about it. 40 companies big enough to go public eventually lose pretty much all their value. Wiped out.
40%. That's huge.
Yeah. And the Forbes 400 list, the rich people, roughly 20% over every decade. People fall off. It shows just how hard it is to stay on top, to survive.
And maybe that's because skills are different. Getting rich often involves taking big risks, right? Being optimistic, maybe aggressive.
Totally. Put yourself out there. But money, our source says it's almost the opposite.
Like what?
Humility, for one. A real fear, a healthy paranoia about losing what you built. Frugality, definitely.
Yeah.
And crucially, accepting that some of your past success probably luck.
You can't just expect it to repeat forever.
Right. This is no guarantee,
A great example of this isn't there. Venture capital. Michael Moritz at Sequoia.
Oh, fantastic example. Sequoia, they've back to Google, Apple, all these massive companies. Been around for decades. Most VC firms last maybe 10 years.
So Rose, what's the secret? Why did you guys last?
And Moritz's answer wasn't about brilliant insights or finding the next bit. He said, "I think we've always been afraid of going business."
Afraid.
Wow. Rose pushed him. It's fear. Only the parent would survive. It was like, there's a lot of truth. We saw one yesterday. Can't rest on else.
So it wasn't about being smarter. It was about being worried about messing up. About survival.
Exactly. Just sticking around, awaiting the fatal foundation. And it connects directly to the power of compounding.
Yes. The magic eighth wonder of the world, or what call it. How does survival play into that?
Compounding is one thing above all else. Time. Using years for it to take off.
Like planting oak tree sources.
Yeah, for analogy. 1 year, how much change? 10 years, okay, something's happened. 50 years, incredible. But
you have to be there for years.
You have to survive all the storms, the droughts, the unexpected stuff that happens along the way. If you wipe out early, the oak never becomes a forest. Compounding needs time.
That makes sense. And we think about someone like Warren Buffett. Everyone talks about his amazing returns, how he stocks.
Right, to copy his.
But maybe the real lesson is what he didn't do.
Exactly. Think about it. He didn't look at. He didn't excel during 14 years he lived through.
15. Wow.
Even his reputation. He didn't marry himself just once. He didn't rely on other people's money. Didn't burn and quit.
He survived.
Gave him life, age 10, early 90. Expand what let compounding work magic. Survival in the.
And there was that other guy, our group, Rick Guerin.
Yeah, Rick Guerin. For a while, it was Unger and Guerin, kind of the three amigos of value investing.
So what happened to him? Buffett had something telling.
He did. Well, asked about years later. And he said, basically, Charlie and I knew Gitch. We weren't hurt. Rick was just smart, but he was in a hurry.
How did that play out?
Well, 1973-74 market crash. Nasty one. Market down almost 70%. Ouch. It was leveraged. He'd used loans, borrow to invest.
So when the market crashed,
his brokers demanded money or he'd sell his share of loans. He was forced to sell his Berkshire Hathaway stock to Warren for $40 a share.
Oh, painful. Stock that became millions later.
Exactly. So Guerin was just as good at getting smart. But Buffett and Munger had that X skill, seeing wealthy.
Wait, the long haul is what really matters.
It's everything. The single life said an edge and surviving. You do this. First requires the second. You avoid at all costs.
Avoid ruin at all costs.
Okay, so these words make it crystal clear. But how do we, do that? How do we build this survival mindset?
Source gives us 3 principles.
Yeah, practical ideas. Aim for financial unbreakability, more just chasing the biggest turns.
Unbreakability, I like that word. How does that look bigger and sounds counterintuitive?
Because breakable means you can stay long enough for a compound to work. You don't get forced out at the worst spot on.
I like the example of holding cash. That is the opposite of maximizing returns, especially when it's hot.
Extra percent, you're catering 1%. Feels like you're losing. That's absolutely.
That's leaving on the table.
But it's your perspective. What if holding that low return cash stops you from annexing your stocks when the market inevitably crashes?
I see.
The real return on that cash wasn't 1%. It was where catastrophic loss you avoid could be multiples higher than 1%. Preventing one terrible mistake can be more than dozens of wins.
So unbreakability affects your long-term compounding.
Precisely. Compounding doesn't heat every year. Just good returns sustained and interrupted for the longest period of time, especially through the chaos. Survive the chaos.
Makes total sense. Okay, number 2. Plan on the plan, not going to plan. Embrace them for error.
We all make plans, right? Financial plans, life plans, they're useful, set direct.
Realities.
Always. Think about the last 20 years alone. It's unpredictable. 9/11 housing crash, millions lost homes. Then the financial crisis, millions lost jobs. The war, the pandemic.
Yeah, the unexpected is effective.
Yeah, the unknown is just reality. So a good plan doesn't pretend everything will be smooth sailing. It builds in buffers.
That's largely it.
Yeah. Room for error. It's okay. I hope the market gives me 8% a year, but my plan still works. I'll still be okay. Even if it gives me 4%.
Not fret. You don't need everything to go perfectly right for your plan to succeed.
Exactly. So many fail, not because the core idea was wrong, but because they require pinpoint accuracy. Things had to be clearly right. Margin safety protects you from that.
That's not being conservative, is it?
No, it's smart, but increase causes level of risk. And the bigger your margin safety, the less your need to be. You don't need a big and edge.
It's like having air belts. You saw it, bad things go wrong.
The principle, develop a barbell personality.
Barbelled, like weights.
Kind of. Heaviness. It means being optimistic about the future, but simultaneously paranoid shorten threads that could stop you from reading the future.
Optimism and paranoia have that silent contradiction.
It feels like it. It's how complex and often work. You need both. Be confident will generally get better over time when innovation happens. That's the optimism.
Okay.
But also be acutely aware that it'll be full of setbacks, crashes, unexpected problems. That paranoia needed to navigate the short term.
So believe you'll reach the destination, but watch out for landmines along the way.
You got it. They aren't mutually exclusive. Think of
okay.
By your teams, you guys talked about half-brain connection you had. Sounds terrible, right? Destruction.
Yeah,
but you're way smarter as a 20-year-old.
Yeah.
Destruction is actually pruning, getting rid of material to make the network strong. Progress.
Huh. Interesting. Never thought of that way.
The U.S. economy example is even more striking. Over 170 years, standard of up 1-fold. Incredible progress.
Long-termism, yeah.
During that same period, 9 major wars, 1.3 million deaths, countless failed businesses, presidents assassinated, pandemics, natural disasters, 30 recessions, market crashes dropping by a third 12 times.
Constant reasons for pessimism, even panic.
Rarely it went by without so deeply worried. Yet the long-term trend was powerfully up.
So you need to hold both, like be paranoid enough day-to-day to side effects.
Seek around enough benefit from long-termism. It's hard mentally. Or like simple, nuance stuff.
But essential for survival. And for he the balance.
His 99 success and him lose it. He thought the good times just keep rolling. Game over. So ahead, as he put it.
All right, yeah.
Yeah, about how no price is vital to get well ahead. He called and they everybody learn that less far too late.
I know the hardest way possible. So let's wrap this up. This deep dive is really shift focus, isn't it? From to the five the
Absolutely everything else.
And those principles seem key. Affordability, not just big returns. Plan for things go wrong, build in that more safety.
Right. Embrace error.
Get barbelled, long-term balance with short-term paranoia.
The powerful framework.
So here's the final one. We talk about development economy. Long-term involves, it requires short destruction, loss, chaos, growth, the mid-loss.
Yeah, pruning the sets.
What do you to your career, project, or what is X? The times you feel you've lost, the moments of paranoia. What if they adjust? That's actually part of the process. Maybe even an insufficient of clear for your to leap forward. What destruction you're like actually paving the way for something extraordinary. Okay, here's a strange one for you. What could the in-year history having in common with your money?
It's unplated.
Right, like a trick question. But apparently the answer to something fundamental about comp.
Exactly. That's what we're digging into today. It's incredible and also really counterintuitive. We're going to pull lessons from these, seemingly very different fields.
Okay, so what's the mission here?
Let's show you. Look at these results that, honestly, our brains are just not wired to predict easily.
Logic find results, it says here. I like that. Resources can geology advance.
That's the plan.
Yeah.
Hacking these hidden drivers of success that often get missed because they seem dramatic enough to start.
All right, let's do it. Where do we begin?
Yeah, let's do it. And it's kind of amazing how recently we even figured out the basics of our own planet. Isaac Newton understood stars century before we really grasped Earth's technology.
That is wild. Space ages weren't always accepted science.
Not at all.
Yeah.
It really wasn't until the 19th century that the community generally agreed, okay, yes, there is multiple ages. Not just one, but 5 sequels.
And what
evidence? Things like massive boulders just sitting in fields miles from any similar rock formation, or huge areas of bedrock totally smooth down to layers, things that only glaciers could re-explain.
Okay, so they cover about 5 ice ages.
Right, and then you think of the energy vault. I mean, the sheer staggering amount of energy needed to freeze huge the planet and freeze again multiple times.
Yeah, that's immense. Naturally, they thought it must be some huge catastrophic event causing it, right?
Precisely. First theories were grand. Maybe huge mountain ranges up with changing weather patterns, or massive blocking out sun. They were looking for a cause that matched the
But they didn't quite work out.
They had a wall, basically. Because none of them could properly explain why cycle it happened over again, 3 cycles.
The repeatability, okay. So the big Americans weren't cutting.
Exactly. And that's where this Serbian scientist, Milutin Milankovic, came back in the 20s. Here was the breakthrough. And surprisingly,
Simple. How so?
He rose down the subtle gravitational pull of the sun and the moon. Slightly leaking Earth's orbit, its tilts wobble over thousands of years.
Okay, I can see how that might change gravity, but cause an ice age.
Well, these tiny changes are how much solar radiation is different. The difference. It's a very slow, gradual shift in sunlight distribution.
We're thinking, well, these just make winters incredibly cold during a freeze. That feels intuitive.
The Novich is an old thought too. Makes sense, right? Cold winter, more ice. But then Russian meteorologist Flood Cope, and he dove into the actual climate data associated with these orbital cycles, and he found something completely counterintuitive. The real driver wasn't brutally cold winters; it was moderate summers.
Wait, cool summers. That sounds underwhelming. How does a slightly cool summer cause a plant-wide heat?
He knows wrong, doesn't it? Think it through. A summer that's cool enough that none of the winter snow away. Well,
A little bit of leftover snow or ice.
exactly.
Yeah.
Small, lingering base snow and ice. Now, left pad makes it easier for more snow to accumulate next winter.
Okay.
Then the you started with more, even less likely to melt, so you slightly left person.
I see.
Right. And that slightly bigger snow patch reflects more sunlight back into space than would, which causes a little bit more local cooling.
And easier to stick around next.
You get more snow accumulation, higher chance of survival, reflects more sun, leads more snowfall. It eats back on its compounds.
So it's snowball effect,
Literally. This process, starting from just one really cool summer, leaving a thin snowpack, can escalate remarkably quickly in geological terms. We're talking maybe just a few hundred years to go from that first percent snow to continental sheet miles thick.
Wow, not a sudden snap, but a run accumulation.
Exactly. The reverse process too, with slightly warmer summers eventually managing to melt more than accumulate each year. It shows how something dramatic can grow from a relatively change in conditions. That seems significant.
Yeah, that powerful result seems to defy the cause.
It really is. A core lesson is matters from a small starting point, applied over time to apply directly well to how serious was often built.
Okay, I can find this is where we're often right. Over 2,000 books.
Yeah, thousands of books pick apart brain strategies, quotes, and look, a lot of them are very
Yeah.
but they often have the simplest, most dominant factor. His forte isn't because he's an investor. It's because he's been well, pretty much his entire life. Since he was a kid.
Murder century source mentioned.
Think about that.
Yeah.
75 years of compounds that numbers are come along.
Yeah.
It's worth around $80.5 billion on the books.
A huge number.
Now get this, $8.2 billion. That was accumulated after 50th birthday.
Wow.
It's better.
Yeah.
$81.5 billion came out in his mid-60s, already eligible for social security.
That's actually unbelievable. So we did it in a shirt, but real magic ingredient is just time.
It's the crucial multiplier. Found a strategy, a higher return relatively speaking, and just stuck with it for an unprecedented long time.
That thought experiment make it concrete.
Okay, so Buffett started around day 10, by age 30, he already had about $9 million, say, adjusted inflation.
Which is already 30.
Totally. Let's imagine more typical. What if he, spends 20, figuring he traveled longer? It's about 30. He had a more modest overall $25,000.
Right.
And let's say he invested $25,000 even asking yours Buffett. But the entire like maybe play some golf, travel.
Right, so finishes earlier. Same Grin still in Booney. What's the outcome?
His net worth wouldn't be $84.5 billion. It would be according to $11.9 million.
11.9 million. Compared to 8 billion.
Yeah, that's 99.9% less. Later and later, even with last person.
Okay, I drive my home hard. Still investing.
His secret is time. That's compounding running over decades.
And there's that comparison with Jim Simon, right? Hedge fund.
Simon's from Renaissance Technology. At this point, clear, I think. Simon's return is astronomical, around 6% per year since 1988.
6% a year. That's saying Buffett's around 2 times.
Roughly, yeah. So he immediately says Simon's vastly richer. He's clearly the best on an average basis.
That's the reason.
He's not. His net worth is estimated at $21 billion, which is incredible, but about 75% less than Buffett, $84 billion.
10% less, even with triple the return. Wow.
Yeah. Simon didn't really estimate Renaissance yield.
So he less than half time compound compared to Buffett.
Exactly. Less than half runway for those amazing to fly. Just to show you how get, Simon had somehow managed his 60% return the full 70 period Buffett's investing.
Oh, Dick's coming.
Brace yourself. He'd be $3 quintillion.
Less than monopoly money. 18 zeros.
Pretty much. It's an interactive summer. It highlights the seemingly small changes in growth assumptions, or the time left growth lead to the mind-boggling outcomes.
And because I'm so maybe focus off on the
I think exactly. We dismiss results and we overlook the simple powerful drivers like patient or like the summer's contagious.
Perspective feels so counterintuitive. Why founding surprises?
Boils down to we linearly more naturally than exponentially. Meaning, if I calculate 9 times, you get that quickly. I do simple addition.
Right.
I calculate 8 times 9 times. 8 to the power 9.
That's a later time.
Exactly. It's 134,217,700. Clearly the beast. Our intuition for the kind of rapid multiplication, that exponential explosion.
Yeah, definitely not the hard example like for you. Everything notices a fast thing to scale up.
Statistical ratio. IBM hard drive 50s, maybe 3.5 gates. Huge thing upward.
Right.
But Randy's will see I'd have what, 2,500 bytes? These something did. Then, whoosh. Curve, vertical. Think about numbers. From 1990, 4 years, he made 300 bytes or so storage. For 1980, roughly 30 years, being, drives are measured in terabytes, a million megabytes. We put into 100 megabytes in a short time frame.
A million times more storage. It's hard to even get your head around that kind of change.
It is. And I would have realistically predicted just how even very smart people get caught out.
Like Phil Dixie.
2004, a full gigabyte of storage free. The
I
revolution.
remember that is simply generous.
Right. And Bill Gates publicly questioned it, wondering why anyone would chase. His thinking, even as early as 4% back, still in that old storage and next match.
Just to see the exponential trend continuing at that pace.